Hello folks, good morning. I hope you guys are doing great. So I'll start our first day lecture about breaker very soon at 10:50. So before that, please let me know if you guys can hear me loud and clear. Thank you folks, thank you for letting me know. The microphone is very close to my mouth, so sometime you guys will hear like the voice won't be very clean, it will be distorted, so I can't do anything about it. I'm putting it as much away from me as possible, but hope it will be good. So our 3-day boot camp, we are starting our first day of our 3-day boot camp, and this will be completely based on breaker. Everything that I do with breaker. Okay, there are a couple of stuff that I'll do that I put it away for another session. I'll do another session with breaker with you all, because one day what I thought is not enough for all the knowledge that I'll be sharing. You guys will require a little bit more examples from my part to understand each concept clearly. I included examples in our today's lecture, but these are not enough from what I think. So I'll do another session with you all about breaker, and there today I'll cover like most of the topic, like 90% of the topic. Rest of the 10% I'll put it away for another session that I believe is very important for you all to understand. Okay, so I'll give like extra time for that, another session another day. So the date is yet to be decided. I'll let you guys know as soon as possible once I'm done creating all the content for our later lectures. Okay, our next lecture that was supposed to be on 24th October about inversion, it may get delayed because, as I told you guys, I'm not satisfied with the examples that I made. I want to present more with you all, but if you guys agree, we can do like one session on 24th on inversion, and then another session on inversion at another day. Okay, so we'll start very soon our 3-day boot camp. I'll be waiting 1 or 2 minutes more for everyone else to join, and we'll start exactly at 10:52. So you guys can ask me question, any type of question. It doesn't matter if it's a beginning question or if it's a like an advanced level of question. It will be answered. I got nothing to hide, so I encourage you to ask me the question, but your question will be answered once I'm done explaining one slide or one topic. Okay, so don't be like you have to ask the question right now. I'll ask it, but it will take some time. Once I'm done explaining from my side each slides, I'll try to answer each and every question. I'll go through each and every question that you guys will be asking me here. So I chose YouTube to do the live stream, as on Zoom the quality is a bit reduced on Zoom. I tried to do the stream from the Zoom first, but the quality is stick with 720 pixel. So to me quality matters, so that's the reason I'm doing the stream on YouTube. You guys can watch this stream and it will be recorded. Okay, so you guys can watch it with higher quality later in future. It will be available for the lifetime. So if you don't lose the link, or if you download it, save it for the later, that will be good. A lot of you are asking me about the PDFs, the slides. So every slide that you will see is done by me, and everything is handmade. Okay, so these slides won't be available with the workshop that you purchased, but it will be available for purchase later after I finish the stream. I'll let you guys know more about the details of how to purchase the slides, which will be with high quality, and you guys can use it for studies or print it out. But you guys can also take screenshot. I believe the stream is running on 4K, so you guys can take the screenshot, which will also be very high quality, and then later you can print it out. There's no difference between this stream and the PDF, literally nothing. The PDFs are like you are getting the actual quality, but from the stream, whatever quality you will get from screenshot, that's it. Other than that, there's no difference between the PDF and the actual slides that I'll be sharing here. So we will be starting now. Okay, folks, so our first day is about the breaker. I'll share the complete model with you all here. So we'll go through a lot of topics. So our first topic that I'll go through is here about the macros that I use on stock, US 30, US 500, US 100. I also shared macros on Forex and crypto. These macros will have a separate lecture with separate models, okay? For today, I'll only be talking about the stocks, not Forex or crypto. These lectures will be solely on stocks. US 30, US 500, US 100. A lot of you mentioned it as Dow, ES, and NASDAQ. Our next topic will be how a breaker forms. Okay, there are a couple of rules that you will have to follow to identify a correct breaker. There are 5 rules that I'll be talking about with very deep explanation in our second slide. In our third slide, we'll be talking about all types of high probability breaker. There are 7 or 8 types of breaker. Okay, so I'll be sharing with you like how that breaker will be forming, what we'll be looking at, everything, and all of these models will be high probability. I won't be sharing the low probability models in this lecture. I'll be sharing the low probability models in a separate day. As I mentioned, we will have another session on breaker later this month. So that time I'll be sharing like what breakers you'll be avoiding, how to avoid a breaker that will fail. It will not be included with this lecture. Rather, these lectures will be very important to understand because nothing is guaranteed for 100%. Even your A+ setup will lose, so you will have to understand when it will lose. And that's the reason I put it separately, and the lecture will be given this month, and I'll let you guys know about the date. The fourth topic will be about the time distortion with breaker. Like it's more like when price does manipulation, high resistance liquidity run, and the lecture will be based on that. The fifth lecture will be AMD cycle plus liquidity with breaker. This lecture as well, this topic as well will be separated from this lecture for our later lecture, which I'll be doing later this month. Our sixth topic will be entries with Reaper breaker, how to take early entries with breaker before price activates a breaker. Okay, so on the third lecture, I'll be talking about like how price activates a breaker, how to take safe entries with breaker. On sixth topic, entries with Reaper breaker, I'll teach you guys how to take entries early before price activates a breaker, after we do turtle soup. So the turtle soup entries will be included in the third day of our lecture. That will be separately based on turtle soup, but today it will be on breaker. So I'll teach you guys after we take a turtle soup entry, how can we do early entries with breaker. There are a couple of entries that you guys don't know about that you can take with breaker, and you will know it in the sixth topic, entry with Reaper breaker. And trust me, no one other than me, I believe, knows about this Reaper breaker concept. The second topic will be reclaimed breaker. This alone will give you a lot of narrative, okay, a lot of logic behind what price does at certain times and why it does it. The seventh topic will be based on that. The eighth topic will be breaker in a trend. So sometimes you will see like price is trending, a lot of down close candles in a row, like 5 or 6 candles in a row. So how we will trade that? We will also be looking for a breaker forming in a trend. There's a logic, and the logic will be shared in the eighth topic. The ninth topic, which will be after the macro. Okay, I mistakenly put it here on ninth. This topic will be discussed second, after I talk about share the macros, breaker plus silver bullet. There are a couple of macros that I use other than the actual silver bullet timing that our mentor shared, 10 to 11. There are two macros that forms inside this time period. There are two other silver bullet time zones. I will also share about that in the ninth topic. The 10th topic will be about new week opening gap and the new day opening gap with breaker. How can you trade using new week opening gap and new day opening gap? Okay, so this topic will be also separated from our today's lecture. I'll put it away for another day, because these are the topics, the AMD cycle that I showed you guys, AMD cycle plus liquidity with breaker. Then this topic, new week opening gap plus new day opening gap with breaker, these will be separated from today's lecture, because these are very important lecture that requires a lot more time to understand. Okay, that's the reason I will give you guys more time. So the 3-day bootcamp will be more like 5 days, 4 to 5 days. I hope you guys don't mind getting more knowledge, right? So the 11th topic will be implementing standard deviation to project target. How can we measure a price lag from the breaker and project it in future to get specific targets? I'll talk about that in our 11th topic. The 12th topic will be when to avoid breaker. This topic is also separated from our today's lecture. 13, SMT and mitigation block with breaker. And 14th, a complete market maker sell model with breaker. So when I'm talking about reclaimed breaker, reaper breaker, I'll also talk about market maker buy and sell model with breaker. It's very easy to understand. I know you guys watched a lot of videos before from other Twitter traders about market maker XM, but what I'll be sharing with you all is very simple, the way I look at the chart using market maker buy and sell model. So I hope every topic is clear here and everyone understood. I'll be moving towards our next slide, where I'll share my macros. Okay, the macros that are available from the ICT himself and the macros that I use personally. So let's go. So the macros, I categorize these macros in two types. Okay, the first macro is manipulation macro. In these macros, you will expect to see price changing the trend. Okay, so suppose price is in a trend in a buy model. At these specific time periods, you will expect to see price having a market structure shift. Okay, so what are these macros? The first one is 8:20 to 8:40 a.m. EST. Don't worry, I'll be sharing the models that you will look inside this time period. Just for now, like remember, focus on the time periods that I'll be sharing here. 8:20 to 8:40 a.m. Eastern Standard Time. Why this time period is so important? Is the start of our New York zone. Okay, 8:20 to 8:40. That's the time period when you will see liquidity coming into market. Before that, price will be very slow with low volatility, low liquidity. But as soon as price gets inside 8:20 to 8:30, it will have liquidity, and that liquidity will provide us three types of setup. Okay, the first type of setup will be with breaker, second inversion, third will be on turtle soup. So I'll be talking about breaker today. Our second macro will be 9:20 to 9:40 a.m. EST. That's the macro that I personally use. Like there are days when I'm only executing inside 9:20 to 9:40. Other macros I'm basically not using. So this macro is very important. This macros lecture will be also added in a separate lecture, okay, like what to expect before this before this time comes in, or what to expect when price is trading inside 920 to 940 period. 930 is our New York Stock Exchange opening, so we see like a lot of volatility. What I'll teach you guys, like how to predict the Judas or the 930 delivery before price actually delivers it. We will have some confirmation from chart from price that will confirm that we can take or we can predict a move before it actually happens using this time period 920 to 940. We'll have a separate lecture about this macro specifically. It's very important. It's a very high probability macro. Among every macro that I'll share, this is the highest probability. Then we have 10:20 to 10:40 a.m. EST, which will be included inside the silver bullet macro. 11:20 to 11:40 a.m. Eastern Standard Time. Each of these macros here, folks, remember we are looking for market structure shift. We have other macros where price will continue a trend. Suppose price is already in a trend in a buy model. At those time, you will expect to see price continuing the trend. If price don't continues the trend at those time, then you'll be looking for different things about what I'll talk later. So we have our next macro, which is at 120 to 140 a.m. EST. It's our launch macro, which is very high probability. You guys usually like 60 to 70% of the time you will see price changing its trend inside this time. So what ICT uses is 120 to 140 macro. What I use is 110 to 140 macro. That's the macro from ICT. What I found is that our setup, our breaker setup forms after 10 minutes of the macro that ICT shared, okay? 110 to 140, this macro will be included with turtle soup. That's when in between the 10 minute, okay, the first 10 minute of 1 p.m. Eastern Standard Time, we usually have a turtle soup setup, so that macro will be included inside our turtle soup lecture. But today 120 to 140 macro will be for the breaker. Then we have 220 to 240. Every hour we have two macros, folks. 20 to 40, then 50 to 10. Always remember that. That's it, okay? You can use the same macros on Forex, okay? You can do the test. I didn't. I only tested macros on Asian session, and I found Asian session high probability than New York session. Price runs very clean inside Asian session on Forex. So when I'll be talking about Forex, I'll share those macros as well with the deep lecture. Our third macro is coming at PM 320 to 340. Now we will see like where price will continue a trend, okay? We are expecting to see price having a market structure shift at 820 to 840, okay, folks? And after that, if suppose you missed the macro or you saw the price changing the trend but there was no high probability setup, we will continue to look for setup at 850 to 910. But this time we are not looking for price to have a market structure shift, rather continue the trend that it will generate at 820 to 840. I hope you guys understood. If not, we will have more deep lecture coming very soon. Then we have 950 to 1010. This is a trend continuation macro. Okay, so before I talk about that 850 to 910 macro, inside here price will set the liquidity for 930. Okay, inside that time period you will see price generating either sell side or buy side liquidity as a form of relative equal high or low. Okay, inside this time period price will generate that 850 to 910. 920 to 940 price will generate our high probability model that will clear out the liquidity that price generated at 850. Okay, so did you understood? At 850 price will generate liquidity for 930 volatility. Okay, at 930 price will clear out the liquidity that is generated at 850, and we will target this 850 to 910 liquidity inside 920 to 940 macro. I know it's maybe sounding like a little bit confusing because it's your first time, but trust me, I will take you guys through deep with a lot more examples in coming days inside these macros. Even today you guys will see like what you will expect to see forming here. So our next macro is 950 to 1010. It will be a trend continuation macro as well, because at 920 to 940 we are expecting to see a change in a trend. Either price will go towards buy side or sell side. It will very less of the time you will see price continuing a trend inside 920 to 940. Okay, so inside 920 to 940 our high probability is the market structure shift. 950 to 1010 is a continuation of the trend. 1050 to 1110 same trend continuation macro. We will be looking for price to change its shift, have a market structure shift inside 1020 to 1040. After that we will look for price to continue the trend at 1050 to 1110. So there will be a lot of setup, folks, okay, forming each and every day. Now you don't see it because you don't know what price is doing at exact these times. I'm sharing this logic with you all here. Then we have our fourth macro, 1150 to 1210. 1250 to 110 pre-launch macro, very high probability. Okay, why is it high probability? We have a launch macro at 120 to 140. So if sometimes what price does, does the early market structure shift. Okay, at 120 to 140 I told you guys that price does a market structure shift. But at 1250 to 110 sometimes, like 40 to, I believe 30 to 40% of the time in my result, I saw price having the market structure shift early inside 1252 to 110. So how to know that price will have that early market structure shift inside the time period? I'll show you guys some setups. If the setup is forming inside this time period, that's the time you will execute without hesitation. If you lose it, don't worry, we have another macro 120 to 140. If price is not changing its trend, okay, inside 1250 to 110, we will look for our next setup forming inside 120 to 140. So pre-launch macro, folks, is very important. These are the two times that specifically with high probability we'll expect to see market structure shift happening. Okay, these are very common things that price repeats, and you guys will see it repeating once you know it. And our last macro that I'll be focusing on is 350 to 410. This is our final macro. We have 220 to 240, 320 to 340. These are the times we are expecting to see a market structure shift happening, either of these times. Okay, and once the market structure shift happens inside 350 to 410, we are not expecting a market structure shift, rather a continue of a trend. So I hope you guys understood the macros that I shared and what we will be looking for inside these macros. These are the things that we'll be looking at these macro times. We expect price to break out from a consolidation. That means we are looking for a market structure shift, reach for higher time frame premium or discount pretty area. That means we are expecting expansion. Okay, expansion towards a direction, our draw on liquidity. I'll share with you all what target we'll be looking for, so don't worry about that. Our third thing that we'll be looking at these macros is price to deliver liquidity as swing high or swing low to change a trend, and we will expect price to have volatility. That means low resistance liquidity run. Low resistance liquidity run will generate our high probability setup. We'll be avoiding every types of high resistance liquidity run. And if you don't know about these things, don't worry, I'll introduce to you what a high resistance and a low resistance liquidity run looks like inside our time distortion topic. So I hope each and every one of you understood these topics. We have another macro that I forgot to share, or it came up late. The fifth macro, 1220 to 1240. Same thing, we will be looking for price to change its trend inside here. So I hope everything is clear. So Madonna is asking, is these macros are applicable to every market? It's not. It's applicable only for stocks. Okay, stocks specifically on ES, Nasdaq, and Dow Jones. Other than that, you guys can look for. I didn't test it, but you guys can test if these macros works on Forex as well. The macros that works on Forex with high probability, with higher win rate, I will share. I already shared these macros in our private Telegram group, so you guys can go there and watch these macros. But the lecture on those macros will be later this month. So our next topic is on breaker and silver bullet. We'll be looking for the macros that will be inside the silver bullet. So a high probability breaker forms inside 3 silver bullet zone. There are 3 silver bullet zones for stocks. Okay, these silver bullets are only applicable to stocks. I'm not talking about forex or crypto, so don't confuse it, folks. These are the silver bullet time periods that we'll be looking at: 8 to 9 a.m. Eastern Standard Time, 10 to 11 a.m. Eastern Standard Time, 2 to 3 p.m. Eastern Standard Time. So we got one silver bullet from ICT, 10 to 11 a.m., but we have 2 other silver bullet time periods that where we'll be looking for price to form a fair value gap and then continue the trend. So the fair value gap lecture will be included in our inversion lecture. So today I will only be sharing what type of breaker forms inside this time periods. Okay, we'll not be looking for inversion setup, but inversion with breaker, that's what we will be looking for. Separately inversion, we'll talk about this in our inversion lecture. We will not be looking at this 1 hour period randomly, but in specific time zones inside silver bullet, the specific time periods are. So listen, folks, we are not randomly, okay, we know about the silver bullet, but what we are doing, we are not focusing on this whole 1 hour time period. We'll be focusing on specific 20 minutes time intervals, and these intervals are 8:20 to 8:40, 8:50 to 9:10, 8:20 to 8:40. I already shared with you all that this is a manipulation macro. What happens inside this macro, folks? You already know it. We'll be expecting to see a change in trend. 8:50 to 9:10, we'll be expecting to see price continuing that trend inside the silver bullet time period. Other than the times that I'm sharing here, we are not trading there. Okay, that's the time you will see price doing high resistance liquidity run, means manipulation. Price will become choppy, it will have less volatility. We will trade only inside the time periods when we will expect to see high volatility. Why high volatility? Because that's when you will have less emotions. Either price will hit your stop loss in 1 minute, or it will hit your TP in 2 minutes. That's it. When price is having high resistance liquidity run, rather than generating profit, it will generate emotion inside you. So suppose you were supposed to like have a clean mind for your next setup, you will lose that state of clean mind because of the high resistance liquidity run. So that's the reason we will only be looking at 8:20 to 8:40, 8:50 to 9:10. Our second silver bullet is 10 to 11. So we'll be looking inside 10:20 to 10:40. We'll expect to see price changing its trend inside this time period. Then we will have another macro at 10:50 to 11:10. That's the period when we will be looking for price to continue the trend. Then we have our last 2 macros inside our silver bullet. Now last silver bullet, 2 to 3 p.m. Eastern Standard Time, which is at 2:20 to 2:40, then 2:50 to 3:10. 20 to 40 period is the time when we will be looking for price to have a market structure shift, and 50 to 10 period is the time period when we'll be looking for price to continue the trend. So it's not the theory that I'm sharing, the logic that I'm sharing here is it's not gonna work 100% of the time, but this is high probability. Okay, 80% of the time from my experience, it changes month to month, week to week. Okay, some days you will see price just continuing the trend at 8:20 to 8:40, but these are very less of the time. Most of the time price you will see price doing what I'm sharing with you all. So I hope you guys understood what I shared here. Breaker and silver bullet, these are all the times we will have models in our lectures. So I hope everything is clear here. We'll be moving towards our next topic. Okay, so before we do that, I'll be focusing on this specific silver bullet time period. Okay, this is the highest probability silver bullet among the three of it. Okay, so 1020 to 1040, 1050 to 110, sorry, 1110. What's the importance of 10 to 11 a.m. macro? Why is it so important? Why I'm telling you guys to focus here? Because we are ending the first 90 minutes of trading. Okay, so the 90 minute of cycles, I'll not teach you guys that here. It will be included inside my mentorship, but once price does a 90-minute cycle each of the time, it generates a setup. I'll be talking about the setup here in this lecture. The next thing that makes this silver bullet very important is that it's last hour before we get to launch macro, sorry, New York launch. That's when price gets choppy. So before that, we expect to see volatility inside price. So our next topic is my high probability macros. Okay, I don't use all the macros that I shared. I don't look for setup all day in price. Rather, I look for setups as specific macros, the macros that I know will present what I look for. Okay, so this topic will be my high probability macros. So the first high probability macro that I use is 920 to 940. High probability for breaker and turtle. So very less of the time you will be seeing price forming an inversion setup here, but most of the time you will see 70 to 80%. This is the highest probability macro that I use, folks. Like, this thing repeats with 80%, 80 to 85% of the time you will see price repeating a breaker or a turtle soup setup inside this time period. Because why it repeats here so often? Why is that? So what I understood is that most of the people avoid this trading inside this time period. Either they are waiting for price to open and see what price did, okay, where it opened, and then take the entry, right? Most of the people do that, more than like 95% of the people. So 5% of us who follow what I'm teaching here, or we look for setup before the New York open, we see that price repeats very often two types of setup, breaker and turtle soup. So this is the highest probability macro that I use. The second one is 950 to 1010. What I found from my results is that price continues a trend inside this macro 65% of the time, because it's a trend continuation macro, right, folks? Because it's 50 to 10 macro. Each and every 50 to 10 in time interval is our trend continuation. 20 to 40 is our market reversal macro. But sometimes you will see price not following our logic, but the setup will be there even when price is reversing. So if you are confident in the setup, you can take it, because 35% of the time I found that market reversed inside this macro. But the high probability is the trend continuation. 1020 to 1040 is our silver bullet macro. 1050 to 11 trend continuation macro with high probability 70% of the time. 120 to 140 launch macro, mostly good for reversal. We'll be looking for specifically and only price to change a trend. We will not be looking for price to continue a trend inside 120 to 140. This is very low probability. Okay, folks, this time period you look for price to have a market structure shift. A market structure shift. Then the last macro that I use, suppose I didn't find any setup, any high probability setup inside this time period, which is very rare, or suppose the AM session I'm avoiding completely, then on PM session I only trade these two macros, 120 to 140, 220 to 240, which I consider as a reversal macro or a change in trend macro. 50% of the time I found this macro inside this time period price changing is trend. Another thing important about this macro is that suppose price is not changing its trend inside 1250 to 110, then 120 to 140 macro, we'll be looking for price to change its trend or have a market structure shift inside 220 to 240. It's only applicable, folks, when price is not changing its trend inside these two time period. What time period? 1250 to 110. I'm repeating myself again. Then 120 to 140. If the change in trend is not visible, we will expect to see price changing its trend inside this time period. I hope everything is clear. These are very easy to understand, all based on theory. And at the end, I'll say to you guys that less is more. I will suggest you guys to focus on less macros, not looking for setup all day. There is macro, it doesn't mean that you will be looking for setup all day. When you limit your focus, your focus will improve. You will be able to identify high probability setup more. But if you look at charts all day, you will get confused, you'll lose your focus, and that's the most important thing, to keep having the focus in chart. So our next topic is all types of high probability breaker plus their formations. So there are 7 types of breaker that you will find which is high probability. There are 2 other types of breaker which is low probability, which will be included inside our next day. Okay, so today I'll only be sharing with you all the high probability setups. So our first lecture will be on the actual breaker. The second lecture will be on breaker plus fair value gap. So when price forms a breaker with a fair value gap, it comes in 3 formation. The first one is fair value gap swing high or low. The fair value gap will be either at the low of the breaker, okay, near to the swing low, or at the swing high. Don't worry, I'll show you guys the example. The second formation will be fair value gap inside breaker, okay, and the third one will be twin fair value gap and breaker. Price will have 2 fair value gaps inside one breaker. So when price does that, what you will be expecting to see, I will also share that. Our third lecture will be on breaker plus inversion. So here we have 2 types of formation with inversion at manipulation lag, okay, and the second one is at inversion at Reaper, how to take early entries in using inversion. So this lecture will be included inside our Reaper breaker. When I'll be talking about the Reaper, I'll share like how to take early entries with inversion, or a entry with inversion, which will be inside the Reaper. Our fourth topic will be on breaker plus order block. Fifth will be breaker plus volume imbalance. So when price forms a volume imbalance, it comes in 2 types of one type of formation, which is at volume imbalance at third leg. There are 3 legs of a breaker, okay, and each of the leg you can use to take a entry. I'll share with you all. So far I believe you guys only know about how to take a entry from a breaker using the third leg, okay. The first and second leg, I'll share it here for the first time with you all. Then we have breaker plus liquidity void, which is also a high probability setup. Then we have at the end breaker plus BPR, which is one of the most common pattern with breaker that you will see, and I'll share with you all like the 2 types of common BPR patterns. So now we are approaching towards our actual breaker lecture. So I'll be sharing with you all how a breaker forms, what are the rules, what are the things that you will look for to see a high probability breaker forming, or to identify a high probability breaker. So before that, I'll just answer some questions here. Suraj, he's asking, what is the higher time frame we need to see the setup? I'll discuss about that. What is the lower time frame we need to see the execution? What days we need to avoid the trades? What is the invalidation for the setup? Everything will be shared here. Suraj, you asked the questions early, so I'm just approaching towards our lecture, and every question that you asked will be answered in each of the slides separately. So what do we look for in price to identify a high probability breaker or just a breaker? There are 5 things that we look for in price to identify a breaker. So the first thing will be, we'll have to identify from where price will reject or get support from the higher time frame. So higher time frame PD area for support and resistance that goes with our daily bias. This higher time frame PD area can be fair value gap, inversion, which is a failed fair value gap, or a order block, etc. We'll be looking for price to reach to this premium or discount PDRAs according to our bias, and then we will expect to see price rejecting from there or getting support from there with plus forming a breaker inside these PDRAs. So I include a pattern here. So suppose we have a as you guys can see, we have a price action here. Price had a market structure shift. As you guys can see, we have a high here. Price broke out this high, then the change in trend happened here, the market structure shift, then price continued the trend towards sell side. So when price does that, each and every single one of the time, folks, price will have a PDRA that will either be untapped or unfilled. So if it's a fair value gap, then you will see like it's coming into the premium PDRA and it's not unfilled, or you will see like a order block that price didn't use before. I will also teach you guys what order blocks to look at, which will be coming at later in our lecture. So the first thing we'll identify is the higher time frame PDRA. I'm showing you an example here for shorts. So as soon as we identify the higher time frame PDRA, we'll be looking for price to tap inside this PDRA and continue its trend with a breaker forming. Okay, so our first rule is to identify a high probability PDRA on a higher time frame from where price can reject. Okay, here I'm showing you an example of bearish chart, but if price is going up and you are expecting to see price like continue a trend towards bullish or buy side liquidity, it will wait to see price getting support from a higher time frame PDRA. It's very easy to understand, and I'll talk a lot more about this in our coming lectures. The second thing that we'll be looking for is a clean swing high or low. So there are some rules to identify a clean swing high or low. So your swing will have to look at like this. Okay, so suppose you are looking for a bullish swing, then the candle that is on the middle, it will have to have a candle on the left and the right side, like on the upper side from this one. Okay, it will have to close a candle's body above here. It cannot close a candle's body below the middle candle or like below this candle's wick. It will have to, the candle on the left and the right side will have to close its body above the middle candle. Same goes for the bearish swing. We'll look for price to have two candles right next to each other, lower than the middle candle. I hope you guys understood. It's a very simple thing to understand. It's a very simple pattern. If you see this pattern in price, this is our second confirmation that price is forming a breaker. Once you identify a clean swing high and low with two candles right next to the middle candle, which will be lower, you will be able to identify a high probability breaker. So this pattern will be vice versa for longs. Okay, I wrote here shorts, which is incorrect. Vice versa for longs, you'll be looking for, as I told you guys, you'll be looking for price to continue its trend from a discount PDRA if you are looking for buy. So the first thing, you will have to identify a higher time frame premium or discount PDRA. Once price reach that PDRA, you will be looking for price to reject with these clean swing high and low. Our third rule is that price will have to have a stop hunt. Later I'll teach it as a turtle soup. Okay, I'll teach you guys how to take an entry once price forms these swing highs. Okay, because when price is forming this swing high, is also forming a breaker setup, which will be a turtle soup setup, which will be included inside our turtle soup lecture. So our third rule to identify a high probability breaker is to have a stop hunt. So the second rule was to identify a clean swing high, which will be forming inside a higher time frame PDRA. So we identified a clean swing high. This is a swing high. We have two candles lower next to this middle candle here. Then we'll be looking for price to go above this swing high if we are expecting to see a bearish breaker. As you can see here, price went above, did a stop hunt. Okay, so this is our third rule to identify a correct breaker. Our fourth rule is candles closing its body below or above breaker. This is the safest entry with breaker. I will also teach you guys that how to take the safe entries with breaker once I'm talking about the models. I'll also teach you guys how to take aggressive entries, one before price activates a breaker. But this here is our safest entry. If you are new, if you are just like learning about breaker from me for the first time, I'll suggest you to stick with the fourth rule here. So we have a clean swing high. We identified the swing high which formed inside a higher time frame PD area. Then price did a stop hunt. Okay, price formed a new higher high. We are looking for a bearish breaker here. The next thing that we'll be looking for is the price closing a candle's body below this last down close candles here. Okay, so do you guys see how I'm aligning the rules with the chart, with the pattern? First, we'll have to identify the higher time frame PD area. Then price will have to form a clean swing high or low. Low for the bullish breaker, high for the bearish breaker, and we have a clean swing high or low. Then the fourth rule is price will have to close a candle's body below the last down close candle prior to the move up that did the stop hunt. Okay, folks, so as you can see, price did close the candle's body below this last down close candle, and as soon as price opened the next candle, you guys can take an entry. This will be considered as the safest entry with breaker. So this is the complete formation of a breaker. We have other formation. This formation is basically without any fair value gap, without any volume imbalance, order block. This is the actual breaker. If you see it in chart, this is the high probability. Our first this high probability, sorry, I didn't mention about it. So we'll be looking for this high probability setup to form on lower time frame. Okay, we'll identify the higher time frame PD area from where price will reject. Then we'll be dropping down to 3-minute or 1-minute time frame, and we'll be looking for price to have this formation or patterns on 1 or 3-minute time frame. The higher time frame can be 15-minute, hourly, and 4-hour chart. I'll talk about these higher time frames later, but that's it. We'll be looking for setups to form inside 1 or 3 minutes. I'm not teaching you guys to take entries on higher time frame, rather I'm training you as a scalper as I am. Okay, so we are looking for these patterns to scalp, not on higher time frame. This same pattern is applicable on higher time frame, which will be included in our later topics, but for now we are looking for scalping models. So our first rule is that we'll have to have a target, most important part of the business. Okay, first we identified the higher time frame PD area, price rejected from there. We dropped down to the lower time frame. We identified a swing high, price did a stop hunt, then price closed the candle's body below the breaker. Everything is done so far, but we still have the most important part left for our breaker to become high probability. Okay, folks, and this is the target. So where can you find the target? Target can be found on higher time frame. Even if you are executing on lower time frame, your target can be from the higher time frame. Okay, folks, what are the targets can be? If you are a scalper, then easy low hanging fruits can be found on lower time frame. So I'm teaching you guys how to trade, how to scalp on lower time frame. So we'll be looking for our low hanging fruit targets that price can easily meet, like in 5 or 10 minutes max you will be done trading, and that's what I refer to as low hanging fruit, which can be found on lower time frame. Specifically on higher time frame, we'll be looking for long term targets. When we are holding our trades, folks, we'll be targeting higher time frame targets. When we are scalping, we'll be focusing on lower time frame targets. So what are the targets? The best targets are unfilled fair value gaps, unbeatable. If you see a fair value gap that is unfilled, which is below our bearish breaker, then we can target their unfilled fair value gap in it feels like it never fails. In my eyes, I found that if I identify the correct setup with high probability formation and there's an unfilled fair value gap, then price is going there, and that's what I know. The second high probability target is a BPR, and that BPR specifically will have to be unfilled. Okay, folks, the BPR, if price already used the BPR, okay, I'll talk about the BPR, like how to identify unfilled BPR and then a filled BPR. Unfilled BPR is our highest probability target. So once we identify a high probability unfilled BPR, we'll target that, and easily price will provide us minimum with each of these target, folks. That's the magic. Okay, that's the magic of looking at price with time, with certain rules. That minimum the setup that your price will provide is 2R. Each of the targets, I'll teach you guys how to get 2R from trades by having early entries, by having safe entries, aggressive entries. Each of the time you are getting 2R. Less than that, we are not talking about it. Okay, our third most important target is a relative equal high or low. This is the highest probability after unfilled fair value gap and BPR. And then the last one that we'll be targeting is unfilled new week opening gap and new day opening gap. So this topic will be separated from our today's topic. I'll talk about this in later in another day, how to target unfilled new week opening gap or new day opening gap, or how to use these to identify a high probability breaker. Okay, folks, so these are the 5 things that we'll be looking at price to identify a high probability breaker. I hope every one of you understood it. We'll have a lot more examples coming very soon. So I'll suggest you guys to take a screenshot, and in between this time I'll go and drink some water, and I'll come back and answer your questions. Okay, so I'm back, and you guys are asking, how about candle without wick? We will talk about it in our coming lectures. Should I consider swing high or swing low without wick? Basically not. Okay, what I'm sharing here is price is having candles with wicks, and that's the high probability. If you are finding a setup that formed without a wick, which I'll consider as a low probability, but most of the time, folks, without wick you will see it less. With wick you will see it most of the time. Okay, if price is hitting the higher time frame PD area, then that's the time you are looking for this setup in 1 minute. The golden boy asked, yes. Once price hits the higher time frame PD area, I'm dropping down to 1 minute, and I'm waiting for my macros to start the time periods that I shared with you all. I'm expecting to see price hitting the higher time frame PD area, which will be at premium or discount. Okay, folks, so you will have to have a general idea of what a premium and discount PD area. Okay, I'll not be talking about that here, but once you identify that, like the premium or discount PD area from where price can potentially reverse, you will be dropping down to 1 minute chart. You will wait for time. We will wait for price to get inside the macros that I shared, the rules. If price is trading inside a so manipulation macro, inside that higher time frame PD area, you will expect to see price changing its trend. If price is trading inside that higher time frame PD area in a trend continuation macro, then you will not expect to see price reversing from that PD area, rather continuing its trend or using that higher time frame PD area on lower time frame as support, which I will teach you guys how to do that. Is stop loss above the breaker or swing high? I'll talk about that very soon. Is the Judah swing part of the breaker? The Judah swing is not part of the breaker, and we do not call it as a Judah swing, rather a manipulation price lag. Okay, I know you were talking about this one. This is not included with breaker, but we can also take entries using this manipulation lag. Okay, this will be included in our Reaper fair value gap, Reaper breaker lecture. This is advanced theory, folks. What I'm sharing with you here is the safest entry that you guys can take. If you are very new, I will suggest you just to watch my advanced lecture that I'll be sharing here after a couple of hours. Okay, folks, because these are the safe entry lectures will take some time. So once I'm done with that, I'll be sharing about the advanced lectures, like how can you take early entries using manipulation, bet lag, then the breaker itself. There will be setup that will form here in this price leg. So you can also use this price leg to take early entries using breaker. But if you are very new, I'll suggest you, I highly recommend you to stick with these rules and follow these rules until you are seeing the breaker forming often. Okay, folks, so move on to our next topic, which is also about the breaker. We'll see like how it forms in actual chart. So putting it all together, this is our swing high that we identified. The next rule is the price will have to have a stop hunt, right? Price did a stop hunt. We have a swing high here, then we have a new swing high here. Price did a stop hunt. Now next, what we will expect to see price going below this down close candle and closing a candle's body below here. And as you can see, we identified these down close candles as our upcoming breaker. We will not be doing anything right now. Okay, folks, we will wait for price to go below, close a candle's body below here, and that's when we have a complete breaker. So this is the whole breaker formation, and I identified is the safest entry with the breaker. So now I'll be talking about the entries with the models, with the patterns that I shared with you all here. A regular breaker generates two type of entries. So what are these entries? Okay, folks, after price closes a candle's body below the breaker, at the next candle you can execute. This is gonna be considered as an advanced entry, because the safest entry is when price is retracing back to the breaker after some time. So the second entry the price will generate with a breaker setup is price retesting the breaker. Okay, so I'll show you guys the examples here. The second one, I consider it as a safe entry because when I started looking for breaker very first, when I was a beginner, executing at the very next candle once price activates the breaker was very hard for me. It took, I believe, like minimum 3 to 4 months for me to take the advanced entry. I was sticking with the safe entry. Okay, folks, so what will be the formation? For the first formation, we'll be looking for this type of formation. Price closed the candle's body below the breaker. Now we'll be looking for what? We'll be looking for price to generate a new candle that will open lower below these down close candles. Okay, folks, and as you can see, price closed the candle's body below the breaker, and at the next candle price went up. As you can see the wick, okay, folks, here price went up. So as soon as price was going up and retesting this breaker, it will execute, and this is what I'm considering as an advanced entry. A lot of folks who are new here don't expect to from yourself that you will be able to take this type of entry as ASAP. It will take time for you to see these type of entries, but this is one of the highest probability entry that will give you more profits because you are executing early. Today, folks, I shared an execution with you all on my Telegram, public Telegram, by using 950 to 1010 macro. If you guys go there and zoom in a little bit, you will see I use the same exact logic there to execute. Okay, so this pattern repeats most of the time, and this is our second formation. Like once price closes a candle's body below the breaker, you will execute at the second candle. Okay, but if you are not getting the chance of execution, you will wait for price to retrace back to the breaker and then going down. Okay, folks, like this here, price is going down, price went down, then price came back up, retested this breaker, and then it's going down again. So this formation, I consider it as a low probability. Okay, folks, why? Because once price is coming back up, what it's doing is that it's most of the time is done providing liquidity towards the sell side. So the safest entry here is the aggressive entry, okay, to execute when price is closing a candle's body below, and at the next candle when price is coming up, when this candle is bullish, okay. This candle was bullish when price was retesting this bearish breaker. So as soon as price is entering inside this candles zone, okay, we are not measuring it from the week to week, rather we are looking for price to tap inside the candles body. Why body? Because that's where the liquidity is. Most of the liquidity is there. Okay folks, so this is our first chance of entry, and we'll be focusing in this type of entry. So here is your stop loss with your entries. So the first entry, suppose you didn't miss it, you took it. Second time price came back up, you can execute again with a stop loss above the candle's body of the breaker, not above the week's high. What's the logic behind it? Okay, because if price is going above the mean threshold, okay, you will measure this breaker, and if price is going above the mean threshold, price will not respect this breaker most of the time. So you'll put your stop loss above the candle's body, because this is our last line of defense. Okay, if price is going up, it will be breaking 3 PD arrays, which will be this breaker, this up close candle, last up close candle, and a PD array will be here. So 3 PD arrays. Once 3 PD arrays fails, you should be closing your trade. So this is the safest level to put your stop loss. We'll discuss more about how to put stop loss in different scenarios in our coming lectures, but for this, it is the highest probability, folks. Once price generates a breaker without any other PD area, if you guys look closely, there's no other PD area for you to take entry. Okay, there's no fair value gap right next to the fair breaker. There's only the breaker itself without any PD area. So once price has with no PD area, you will expect to see taking these kind of entries at the second candle, and when price is retracing back to the breaker, you will be expecting to see price going lower or continue its trend, but this is the low probability. You will train yourself to take entries once price closes the body, and at the next candle once price is retesting the breaker. What time frame do you use when you want to enter a breaker? 3 minute and 1 minute. 3, 2, 1. These are the time frames that I look for breakers to form. These setups that I'm showing here, folks, these are the setups I look for to form inside lower time frame. As I told you guys in the beginning of our lecture, what I'll be sharing here with you all today is mainly for scalpers. The same thing works on higher time frame. The same pattern will repeat on higher time frame, but the lower time frame execution is the highest probability here. So Jai is asking if it does not clear a previous stop hunt, but reverses and forms a breaker, is that a low probability entry? So that's a very nice question, Jai. So if price don't have a stop hunt, we will not consider that as a breaker. That will be a mitigation block, and I will also talk about it inside our topic that I shared, SMT and mitigation block. So that will be a low probability setup. There are rules to follow to take entries like that, which I will not talk about here. I will only be talking about the breaker that forms with a clean stop hunt. Without a stop hunt, that's a mitigation block. So if you are having like questions like that, so these are the topics that I'll talk later about, folks. So just be a little bit of patient, and you will see me talking about when price has no stop hunt, how to take entries on that. Any London macros? Nope. I'm only sharing high probability. What I consider as high probability London session is something that I don't consider as a high probability, rather a very low probability market. On London session, I do not trade on London session, so everything that I'm sharing here is applicable to London session, but I'll be focusing on my lectures for New York session. So Amir is asking, where should price close the candle's body? Below the wick or the candle's body? below the wick Amir. So we have the wick here, and as you can see, price closed the candle's body below the wick. If price is closing a candle's body below this candle's body right here, below this last down close candle, we will not be using this as an entry. Rather, we will wait for price to go below the breaker, and at the next candle we will execute. Okay, so on Burson S is asking, this breaker is forming before macro or after macro or inside macro. This breaker can form before macro. Okay, so if price is forming this breaker if price is forming this breaker before our macros, then you will see price closing a candle's body inside our macro. That's the must rule. Okay, price will do it. Not 100% of the time, but with a high probability, you will see either price closing, activating a breaker inside macro, or inside macro it forming a breaker. If price forms a breaker outside of macro, then it will activate the breaker inside the macro. If there's no breaker inside our macro, will not look for any trade. If price didn't form any breaker before macro, we'll expect to see price forming macros inside our breaker inside our macros. I hope it's clear. Yes, the ideal target is 221. This is the ideal target, but I'll teach you guys how to target more in coming topics. So we'll move on. So tips on the breaker. Okay, I showed you guys the formation of the actual breaker. Now I'll share one tip that makes the breaker high probability. Best reaction from a breaker will happen from the last up close or down close candle. Okay, here as you can see, I wrote not candles. Okay, from one specific last down or up close candle. Up close candle is we will consider the up close candle when we are looking for a bullish breaker to form. We will be considered to look at the down close candle when we are predicting to see a bearish breaker. So here's the example. We have a higher high, a new higher high. Price did a stop on, price closed the candle's body below the breaker. You can execute here. Okay folks, I already showed you guys how to execute here, and then once price retraces back to the breaker, you guys can take another entry here targeting this low. Okay, but the best reaction from the breaker will be happening from the last down close candle. All of these candles are our breaker, and we'll be putting our stop loss above here, not above here, but because we don't know if price wanna do a little bit of deeper premium retracement. Okay, if price is coming back up and just sitting here, we are also safe. That's the reason we'll be putting our stop loss above the breaker, not here, but we'll be expecting to see the best price rejecting from the last down close candle. If it's a bullish scenario, then it will be from the last up close candle, vice versa of this thing. Last down close candle best for expecting low resistance liquidity run. So if price is supposed not closing a candle's body above the last down close candle, we will expect to see low resistance liquidity run. That means what? Price hitting our TP aggressively. As you can see here, we have a very low resistance liquidity run, best for aggressive delivery. If price is rejecting, if price is getting resistance from the last down close candle, this means we are in a high probability scenario, and price will deliver liquidity with speed, and this delivery will consider it as aggressive delivery. Sometimes you will see our mentor sharing executions, and there he is referring like I want to see speed now. So this is the time when you expect to see speed in price. Once price is going up, hitting the breaker and then rejecting, that's the time period we expect to see speed. If this exact formation is happening in price, folks, and trust me, you will see the same exact thing forming here. Nothing like changed or anything. Okay, if price has no other PDRA here or here, this is the reaction that you are expecting. This is the highest probability breaker here. So I hope you guys understood. Do you guys have any question regarding what I'm sharing here? Please don't ask like the questions that I'll answer later. What I'm sharing with you here, ask the questions based on these topics, because most of the questions that you guys are asking will be answered in our future topics. uh Esteban is asking, HYDRA, so we have to wait for a candle to close below the wick of the last candle of breaker block. Yes, this is the last candle, and we'll expect to see price closing a candle's body below the breaker, and at the next candle we'll be able to execute here as I showed you guys in the previous templates. And if you miss taking entry here, this is the highest probability entry. This right here is a low probability entry, okay? But if you miss it, and if you saw like price rejecting from the last down close candle, you can execute either at this candle or at this candle, because as you can see price still is going lower. And if price is not closing, listen carefully folks, if price is not closing a candle's body below the above the last down close candle, price will deliver with high volatility. That means what? Price will move a lot. So this becomes our highest probability trade once price creates this type of formation. Now we'll move on to our next scenario, next topic, which will be breaker plus fair value gap. So far I showed you guys that how to look for a breaker when breaker has no PD array next to it. Now I'll be sharing with you all when breaker has a PD array right next to it, and this PD array is fair value gap, and we'll be looking for this fair value gap to form at the discount leg of the breaker. So as I told you guys that a breaker with fair value gap has two types of formation. A fair value gap will either form in the premium or in the discount PD array. And the second formation is that price will have two fair value gaps with the breaker. Okay, so I'll be sharing the examples with deep details here. Now we'll be talking about fair value gap with breaker at discount. This is the highest probability among each of these formation. This is the highest probability. So this is the pattern that we'll be looking for. Okay folks, I'm sharing a pattern here. I'll share the actual chart later once I'm done with explaining the formation. So we have a higher high here, then we have a new higher high. So we expect to see what? Price forming a clean swing high here, then price going above, clear, doing a stop hunt, right? Or a Judas swing if you guys want to mention it like this, and then price coming down here before price goes below the breaker or close a candle's body below the breaker. We'll look for a fair value gap forming here. Okay, exactly here. So here this will be our last down close candle, and this will be our breaker. Here we'll look to see a fair value gap forming right next to the breaker, and this is at the discount leg. Okay, later I'll show you guys that a fair value gap that will form here at the premium side of the curve, but now I'll be sharing with you all the fair value gap that is forming here at the discount leg, which is the highest probability when price is coming with a breaker and a fair value gap. So once price does generates a breaker, you will expect to see price doing an immediate rebalance. Okay, just like I showed you guys before. Let me take you guys a little bit back. What do you guys see here? Okay, price closed the candle's body below, then price at the next candle came back up, then it went down. So when price is doing these kind of things, I refer to it as an immediate rebalance. Once price does that, it's the strongest sign from price that it wanna continue its trend towards sell side liquidity, or you are right predicting the breaker. So you'll be expecting to see the same formation happening here. price closing a candle's body below the fair value gap, then coming back up, retesting the fair value gap immediately, and then rejecting towards the buy side, sorry, sell side liquidity, as is a bearish formation. Okay, and the another rule that we'll be following here is that price should not go above or close a candle's body above the fair value gap. If price is closing its candle's body above this fair value gap, which I'll be showing you guys later in the chart, we'll put our stop loss here, so we are safe. But if price is going above the fair value gap and closing a candle's body above it, know that you are wrong predicting the setup. I'll suggest you to close the trade rather than hoping as soon as price does closes a candle's body above the fair value gap. Price can go above, have a week, okay, above the fair value gap, but the bodies of the candles should stay inside the fair value gap. Fair value gap here specifically forming a discount according to the dealing range inside the breaker. So what is the dealing range? From this high to this low, this fair value gap is coming at discount, right? And this is the highest probability. Once price forms a fair value gap premium, this becomes a low probability setup, but that setup also works. This here is our highest probability setup that price forms with a fair value gap. And I already shared with you all like how to identify a high probability breaker. We have every rule matching here. Price has a swing high, price did a stop hunt, price has last down close candles here, price went below, generated a fair value gap, retested the fair value gap, and now going lower. One of the highest probability breaker here, folks. This is one of the highest probability formation. So our next pattern that I'll share with you all is price forming a fair value gap at premium. Price also forms fair value gap with breaker at premium, and the template will be like this below. The fair value gap that we saw last time, it was at the discount range, it was here. Now we are looking at a fair value gap that formed at premium according to the dealing range. What is our dealing range? From this high to this low, this fair value gap is coming here. So what will be the formation? We have our breaker here. First we'll have to identify if we have a clean swing high. Once we identify that, we'll look for price to go above that swing high and do a stop hunt. Then aggressively price should come down, form a fair value gap here, okay folks, and then going down and retracing. So once price has a premium fair value gap, what we are expecting, we are not expecting to see an immediate rebalance. What we are expecting to see is price leaving this fair value gap unfilled, then going down, generating relative equal lows down here, folks. This price leg, we want to see price generating relative equal lows and then coming back up, hitting this fair value gap, and then going down. Listen carefully, folks. What I'm talking here, I'm not saying to you that we want to see immediate rebalance, okay? We don't want to see price retesting this fair value gap immediately, rather leaving this fair value gap unfilled, going down, then coming back up. At the same time, price will have to generate relative equal lows down here. When price is moving up, hitting this, reaching for this fair value gap at premium, we want to see price having relative equal low down here, okay? Specifically, I'm not talking about unfilled fair value gap or anything. Specifically, I'm talking about relative equal lows forming here. So fair value gap and premium, you will expect price to reach there before continuing its trend, okay? Price should leave this fair value gap unfilled, then price should go down, price should generate relative equal lows once it's coming back up. So if price is filling this fair value gap, suppose before going down price generated this fair value gap and is coming back up, doing immediate rebalance. I already talked about what immediate rebalance is. We will not consider it as a high probability entry once price comes back up here, okay folks? While price reaching for the premium fair value gap, you will expect to see price building liquidity as a form of trend line liquidity or equal high or equal low. So there are two types of target that price should generate before reaching here, or once it reaching here, either it should generate a relative equal lows, okay, or a trend line liquidity. Trend line liquidity is also a form of relative equal lows, because when price generates trend line liquidity, price generates swing lows very near to each other. So we'll be expecting to see price forming relative equal lows, and that will make our this fair value gap a high probability fair value gap with breaker. Why? As I answered, this will increase the odds in your favor, means it will be a high probability setup, as we won't target blindly but with high probability targets. Okay, as we are not just targeting, like we are not expecting for price to return continuous trend once it hitting the fair value gap. Rather, we are expecting to see price generating relative equal lows that we can target, okay, and hitting the fair value gap and then coming down. Do you guys remember the fifth rule of our breaker? The fifth rule was we will have to identify a clean target. Okay, before we identify a setup, we will have to identify a clean target, and that's what makes our fair value gap at premium a high probability fair value gap. What we will avoid here, we'll be avoiding a setup that has an immediate rebalance. What we'll be expecting here, we'll be expecting to see price leaving this fair value gap unfilled, going down, coming back up, generating relative equal lows or trend line liquidity, very specific rule folks, and then coming back out down, and these relative equal lows, once we see that price formed, this will make this setup a high probability setup. Now I will show you guys when price will have two fair value gaps at the same lag. Okay, and after that I will take you guys on the actual chart, and we will see how price forms a fair value gap at discount, then premium, and then twin fair value gap. A fair value gap can also form two times in the same price lag with a breaker on it. When price generates two fair value gap in the same price lag, how does it look? I'll be sharing with that here. What is the high probability entry here? So price now has two fair value gaps here, folks. The formation, this is the formation. Okay, folks, before I shared with you all when price forms a fair value gap at discount, now price is forming a fair value gap at premium. Sorry, at price forming both of the fair value gap at the same lag. Okay, and price is forming it like this. I'm showing you just the pattern here, so don't lose your patience. I will share the actual charts, how it will look when price generates two fair value gaps or one fair value gap at premium and discount. I'm just sharing the logic here, which will give you confidence when you look at chart with these patterns, folks. So what's the high probability entry here? When price comes back to the discount fair value gap, it will take your entry. As soon as price hits the body, breaker drop body inside this discount fair value gap, it will execute. Okay, you will have a stop loss above the breaker, okay, above the breaker's wick. This time we are putting our stop loss not above the breaker body, because we have two fair value gaps here. Price can easily come up to fill the fair value gap at premium and then go down. Okay, and how will we know that price will come up to the premium? I shared with you all that if price is generating relative equal lows down here, we will expect to see price reaching for the premium fair value gap. If price has no relative equal lows but a target like far from it, we will expect to see price rejecting from the discount fair value gap, but this is the highest probability scenario. Okay, you can take an entry here once price hits the fair value gap, sorry, the breaker, okay, the candle's body. Once price hits that, you can execute here. You can take another execution here if you see price formed relative equal lows down here, and your stop loss will be above the candle's wick. What's the difference? When price has a fair value gap here, only a fair value gap will put our stop loss above the candle's body. But when price has two fair value gap right next to each other and price has a fair value gap right at premium, will put our stop loss above the candle's wick. I hope it's clear. Please increase your mic. So folks, is my microphone, can you hear me like clear? Please let me know in the chat. Um, Thank you, folks. So if the sound is low for you, I'm not gonna change the settings, folks, because I spent a lot of times to put the perfect settings so that you can hear me loud and clear. And these are the settings that I believe is best for you. Because if I increase the sound, my voice will get distorted. Then it will complain again. So just increase the volume or listen to my lectures in your computer. I hope you will enjoy it. So I hope everything is clear with twin fair value gap, the fair value gap at discount, the fair value gap at premium. Okay, now I will take you guys and show you the actual formation on chart. And before I do that, we still have some things to discuss here. High probability entry here is at the fair value gap at discount. I already shared you guys the fair value gap that is here. We will not wait for price to reach for the premium fair value gap. Price can do that, but we will take our entry as soon as price hits the candle's body here. Okay, at the discount fair value gap, this is the highest probability, but we will leave room for price to go up and fill the premium fair value gap. That's the reason we are putting our stop loss above the wick of this breaker. In other scenarios, we'll put our stop loss above the candle's body, and stop loss must be above the candle's breaker wick. I wrote this because you guys can take the screenshot and later print it out, because there's a lot of slides, folks. When I was making these templates and the slides, I felt like I'm writing a book. So that's the reason I wrote everything even after I'm saying the things here, so that later in future when you review these things, it will be beneficial for you. So you can either take the screenshot, or if you want to get like the high quality, you can purchase these slides from me. So why we are putting our stop loss above here, I already discussed about that, because price can also reach for premium fair value gap. So if it does that, you are safe. And if price is not respecting 3 PD arrays to get rejection, you are wrong anyway. So you will not put your stop loss, folks. Listen carefully, you will not put your stop loss above the swing high here. Why? Because how many PD arrays do we have here? We have a fair value gap. We have a breaker here. That's a fair PD array. We have a fair value gap at discount. That's another PD array. Then we have another fair value gap at premium. That's the third PD array. So if 3 PD arrays are failing together to send price lower, you are wrong anyway. So why put your stop loss here and take a little bit more loss? Why? If you are putting your stop loss here, that's the safest stop loss that you can manage. No, the stop loss is not above the 0.25 of the breaker of the fair value gap, but it is above the candle's wick. I'll show you guys right now. So breaker plus fair value gap, which will be at premium and discount, plus twin fair value gap on chart. First, I will show you guys the breaker that has a fair value gap at the discount. This is our high probability scenario, and that's the price action that we'll be looking at when you are looking at your chart. So we have a swing high here, right? We have another swing high that cleared out liquidity from this swing high. Then price went below these candles, right? It generated a fair value gap here. So it has specific rules, folks. Where should price generate the fair value gap? Right next to the last down close candle. Listen to me carefully if you are missing things out, or you can listen to this again. Everything will be recorded here. This fair value gap should, must, I'm using the word must, it cannot form above the breaker. If it's forming above the last down close candle, that fair value gap is at premium, and we will have different rules. When the fair value gap is forming like this alongside with the last down close candle of this breaker, this is our high probability. So our entry will be as soon as price hitting the fair value gap, as soon as price hitting the fair value gap plus the breaker's body, not the wick. Okay, you can take the execution here once price hits the wick. There's nothing wrong with that, but I'm sharing with you all the high probability scenarios, the scenarios that will put odds in our favor. Okay, we all are gambling here. I cannot guarantee you that 100% of the time price will price will hit your TP with this formation, there's still risk, so we'll have to consider that risk, and that's the reason I'm sharing only the high probability scenarios. The same pattern with this same exact candle will repeat, folks. Same, okay? The size of the candles can be different, but the same thing will repeat. You guys will see it forming in the chart, or if you guys saw me trading in front of you on YouTube, I look for these same things on chart, or if you have experience with breaker, you already saw a price forming the same exact pattern. Okay, folks, the fair value gap will exactly be right next to the last down close candle, and this is the highest probability. And as you can see, price hit the breaker, your entry can be here or at the next candle. If you are patient enough, you can execute here or at the candle that is forming here. It's also coming back up, so price is giving you chance to pyramid here. Okay, folks, these are, if you are very new, I'll suggest you not to take pyramiding entries, but if you have experience, these are the opportunities that price will give you that will help you to generate more profits. Now I'll be looking for the candles that will form in the premium. So this is the pattern that we'll be looking at when price has a fair value gap at a premium. Okay, folks, so here, as you can see, we have a fair value gap which is inside the breaker. So the rule is price will have to form this fair value gap inside the breaker. The fair value gap cannot be above the breaker. If price is forming this fair value gap above the breaker, suppose price has a little bit more candles here, 1 or 2 candles, and the fair value gap is coming here at this level, we will not take this trade from this fair value gap. Rather, we will take this trade as soon as price closes the candle's body below. Okay, folks, here as you can see, we have this fair value gap inside the breaker. Price went down, right? We expect to see price coming back up, and when it's coming back up, what we expect to see, price generating relative equal lows. Okay, and what do you see here? Once price was coming back up, it was generating relative equal lows right here. Okay, so first let's read the tips here. When price is reaching for fair value gap at a premium, expect the delivery in high resistance liquidity run and reversal in low resistance liquidity run. So the low resistance will create the high probability for us. Here, as you can see, price is having a high resistance liquidity run. Okay, why is it a high resistance liquidity run? Because we know that price is reaching there, okay, reaching for this fair value gap, but at the same time we want to see price generating relative equal lows. When price is having low resistance liquidity run, it won't generate relative equal lows or highs. When price is having high resistance liquidity run like this, when it's struggling to reach a pre-DRA and is generating a lot more candles, we consider it as a high resistance liquidity run, folks. And when price does that, it generates high probability target, and that's the reason we'll expect to see price having high resistance liquidity run once it's reaching for the fair value gap at premium. Okay, folks, these are the rules that I shared with you all when I was talking about the pattern. We'll be looking for price to have this exact scenario. Okay, the wicks can be lower, a little bit lower or higher, the candle's body can be a little bit bigger or suppose smaller, but this is the formation that we'll be looking in chart. Okay, this is the same formation that we'll be looking once price does a stop hunt inside a higher time frame PDRA. Once you were able to identify that, it will be dropping down to 3-minute and 1-minute chart, and you will look for this formation. You don't know what formation that price will have. Okay, price can have no fair value gap. So if price has no fair value gap, we'll look for another setup. I shared with you that. Okay, we have other rules. Once price has a fair value gap at discount, we have other rules. Once price has fair value gap at premium, we follow different rules. So we have our high resistance liquidity run here, we have relative equal lows down here, plus trend line liquidity. If you put a trend line here, you will see that price is respecting the trend line liquidity, and that is making our trade a high probability setup. And here, as you can see, price is doing the low resistance liquidity run. Okay, folks, so I hope everything is clear here. Once price is reaching for the fair value gap, we will expect to see price generating relative equal lows, having high resistance liquidity run. Once price hits the fair value gap, we will expect to see price dropping, aggressively clearing out these relative equal lows with low resistance liquidity run. And this is our highest probability scenario. Our entry at this formation will be here, okay, as I shared in the pattern in our previous slides. Our entry will be here. Our stop loss will be above the candles wick. Do you guys remember me talking about putting your stop loss above the candles wick? When will you put the candles stop loss above the candles wick? When price has a fair value gap at premium. When price has a fair value gap at discount, you will put your stop loss above the candles body. When price has a fair value gap at premium, you will put your stop loss above the candles wick. Okay, these are the very basic knowledge. I'll take you guys in the advanced knowledge very soon, but first you will have to know what price does when it's forming this type of repetitive formation. The third formation is twin fair value gap and breaker, and how it looks in the actual chart. This is how it looks in the actual chart. So we have our breaker here, we have our clean swing high that formed inside the higher time frame PD area. Then price did the stop hunt with clean swing high, folks, right? And then price came down, generated a fair value gap here plus another fair value gap at discount. So when price does that, you will look for price to do the same exact thing that it did here, but rather your entry this time will be here, okay? Because sometimes I saw price rejecting from here, sometimes I saw price reaching for the premium fair value gap and rejecting immediately. There are rules. Price will have to form relative equal lows when it has two fair value gaps, when it has fair value gap at premium. This rule is different when price has fair value gap at discount. We will not be looking for price to have relative equal lows, but if price is generating relative equal lows, that making our trade high probability. If not, we are expecting to see immediate rebalance. Okay, immediate rebalance is like this: price coming back up with a little retracement here. As you can see, price having a long retracement, price went down, then coming back up, generating relative equal lows, and we expect to see price forming relative equal lows when price has either fair value gap at premium or two fair value gaps like this. So this time we are going to be putting our stop loss above the swing high, okay, here above the breaker swing high, not this swing. I hope it's clear, because if price is going above this fair value gap, this breaker, and this fair value gap which is at premium, price is not respecting three PD arrays at the same time. So when price is failing to respect three PD arrays, that becomes a low probability setup. We will not take this setup anyway. We will not hope for price to hit our TP, rather we'll close our trade, and that's the reason we are putting our stop loss above this candles wick. So the tip is here, the high probability here is price rejecting from fair value gap at discount, but we leave room for price reaching higher. So this is the end of our this slide, this formation. This is the same thing price does, and these are the same pattern that you will be looking for. Nothing more, nothing less. You will be looking for this same exact pattern. Okay, folks, like when you go to sleep, before you go to sleep, look at these patterns. These are the same patterns that price will repeat, exactly same. The only difference can be is just a little bit bigger wick, a long wick, or a little bit bigger candle. That's the only difference. Price will have the same high resistance liquidity around. Price will form relative equal lows just like this, and that's what makes our setup a high probability setup. If you guys have any question, feel free to ask me here. MCO is asking what to do if price forms a bullish fair value gap while retracing for the premium fair value gap. We will not look for buy from that bullish fair value gap, okay? Rather we will look for price to reject from the premium fair value gap. I share some specific things, folks. I'm saying again, listen carefully. We are not looking for any entries here. Once price is retracing higher, we are not looking for any entries. Rather, we are looking for price to form relative equal lows here. If you look a little bit closer, you can see we have a fair value gap here that price respected, but we are not taking it as an entry. Rather, we are waiting for a high probability entry that price will generate once it hits the premium fair value gap. So Hamid is asking how many time you take trades if the first setup failed and later another breaker formed in the same higher time frame fair value gap. Price will only form this type of setup once, but if price is forming different types of setup, different type of breakers at the same inside the same higher time frame PD area, we will consider it as a time distortion. I told you guys to wait. Okay, you guys are asking questions early. Every question, every type of question that you can think of, I already thought about it. Okay, how do you think I am making profit with this setup? I had the same exact question in my mind, and I looked in chart and I found the answer, and I'll be sharing the answer with you all in later chart. So when price forms many breakers, okay, inside a inside a higher time frame PD array, that time we will look for price to go inside our macro. Okay, each of the setup that we are looking for, each of the formation that I shared here is we are looking for a setup to form inside the macro. Okay, we are expecting to see price hitting this fair value gap inside macro, inside macro here. Price can form this setup before the macro, but the execution or price will tap inside the fair value gap will be exactly inside the 20-minute interval that I shared with you all. Okay, so if price is going inside that time period and hitting the fair value gap inside macro, you won't hesitate. You execute, and after that, if price is forming another breaker, or suppose your breaker failed, you do not execute. You wait for another macro to show up, and that's the time you execute. And I'll be talking about these things later in later topics. Do you explain your view about the difference between LR and HRLR? I have the different view. What the view that I have, I already shared here. Go back and listen carefully. I hope you will understand. So the third formation that we'll be looking here is breaker plus inversion. Okay, Rahul is asking on the example 2, we could take entry after price closes below the breaker and reaches it again. What did I say, Rahul? Did I talk about price coming back, taking aggressive entry? No, I told you guys that we wanna see price coming down, going down, okay, and generating relative equal lows. Very specific things, folks. I'm not sharing a lot of things here. We want to see price forming relative equal lows here. If price do not form a relative equal lows, we are not taking this trade because we do not have high probability targets. We will wait. If price is coming back up, if price is not coming back up and retesting the fair value gap at the same time doing a immediate retest, then we will not take this trade. It's simple as that. This is the high probability scenario that I'm sharing. The scenarios that you are referring to me is not high probability scenario. At that time, you will not take it as an entry. You will only take entry once price do this. Once price generates relative equal lows, okay, you will take the entry. So I'll be moving forward to our next lecture. So Jai is saying in HRLR price is moving against a huge expansion without any swing high or swing low. In case of low resistance liquidity around price clear, swing high or swing low where there is liquidity. The way you are saying, Jai, I do not see high resistance and low resistance equity like this. A lecture on high resistance and low resistance equity will be inside the topic of time distortion. There I'll talk a little bit more about when we expect high resistance and low resistance equity run. Okay, we can predict when price will have high resistance and low resistance equity run, and price can also have a candles week and have a high resistance equity run. There's no rules such as this, so I'll clear that in our future topics, Jai. So our next topic is breaker plus inversion, a new opportunity. Why is it a new opportunity? Once a fair value gap fails, we consider that failed fair value gap as an inversion to look for new setups. So even that fair value gap failed, it will still create opportunity for us. So a failed fair value gap is equal to inversion, generates two types of setup with breaker. Breaker plus inversion generates two type of formation. What are these formations? Inversion at manipulation lag. What is the manipulation lag? The lag that does the stop hunt. The second one is inversion at reaper, which will be included on our reaper lecture. So the first formation that we'll be looking at is inversion at manipulation lag. We'll be focusing here at the price leg that did the stop hunt. Okay, folks. So what is the lag here? We have this higher high here, then price went down, generated the breaker, okay, and then price came up, cleared out the swing high here. This is the leg that we'll be focusing. We will be focused inside this price leg here. So far I shared with you all that how to take entries from this leg here, right? If I take you guys a little bit back, so far I shared with you all that how to take entries at this leg of the price using breaker. Now I'll share with you all that how to take entries using the manipulation leg, because there's also PDRA forms. Okay, so we will focus inside here for price to form a inversion. We'll focus here for price to form a fair value gap. Later in time, when price is coming down here, price is going below the breaker, we will use that failed fair value gap to take entries. Our high probability inversion will form near to the swing low of bearish breaker. Okay, our high probability inversion will form here, right, exactly here, near to the bearish breaker. So this is the formation in actual chart. As you can see, we have a clean swing high here, price went above, and when price was going up, it formed a fair value gap here. So this fair value gap here is important, folks. It will give you insights on like if price wanna use this breaker to continue its trend towards downside, or if price don't wanna use this breaker to continue its trend, you will get support from this fair value gap. But what we are looking here is for this is that we are expecting to see this fair value gap getting failed, price closing a contest body below this fair value gap, doing immediate rebalance here, and then retracing lower. So the two types of fair value gap that form, the first type is that the fair value gap will form at the manipulation lag. The second type of formation is that price will form the fair value gap here at this here near to the swing high of the bullish breaker, and I talked about this in our previous lectures. So inversion and manipulation lag. Now I'll take you guys deep inside what to look for, what to expect here. How will I know this inversion will support my trade idea? That's a very nice question, folks, right? Because that's a bullish fair value gap, that's a busy buy side imbalance, sell side inefficiency. So how will you know the price will not respect it as a bullish fair value gap, rather that fair value gap will fail and turn into inversion? So here are our rules. Price will have to generate the inversion near to the swing high or low. Price will have to go through this inversion with speed. price will have to generate a new fair value gap alongside with the inversion from the manipulation lag. So now here I'm showing you guys a example on a bullish fair value gap. As you can see, we have a low here, we have a lower low here. These swings are very clean, and we are expecting to see a bullish fair value gap, sorry, a bullish breaker forming. Okay, so where is our breaker here? Last up close candles. These are the last up close candle which we'll be considering as a breaker, and a fair value gap formed right next to this breaker, inside this breaker. So the rule is, folks, price will have to generate a fair value gap inside the breaker. Suppose if there's 2 or 3 more candles and price is generating fair value gap here, we will not consider that fair value gap to take it as an entry, rather we'll focus on this breaker. But if the fair value gap is forming inside the breaker right here, right, we will look for some formation like this. We will expect to see price going up inside, price closing a candle's body above this inversion. So once price does that, we will know the price wanna continue its trend towards buy side. It wanna respect this bullish breaker. That's how you will know that price wanna continue its trend towards buy side. Once price closes a candle's body above the inversion, okay, above this fair value gap. If price is not closing a candle's body above this inversion, or suppose price is having a candle here but the wick are reaching up there, you will not take it as an entry. Price will have to must close a candle's body above the inversion, and that's the time when our high probability scenario generates. So as you can see, it's this candle is following our rules. Our second rule is price will have to go through this fair value gap with speed, and as you can see, price did that. Price generated a new fair value gap with inversion. Okay, price also generated a fair value gap here, which you will see coming later. So how will we manage our stop loss and entry with this inversion? There are 2 entries we can take with inversion inside breaker. Once price closes a candle's body above or below inversion, you can execute at the second candle, just like I showed you guys at the actual breaker what we will do. So we have our pattern here of bullish breaker. We have a lower low, new lower low. So these up close candles are becoming our breaker here. We have a fair value gap here that later turned into inversion. This price pattern is following our rules. We want to see price closing a candle's body above. Price did that. We want to see price going through this fair value gap with speed. Price did that. Okay. Next we want to see a fair value gap forming here alongside with the inversion, and as you can see, so the fair value gap that I talked about, this fair value gap here can also form or it can't. Okay, if price forms that fair value gap, we will expect to see price stepping inside the fair value gap here, and there will be your entry like this. Okay, we are executing at this candle and at this candle. As soon as price is coming down, retesting this inversion fair value gap, we are executing here. After price closed the candle's body above the inversion, we are executing at this level. From the inversion, that is at manipulation lag or at the Judas lag. Okay folks, I hope it's clear. It's very simple. We have 3 rules to follow. Once we identify a fair value gap at the manipulation lag, we'll expect to see price coming back up. Okay, there are other rules. Price will have to do stop hunt. We already discussed about those things, so if you missed it or you join later, you can go back and watch it again. So once price does close the candle's body above, we'll look for speed. That if price closed the candle's body above here with speed, it did that. Then as soon as price generates the second candle, it comes down, retest the inversion here, we'll execute. Where will be our stop loss? After price closes the candle's body above inversion, we wait for price to retest the inversion at the next candle, and that's when the high probability signal comes. As soon as price is retesting this fair value gap, you are inversion, you are executing here the second candle. If price is giving you opportunity to retest and it comes back inside this inversion, you are executing again. We buy at the bearish candle when price is trading inside inversion and breaker. So here, as you can see, price didn't close the candle's body above the breaker, right? Sorry, price did close the candle body above the breaker, plus price is retracing lower. So once this candle was black, okay, when this candle was bearish, we buy. We are not buying in any bullish candle, folks. If you are buying here, your risk will be a lot more than what price can offer when it's trading inside this inversion. So once price is trading inside this inversion, we'll be looking for buy when this candle is black. When this candle opened here and came down, we'll be looking for to execute. So our stop loss management here, we'll look for, we'll see where we will put our stop loss. So this is the whole formation. As you can see, once price stepped inside the inversion, we saw speed, and that's what we expect to see from price. Where will be our stop loss? So here our stop loss will be a little bit different from what I already shared with you all. We will have our stop loss below the fair value gap, right next to the fair value gap. The next candle that price generates after generating the fair value gap, we will put our stop loss below this candle's low. These rules are very specific, folks. Don't put your stop loss here. Okay, you can do that if you are willing to risk more, but if price is going below the last candle before price formed before price formed a fair value gap, if price is going below this candle, then you are wrong anyway. You should close your trade, and that's the reason we'll be putting our stop loss at the next candle after price generates this fair value gap. Hamid, you are asking the questions that I already answered. How will you know that it's a breaker? For price to generate a breaker, it will have to follow some rules. What are the rules? Price will have to form the breaker inside a higher time frame PD area. So imagine there's a higher time frame PD area. Then price will have to have clean swing lows for bullish breaker. We have a clean swing low here. Then price will have to do a stop hunt. Price did a stop hunt. So when price did all these three things, we are expecting to see these up close candles becoming and performing as a breaker. Okay, and how will you know that this will actually work as a breaker? We have a fair value gap here, right? So price is going up. As soon as price closes the candle's body above the inversion, is activating the breaker as well. No need for price to go above the breaker and close the candle's body, because as soon as price does closes the candle's body above the inversion, is activating the breaker as well, plus the inversion as well. We don't want to see price going below the breaker, the inversion. Price can have its wick below the inversion, but the body should stay inside the inversion. Okay, Hamid, I hope it's clear. How do we know that this is a breaker? Because price did a stop hunt inside a higher time frame PD area, price has clean swing lows. Okay, and plus, if you are still confused, I told you guys that this type of execution is advanced level of execution. If you are very new, okay, if you are very new, I'll suggest you to stick with the first formation that I shared with you all, the actual breaker formation. Stick with that, and with time, trust me folks, you will see this type of setup repeating, but you will have to give yourself time to improve. You will not, trust me, you will not see it tomorrow forming in price. Okay, even if you see it, you won't be able to execute because you will hesitate. The hesitation will be there. You need to train your eye to see it. Okay, what I'm sharing you here, these are the same exact formation that price will have on chart. Okay, exactly the same. The only difference will be, like, suppose this candle will be a little bit bigger, or this candle will be a little bit bigger, or we'll have a bit higher wicks. That's the only difference. That same exact thing will price repeat. So our stop loss will be below the second candle after the fair value gap got generated. Later we will expect to see it turn into inversion. So I talked about how will you know that price is activating this inversion. Price will have to close the candle's body above. Go back to the previous slide and you will see me explaining the rules. Price will have to close the candle's body above this fair value gap with speed, with forming a PD area. Suppose a fair value gap is here, or without a fair value gap. If the fair value gap is not here, then we can expect to see price retesting the inversion. But if we have a fair value gap here, we will take in execution inside this fair value gap, and our stop loss will be below here even on that case. So these are the very exact things, folks, that repeats inside time. Okay, it repeats inside the specific time periods that I shared with you all. This setup, you will look for this setup to form when inside the manipulation macro, so you know the time when you will be looking for this type of setup forming, because price is doing what? It's changing a trend here, right? Price is going above a inversion. Suppose price is continuing a bearish market maker, price is having a market maker sell model here. So once price generates a formation like this with a fair value gap, you will expect to see price continue its trend higher and have a market structure shift. Once price closes a candle's body above the inversion alongside with the breaker, it's activating the breaker plus the inversion plus it's having the market structure shift. So it's doing a couple of things. That's the reason I'm marking these type of levels as advanced levels. I'm not guaranteeing you that tomorrow you will see the same pattern in your chart and you will be able to execute, but rather with time you will be able to see the same pattern repeating in your own chart. So let's move on to our next lecture. When price retests the inversion, okay, what we looked at here before is that price is doing immediate rebalance. Okay, the retest was very small. In the next slide I'll show you guys when price is having like deeper retracement. Okay, just like I showed you guys in the previous slides, this here is a immediate rebalance because we are looking to buy as soon as this candle is going lower and hitting the inversion here. I'm explaining again and again, folks. I hope it's getting clear to you. When price is trading inside this inversion at this candle and this candle, we are expecting to buy. Okay, we are not looking for like a deeper retracement, like price is going up and then coming back up. No, we are not doing that. We will be looking for this scenario here. When price retests the inversion, this is the scenario that a price will be doing. Okay, so what's the scenario here? Before I talk about it, I'll pause the stream for 1 minute. I'll go and make a coffee, and before so when I'm making the coffee, look here and put your own logic that I shared here. There's specific logic why you will expect to see price retracing lower. Okay, do you guys see any difference here? So what's the difference here, folks? Did you guys identify it? This here price didn't came back inside the inversion, so we are only executing with our previous model that I shared with you all when price is retesting this inversion, right? But here, as you can see, price didn't retest this inversion, and rather it left this inversion unfilled. Alongside, it generated a new fair value gap here, which makes it a BPR, but we'll consider it as an inversion as we are looking at the topic of inversion and fair value gap. Okay, so we will expect to see price retracing deeper because of this. When price leaves this fair value gap unfilled, or sorry, this inversion unfilled, we expect to see price going higher, hitting a premium PDRA, then retracing lower. And once price retraces lower, that's the time when we will execute at this candle, and at this candle price will generate a fair value gap here. At the same pattern will repeat, folks. The same exact thing that I'm showing you here, same exactly it will repeat. Okay, so the logic behind we are expecting a deeper retracement now is because of the unfilled fair value gap here. Price left the inversion unfilled, and we need a balanced delivery here before pushing up. Okay, before expecting higher prices, we want to see price coming back down here. So anywhere here you are not buying, anywhere here you are not selling, you are waiting for price to come down, hit the fair value gaps, hit the inversion here, and then moving higher. When is this applicable? It's only applicable when price is leaving this inversion unfilled. If price is not leaving this inversion unfilled and price is coming lower, trading inside this inversion, we will look for the previous scenarios that I shared with you all. So as you can see here, price balanced the zone. Now we can expect higher prices with these two down close candles. Price did a deeper retracement, price stepped inside our inversion, right, and then price generated a fair value gap here. So here's another logic, folks, that I will share with you all. When price generates these two down close candle, and then the next candle, you expect to see a fair value gap forming here. These are very specific rules. Okay, so write it down because I didn't write it here. When price hits the inversion, the last two down close candle, you want to see price forming a fair value gap right next to these two down close candle. Okay, so the rule is price will have to come down to hit the inversion. Once it does hit the inversion and shows willingness to go higher, what's the willingness? Okay, price is not closing its candle's body below the inversion. The wick can go lower, it does the damage, it does the manipulation, but the bodies are staying inside the inversion. That's what confirms us that price will go higher. And plus we will use these two down close candle here to predict a new PDRA forming. Okay, we will outline these two down close candle, and we will expect to see price forming a fair value gap here at the next candle. If price forms a fair value gap, you can expect to enter here again, pyramid on your entry. I hope it's clear. Is it clear? So manipulation before macro and entry inside macro, or both can happen inside. Manipulation, we are expecting to see it happening outside macro. Okay, and we are expecting to see low resistance liquidity run, price delivering with high volatility and speed inside macro. Inside macro, we do not expect to see manipulation. If price is doing manipulation, which I consider as high resistance liquidity run, I already showed you the example of high resistance liquidity run. If price is doing that, we are not taking any entries inside macro. Inside macro, price will do low resistance liquidity run, no manipulation, and that's what we expect to see. Okay, Jai, I hope it's clear. And these are very specific rules, folks. Okay, I'm only showing you one example. Why? Because this is the only example that price will repeat. With my 3 years of experience, I have hundreds of execution, breaker execution recording. I already shared a couple of it with you all in the private Telegram group. And if you look carefully, I do the exact same thing. Price repeats the exact same pattern, each same each buy candle. Okay, so the rule was, I shared another tip with you all. I'll be talking about this tip again. Once price hit the inversion, the last two down close candle, you will mark it. You will expect to see price forming a fair value gap right next to the last down close candle once it going higher. How will you know the price will go higher? because price is not closing a candle's body below the inversion. Okay, we can go lower, but the body should stay inside the inversion. If the body is staying inside the inversion, that's confirming you that price wanna go higher. After that, we want to see a fair value gap forming here. Okay, at the very next candle, not like the third candle or fourth candle, we are not counting the candles here, but the rules are very specific. We are looking for a fair value gap to form inside here. I hope everything's clear here, folks. We'll be moving to our next slide very soon. Now we'll be looking at breaker plus order block. Here I'll share some topic that I know that you don't know about. So breaker and order block, this formation is also a very high probability formation. Okay, before I shared with you a actual breaker, then a breaker with fair value gap. Fair value gap can form in premium, discount. Fair value gap can form like 2 times in the same price leg. Then the fair value gap can form also in the manipulation leg, and that's what we consider as an inversion. So we already talked about 3 types of high probability setup with breaker. Now we'll be talking about breaker and order block. Okay, so Brian Ho is saying there are some folks in the channel that paid but didn't receive the link. HYDRA, they've been DMing me for it. Okay, so some folks paid now, I believe. Yeah, because I was talking with you all here, so I didn't look at the chat emails, but hey, I'll be replying to the emails now. Okay, so 6 folks just like sent me the money to get enrolled in the course. I don't know like why they took so much time. So I replied to them, Brianna, then Jonathan, then Kayan, Ben. So all of you paid today, and just like before I started my stream, that's the reason I didn't see it. I'm sorry for that, but I shared the link of the stream with you all right now. And if you missed the stream, the first part of the stream, don't worry, everything will be recorded. This stream is getting recorded. Okay, you can just go back and listen to it again in your free time. So let's start our lecture on order block. So we'll be looking for order block to form in the first leg of breaker, and that's high probability. Okay, so the first leg of breaker, we'll be looking for the breaker forming there. Okay, so the formation, the first formation will be something like this. We have a higher high here, and we are expecting to see a bearish breaker forming here. So before I talk about the order block here, do you guys see it here?
I'll just give you guys 1 minute, and in this time I'll reply for some folks who don't have the link for the session. I don't know how these people missed it. I replied like to every single one of the person who emailed me like the day before today and before that. Okay, so we have our breaker here. Let's continue, folks. So we have our breaker here, then price generated a swing high, another swing high, price went above this swing high. So this is what we are expecting to see working as a breaker. Where is the order block here? So before we identify a order block, the way price forms a order block inside a breaker, it's a little bit of advanced theory, okay? Most of the time you won't be able to see it because it has some specific rules. If you follow these rules and you are not looking at chart to identify a random breaker, if you are not doing that and following the rules, you'll be able to see the order block forming and you can execute according to that. And with this order block, okay, with this order block theory, we can take early entries inside breaker. Okay, before I was showing you guys like when price was near, when price had a near PTR with a breaker, right? But this time we will be looking to take early entries with breaker and order block. So we have a fair value gap here, right? Price formed a fair value gap, then price came back up with the up close candle here. So these up close candles, these two up close candles, will be considering these as our order block. Okay, the first or up close candle that hit the fair value gap is our order block. Is it different than the order block that you already know about? What you know about the order block is that price will have a last up close candle, and that's what we will be considering as an order block. But here what I'm sharing with you is that when price forms a fair value gap inside the breaker, okay, and price retraces higher, price generates a bullish candle, the last candle that hit the fair value gap, we will use this candle as our order block. Okay, once price generates this up close candle and goes below this candle, we will execute at this candle, price retesting this order block. As you can see here, at this candle we can execute at these candles and target this swing low, or if we have a lower target like suppose an unfilled fair value gap or a discount PDRA, we'll be looking for that. Okay, so these are the order blocks that we are looking for. So what are the rules? Price will have to do stop hunt, then once price is coming down, it will have to generate a fair value gap. Okay, and when price is retracing back to the fair value gap with a bullish candle, that bullish candle will become our order block. Right? Is it clear, folks? So high probability order block formed inside fair value gap. Okay, when price generates order block inside fair value gap like this, you can use a very narrow stop loss. So this opportunity, when it comes into the marketplace, it gives us also a chance to use a very narrow stop loss. And what will be our stop loss? Which can be above the swing high body. So this time we are not putting our stop loss above this swing high with the breaker or above the breaker, but we are putting our stop loss above this actual manipulation swing high, but in the body. Okay, we are not putting the stop loss above the candle's wick, but in the candle's body right here when we are executing with a breaker. The folks who have experience with a fair value gap, breaker, the folks who took entries with breaker, trust me, you already saw price forming a fair value gap inside the breaker, but you didn't know that the up close candle working here as an order block. Right now you do, and the folks who didn't know that before, now you can use this simple logic that price will do a stop hunt. Okay, price will generate a bearish breaker. You will have to predict that this breaker will activate it. Okay, this breaker will get activated. And how will you know that? Once you see price rejecting from the order block, you are not pushing the button as soon as price hitting the fair value gap. Are you pushing the button here? No, that's not in the rules. You wanna see as soon as price hits the fair value gap with a bullish candle, at the next candle you wanna see it opening lower, retesting this order block. Okay, and then going lower. If you are still confused, you can execute at the next candle. As you can see, the next candle opened where? Opened here, it went higher, retested this order block that formed inside the fair value gap and then went down. As soon as price hitting this fair value gap, we are not executing, rather we are waiting. Okay, we are waiting for price to generate couple more candles and retest this breaker. What do I mean by retest? Look at how these candles are behaving here. Right, this is something, folks, that you will not see in public place. Okay, every information that I'm gonna be sharing from now on is not available in public place. ICT, he don't talk about these things because these are the things that happens inside the chart, inside the chaos, and you think, okay, price is so choppy right now, should I trade right now? But here price is forming a high probability PDRA with logic. You just didn't know it before. So I'm gonna share the rules again. I didn't write it here, but write it from your part. Price will have to follow our 5 rules of forming a breaker. Once price does that, okay, once price does a stop hunt, we will expect to see price forming a fair value gap at this leg. Okay, not at the manipulation leg, because if price is forming the fair value gap at this leg, it will work as an inversion. Then we have different rules. But if price is forming fair value gap here inside the breaker, right, we have different rule. We will wait for price to come back up immediately. We are not expecting to see a long retracement. Okay, we are not expecting to see price leaving this fair value gap unfilled. If price is leaving this fair value gap unfilled, this fair value gap will work as the premium fair value gap that I showed you guys before. Do you guys remember? There was a chart that I showed you guys that there will be a fair value gap which will be working, which we will expect to see price leaving unfilled, and then price activating the breaker, coming back up, generating relative equal lows. Do you guys remember that? If not, just go back and listen to it. Here we are expecting to see price retesting the breaker immediately. Okay, as soon as price goes inside the breaker, the last up close candle is our high probability order block, folks. The same exact way price will form the setup. The only difference can be, suppose the next candle that you can see, it is lower in the actual chart. The next candle can be a little bit higher, but our logic stays the same here. We are using this candle that hit the fair value gap as a order block, and we are expecting to see price closing a candle's body below the order block. And as you can see, price did here at this candle and at this candle, and we can execute at this candle with a stop loss above here. Is it clear, folks? Now I will share with you all the second formation with this order block theory. There's another order block here. Do you guys see it? Before I outline the order block from here, I want you to identify or use your own eye to see it here. The last up close or down close candle at the manipulation leg is working as also a order block. Okay, the last up close or down close candle where at the manipulation leg. What manipulation leg? This leg right here. Where's our last up close candle? Because we are expecting a bearish breaker, right? So we are gonna be looking at the up close candle. If we are predicting a bullish breaker, then we will be looking at the last down close candle, which will be here. But this time we are predicting a bullish breaker, right? So this is our last up close candle. As you can see here, the same formation, the same chart, folks. Okay, so this time price can form a fair value gap here, or it can't. It doesn't matter. If price is forming a fair value gap here, then we are using this rule. But suppose that there's no fair value gap here, just suppose that, just imagine that, then we'll be using this up close candle as our order block. And as you can see, price formed a fair value gap here, which is also making this order block as a high probability PDA. So as soon as price doing this stop hunt, are we executing? No, we are waiting for price to go below this last up close candle. Okay, the rules are price will have to do the stop hunt, you already know it. Then price will have to go below the last up close candle. Once price does that, it's activating our order block here. Okay, if price is not closing its candle's body below, okay folks, this order block is not like activated, and you can execute, you can take the trade here at this candle as soon as price close the candle's body below the breaker. And if price is generating the fair value gap, okay, and you want to take a safe entry, then you can follow these rules here that I shared here. But if price has no fair value gap here, you will look at this last up close candle and you will use it as an order block. And this last okay, so I wrote it wrong here. It was supposed to be the last up close candle. Okay, so let me fix it. Oh, my computer is lagging because of the amount of slides. Okay, like we are only at the number 20 slides. There are more than 40 slides, so we only reached like the halfway of our lecture. There's a lot of things that left for you to know here. What the hell? Okay. So what we are expecting to see here, we are expecting to see price forming the last up close candle and getting rejected from it, right? Just give me a little bit of time. Okay, so this was our formation, and we are expecting to see our last up close candle in this bearish scenario working as a confirmation to us that price wanna go lower. Okay, so suppose you are not feeling ready to execute from this order block, you can use this order block for a confirmation. Okay, you don't have to take this early entry if you are not confident enough. Okay folks, you are not forcing a setup, you are not forcing a theory that you are not comfortable seeing, you are not used to seeing. Okay, that's how I will say it. So if you are not like, if it's the first time you are hearing about this order blocks theory, then I'll suggest you just to use these order blocks as a confirmation, and once price does close as a candles body below the breaker, you can execute. Okay, if you have the experience and you feel like, okay, I'm seeing the same formation that HYDRA shared, then you can only execute at that time if you have these type of formation exactly repeating in price. Okay, so if we are right anticipating that this breaker will show resistance for price towards downside, then this order block should be respected. So if we are expecting that this breaker will get respected in price later, we also want to see price respecting this order block to get resistance to our sell side liquidity. As I told you guys, if you are not comfortable using this order block as an entry, you can use it as a confirmation, which will boost your confidence in the trades. Okay, this theory is not for entry but to use it as a confirmation. As I'm telling you again, if you are not confident enough, take it as a confirmation, not as an entry. Okay, high probability setup here is this, folks. Once price generates a fair value gap inside the breaker, then that up close candle becomes our breaker, sorry, order block, high probability order block. This scenario is not a high probability scenario. I'm sharing why I'm sharing it to you here, because this thing also repeats, and you can use this last up close candle as a confirmation. Okay, sometimes if I'm sharing the execution with here or on Telegram or Twitter, you guys will see me taking the execution early, and that's what I do. A tip: a high probability order block forms once price takes out a swing high or low with a fair value gap. Okay, so we already know about this. I hope everything is clear here. Do you guys have any question about what I shared just right here? Patrick, I already talked about it. The question that you were asking me: how will you know that price will continue lower and activate this breaker? So there are some rules. If price is forming this fair value gap, okay, and then price is respecting this order block, you can expect to see that with a high probability, meaning like with 80% of chance the price will go lower. And there are other rules. Okay, I don't know why you guys are forgetting the rules. The 5 rules that I shared with you all, that makes our breaker high probability. We'll have to have a swing higher time frame PD area from where price will reject or get support. Then we'll have to have clean swing highs. Then we'll have to have a stop hunt. Then we'll have to see price closing a candles body lower. And the last but not least, the most important thing is the target. If we have a high probability target, that means an unfilled fair value gap in the discount PD area, as I'm showing you a bearish breaker example. So if there's an unfilled fair value gap, unfilled BPR, unfilled new week opening gap at the discount PD area, that's when you will know that price will respect this order block. Okay, so everything goes back to the 5 rules. That's the reason I shared it shared it early. If you are getting confused, like how will I know that price will respect it? Price is trading inside a higher time frame PDR from where you are expecting to see price getting rejected, right? Then price formed a clean swing high, went above a clean swing high, did a stop hunt, that price formed a order block here, price is going below the order block. This is another confirmation. Then once price closes again this body below here, there's another confirmation. Then we have a target here. So couple of confluences, folks, couple of things that we are looking for. Not only that this pattern will show up in chart and we will execute. No, it's not like that. Price will have to have some rules, and that's what makes our setup high probability. Once the rules are visible, the things that we are looking for, we will know that this candle will hold price lower. And as I told you, that this candle can also work as a high probability for us to get confirmation, not as high probability. This candle can also confirm us this price wanna go lower. Okay, so suppose price closing a candles body above this last up close candle, then we will know that price will not respect this breaker. As I'm telling you, if you cannot identify a high probability target, okay, if you are new, if you are a beginner, just use this up close candle or anything here that I shared with you as a confirmation. And once price actually closes a candles body below here, you can execute at that time. So now I'll be doing a bonus topic. Okay, this is not a topic that I included in in our breaker when I was making this content, but I thought of making it because this will be very beneficial for us to use reclaimed breaker. Okay, when a breaker fails, we can use the same breaker to execute new trades, and this information right here will be very beneficial for us to take those entries. So here we'll be looking using old order block, which will be reclaimed order block, to predict new PD array. So near to old order blocks, we will expect to see a fair value gap forming, a volume imbalance forming, order block forming. Okay, near to the old order blocks. What is the market maker buy model? So for that, you will have to understand the market maker buy and the market maker sell model. Okay, in simple terms, I'm not gonna take you into details, but in simple terms, we can identify a market maker buy model as it's understanding market going lower for discount PD array to reach for premium PD array. So if I put it simply, price is going into the discount to reach for the premium PD array. So when price is going for the premium PD array, that's when price is forming a market maker buy model. What is the market maker sell model? It's understanding market going higher for a premium PD array to reach lower for a discount PD array. It's a very simple concept. I don't know why people make it so hard to understand. This is the market maker buy and sell model. When price goes up from by using a PD array, so suppose price is going lower by using a breaker, that's a market maker sell model. There's nothing else there that's happening. If price is buying, if you are buying from a bullish breaker, that's what market maker buy model is. Okay, you are using a discount PD array to target the higher PD array. In a bullish breaker, you are using the premium PD array to target the discount PD array. Very simple things, folks. To predict new PD arrays on market maker buy model, we will be using last down close candle prior to move up from the sell side of the curve. When I show you the formation, the pattern, it will make a little bit more sense, but for now, know that to predict a new PD array, we'll be using the last down close candle from the sell side of the curve before a move up. Okay, so how will it be? So now I'll show you guys the formation predicting new PD arrays on buy side of the curve by using old order blocks from the sell side of the curve. So here, so look at the last two rules that I shared for you. To predict a new PD array on market maker buy model, we'll be using last down close candle prior to a move up from the sell side of the curve. To predict new PD arrays on market maker sell model, we'll be using last top close candle prior to a move down from the buy side of the curve. Okay, so we have a sell side of the curve here. Now we will use the old order blocks to predict a new PD array to form in the buy side of the curve. Okay, so what does our rules say? Last down close candle prior to the move up. So we have a move down, we'll be looking here because this is a move up, so we'll be looking at this down close candle. Then as you can see, price formed a breaker here. We have a higher high, new higher high, right? So this is our breaker. This is our last down close candle here and here prior to this move up. So we'll be looking for this candle here and then here. Then we have another move up prior to a move down, right? We'll be looking at this down close candle to predict a new PD array. Just like this, I hope it's clear, right? So we are pointing out the last down close candle from here. Why? Because after that, price retraced a little bit higher, went into the premium zone and then retraced lower. Then here again price retraced higher. Then this last down close candle here and here, we'll be using it to predict our new PD array. Same goes for here, because we are using to predict a new PD array to form on the buy side of the curve. That's why we are using this kind of scenario from the sell side of the curve. So how will it look in the buy side of the curve? So we mark the last down candle prior to a move up. I hope it's clear. Now we would like to see price going with speed. Okay, when price, I'll show you guys an actual chart. Now here I'm showing you a pattern, so when I show you the example on the actual chart, it will make more sense. Just look at the pattern now, because it will help you to understand what happens in the actual chart. So when price is going above this candle here, okay, we want to see price going with speed. We don't want to see price retracing from this, because this is a mitigation block, folks. Okay, we don't have a stop hunt here. So when we don't have a stop hunt, the last down close candle here becomes our mitigation block. So price can easily come up here and then continue its trend. What are the rules? We want to see price moving with speed when it's going through the last down close candle prior to a move up from the sell side of the curve. Okay, then once price goes up, okay, closes the candle's body above the last down close candle, we expect to see price retracing lower. And before that, we want to see price forming a PD area, a bullish PD area right here. A bullish PD area can be a fair value gap, can be a breaker, can be an order block, everything. Okay, everything, every PD area that is bullish, we will expect to see it forming here. But the highest probability is price forming a fair value gap. Okay, so what are we doing here? We are expecting to see price going up, going above with speed, going above the last down close candle prior to a move up from the sell side of the curve with speed, and forming a new PD area, new bullish PD area right next to the old order blocks. Okay, once price does that, we'll expect to see price retracing lower inside this PD area, this bullish order block. Okay, and not going lower. We want to see price respecting the last down close candle from the sell side of the curve to push price higher. We want to see price using this PD area plus that PD area that price will form inside here, inside the buy side of the curve, the new PD area. We want to see price coming down, hitting this PD area and going up. Then here again we have our last down close candle prior to a move up. We mark it here. We expect to see price forming a PD area here. Okay, this PD area can be a fair value gap, a order block, I'm saying it to you again, a breaker. Highest probability is price forming a fair value gap inside these last down close candles. Then the same thing, we will expect to see price retracing lower. Okay, price can go up, get resistance from the last down close candle here, because this is now working as a mitigation block. Okay, as long as price is not closing a candle's body above the last down close candle prior to a move up from the sell side of the curve, we'll be using it as a mitigation block. Okay, and after that we will expect to see price going higher with speed, forming another PD area here. And that's how price completes a market maker buy model. Okay, price using the last down candle to form a new bullish PD area plus to use it as a support. Okay, so I'm gonna say it to you again, folks. Read the rules here. So when we are predicting a market maker buy model, we'll be using the last down close candle prior to a move up from the sell side of the curve to predict a new PD area forming. Okay, how does ICT knows that a fair value gap will form here? Just like this, uses the same information that I'm talking here, sharing with you here, and that's how he knows. That's how I know that a fair value gap will be forming here. That's how I expect to see a breaker forming here. Okay, and at these times, okay, when price is retracing lower, hitting the fair value gap, this is happening inside our macro. Every single time you see the price can form this fair value gap before macro, but we are hitting this fair value gap inside macro. This is a very specific thing, folks. Okay, price can also form this PD area inside the macro. Okay, and also can have hit the PD area inside the macro, continue the trade inside the macro. So everything that is happening here is inside the macro. I hope I don't have to say it separately. You already know it. So how will we see it in this when we are trying to predict a new PD area to form in the sell side of the curve? So now I'll show it to you all, predicting new PD areas on sell side of the curve by using order blocks from the buy side of the curve. So here we have a market maker buy model, which is a little bit critical than what I shared here. Okay, price will not go higher straight, it will have formation like this. So before I mark out the last stop close candle prior to a move down, I will give you some time to watch it here. Okay, so now let's mark out our last stop close candle prior to a move down. Okay, folks, so what do you guys see here? We have a swing high here, right, prior to a move down. So we'll be marking the last stop close candle from here. Then as you can see, price moved up. This is a move higher prior to a move down, so we'll be marking the last stop close candle from here. So I'm marking both together. Okay, then we have a swing high here prior to a move down. We are marking the last stop close candle here. Then we have another swing high here prior to a move down. We are marking the last stop close candle here. Now once price is going coming lower, we will expect to see price forming a PD array inside here, here, and use all of these last up close candle to get resistance towards sell side liquidity. Okay, here we saw price forming the bullish price using the last down close candle as a support to form new PD arrays to go higher. Here in the sell side of the curve, we will expect to see price going lower below this last up close candle and forming a new PD array and using this PD array to get resistance towards sell side liquidity. Okay, and now we will expect to see, so I shared the rules with you all. What are the rules? We will expect to see price going through the last up close candle, okay, with speed. Okay, if price is not going with speed, this can work as a support for price to continue its trend. So I'm answering the question that you will ask me, like how will I know that price will go lower? That's how you will know. Price should go below this last up close candle prior to a move down from the buy side of the curve in the sell side of the curve with speed. Okay, I hope it's clear. Once price goes with speed, you will expect to see price forming a fair value gap here. Once price does forms a fair value gap, you will expect to see price retracing after hitting the last up close candle from here, because what is this? It's a mitigation block. That means what? It's a bullish PD array. It's not a bearish PD array yet. When does it become the bearish PD array? When price is closing a candle's body below the last up close candle prior to a move downwards in the sell side of the curve with speed. That's when price does a market structure shift, and I refer to it as a hidden market structure shift. So price now went below this last up close candle prior to this move down. We will expect to see price forming a new PD array here, and as you can see, price did form the PD array. Now we'll expect to see price coming up. Okay, the body should stay inside here, folks. Okay, this is very important rule. Price should not go above and close the candle's body above this last up close candle that you see here. Okay, every up close candle that you see, price should respect it and close the candle's body lower than this. If the wick can go up, but the body should stay inside here. So suppose price is going up and closing candle's body above this fair value gap, then we will look inside this last up close candle prior to this move down. We don't want to see price going up and closing a candle's body above. If price is doing that, that means what? Price is reversing. You should close your trade when you are still in profit. Price using the last up close candle to form a new bearish PD array plus to use it as a resistance. Is it clear? The buy side, market maker buy model, and the market maker sell model, how to predict new PD array using old order blocks. Is it clear? Before I show you the actual chart, how it looks in the actual chart, let me know in the chat if you guys have any questions. Brianna, you are welcome. I think you missed the first part of our lecture, so I'll recommend you to go back and listen to those first, not to listen to this first, because what I'm presenting here is coming with logic. Okay, every slide that I'm sharing one by one has a logic behind it. Okay, so I hope it's clear. I tried to make it clear from my ability, from what I understood as much as possible. I repeated the same concept again and again. So now I'll take you guys through in the next slide, and I'll show you how it actually looks in the chart. So the formation in the chart. So we have a market maker sell model here. So before I outline the last down close candle prior to a move up, do it with your own eyes. Okay, why? Because this will help you to improve right here. Okay, so mark the last down close candle prior to a move up, and we'll use the last down close candle from the sell side of the curve to predict a new PD area in the buy side of the curve. So were you able to outline the last down close candle prior to a move up? We also have a breaker here. I don't know if you guys see it or not. So let's mark our last down close candle prior to a move up. Okay, so we have a move up here. I didn't mark the last down close candle right now, but did you see a fair value gap forming here? Do you see that? We have our last down close candle here prior to a move up, right? Then price did what? Price came back up with speed. It closed the candle's body above the last down close candle prior to this move up. Move up, yeah. And at the same time, it formed a fair value gap here. Just like I showed you guys in the pattern, it's doing the same thing here. And then price continues to trend higher. Then again here, price formed another fair value gap here. Why? Look at here. We have a last down close candle prior to a move up. So we'll be marking this last down close candle. We'll be outlining it into time. And as you can see, price formed another fair value gap here. And this fair value gap is very high probability. Why? Because we have a mitigation block here. Okay. So every fair value gap that you can see is formed inside the last down close candle prior to a move up from the sell side of the curve. This is very simple, folks. It may be sounding to you at first like very complex, but I'm trying to make it like as simple as possible because trading is simple, folks. Okay, I can make it complex. I can put a lot of different rules inside here, but it doesn't matter. What I'm showing you here is the highest probability, nothing else. You don't need to look at anything else. Okay, so we have our last down close candle prior to a move up. We mark the last down close candle to project and to predict price forming a new PD area. Last down close candle before a move up, we are marking it to predict a new PD area. Then we have our last down close candle here. We are marking it to predict a new PD area here as well. Is it clear? Let me know in the chat if it's clear or not. Or if you guys have any question, I'll share another example with this because this is a very important lecture, folks. This alone will put you outside of like you didn't know anything what price is doing before. Now you know what price is doing, at what time it's doing, at what time it's forming a breaker. Here I'm not showing a breaker formation. Just give me a second, I'm coming back. So I got a question. Do you suggest using with Heikanshi candles? Okay, so I don't know what you were talking about. How Heikanshi candles? I never heard of it. So we are marking this on lower time frame, i.e. 1 or 3 minute. This concept is not limited on time. Okay, you can use this same concept to predict new PD areas on higher time frame as well as lower time frame. This concept is not bound with time. The setup that I showed you guys before, that is bound with time. You will be looking for those breaker forming inside 1 or 3 minute. Okay, 1 to 3 minutes. But this It's not bound with time. If you are looking at the daily chart, you will be just like this, okay? From the daily chart, this formation can be on daily chart, on lower time frame, on 4 hour, 1 hour, 15 minute, as many time frame is there. This is the formation that we will be looking at. So I'll be sharing the next example with you all. So here's a tip. When price is going through the last down close candle in the buy side of the curve, from the sell side of the curve, we expect to see speed, a new PD area forming, price using old order block as support. So I shared these tips with you all when I was introducing to you about this order block theory, okay, reclaimed order block theory. And now you can see I wrote it down here for you to use it in later, if in case if you forget, okay. So that the information that I shared with you all in the reclaimed order block, okay, this same logic we will use to predict a new breaker from a failed breaker. So if you didn't understood it clearly, I'll suggest you to listen to it again. And before I move and take you to you guys in the reclaimed order block, sorry, reclaimed breaker block, this have to be understood, okay? So I hope it is understood. This formation is only for buying opportunity, or can we short from the down candle? Knowledge 22. What are you doing? Like, I already talked about like how to buy and sell at the same time, right? I did share that. So where did I talk about it? At this slide. Look at that. I shared with you a buy formation plus a sell formation. We'll be using the last up candle prior to a move down to predict new PD areas on the sell side of the curve. Then we'll be using the last down candle prior to a move up to predict a new PD area on the buy side of the curve. So now we'll be looking at another formation of breaker, which is coming with a volume imbalance, breaker plus volume imbalance. This is also considered to be as a high probability setup. So a volume imbalance gets generated when price is moving aggressively towards one direction and creates a high probability opportunity for us to buy or sell, okay? A volume imbalance only gets generated when price is moving with volatility. In high resistance liquidity run, the volume imbalance that gets generated is not a high probability volume imbalance. We'll be focusing inside the third leg of breaker for price to generate a volume imbalance. So the formation is like this. We have a higher high. We are applying the rules that I shared with you all, the 5 rules first, and then we are looking for a setup, okay? Without those rules, no setup is high probability, folks. Price will have to do this formation inside a higher time frame PD area, okay, or a lower time frame PD area, premium or discount PD area, and that PD area will have to be unfilled. I shared it at the very beginning of our lecture, so you can go back and listen to it again. So we have a higher high here, we have a new higher high, then we are predicting a bearish breaker to form, and price formed a volume imbalance here at the discount leg, okay, at the discount range of the price. So we have this little separation. Look at the candles before it. Each of the candles are opening near to the candle before it, right? But this candle opened lower than this candle, and that makes it as a volume imbalance. So when price does things like this small separation between price is called volume imbalance with wicks. When price don't have wicks like this, we refer to it as a liquidity void, which is more high probability than a volume imbalance. So I will also share the example of that in coming lectures. A high probability volume imbalance forms inside the breaker in a discount range, okay? So I'm sharing very specific rules with you all, folks. This volume imbalance that is forming here, you will expect to see it forming at the discount leg, not here at the premium. If it's forming at the premium leg, we are not considering it as a high probability. I'm not sharing with you like the every possible formation that price can have, but I'm sharing with you the high probability formation that price will have. Okay, so we have our fair value gap, we have our volume imbalance that formed in the discount range with this breaker. After that, we will outline the breaker and we will expect to see price hitting this volume imbalance and then going lower. Price can go up, but the bodies of the candle should stay inside the breaker. So where will be our entry? Our entry will be here, and our stop loss will be above the candle's body right here. This is a very simple concept, very easy to understand. Nothing is here is complex if you understood the previous lectures. Candle's body should be staying inside the volume imbalance. Wicks are allowed to move a little bit higher. Okay, wicks should not go below, should not go above this candle high, our breaker's high. Breaker's body should not go above the breaker body, rather it is allowed to go above and fill the fair value gap here that we have here. Okay, in this scenario, your stop loss will be above the breaker body right here. So this is the only formation with volume imbalance that is high probability. If a volume imbalance is forming in the premium leg, premium side of the breaker, then it's on you to take it. But if it's forming, I'm not considering it to take it as an entry, as I'm considering it as a low probability. Now I will show you guys how a breaker looks when it's coming with a liquidity void. The same logic, but this time we won't have the wicks. Okay, in a volume imbalance we have wicks crossing each other, but we have a little bit of separation, right, just like here. But in a liquidity void we don't have a separation but a gap. A liquidity void is when price has to trade inside a zone, even though, okay, wait, I did a mistake here. Now it's good. So a liquidity void, let me take it back again, let me take you guys there. So a liquidity void is when price has no trading inside a zone, even no wicks. Okay, liquidity void works as a strong support for a bullish breaker, resistance for a bearish breaker for price, and can be used many times in future as a reclaimed void. So reclaimed volume, a volume imbalance cannot be reclaimed. It's not a high probability, but a liquidity void can be used many times in future. Okay, folks, so how is the formation? As you can see, it's just as like our volume imbalance. We are expecting to see price forming a liquidity void at the discount range of our price leg, of this third price leg. Okay, so as you can see, this this liquidity void has no wicks but a big gap. It has no trading inside it, so this here is way more high probable than a volume imbalance. Okay, why? Because price has no trading inside this range, so price will eventually come back up, hit this fair value gap, hit this liquidity void and go down. Your stop loss is same as before, staying here. Okay, so there's nothing more to say here. This is our liquidity void, and that's a very simple concept. Here again, I'll share the logic that I will share the same logic that I talked on the order blocks. Okay, this candle, this bullish candle, is our last bullish candle that hit this liquidity void, okay, at the discount lag. So we can also use this, the up close candle, as an order block. So suppose you missed your entry here, once price closed a candle's body below this order block, you can expect to see at the third candle price rejecting by using this order block. So suppose you missed your entry from this liquidity void, You will wait for price to go below this order block, and at the next candle when price is retesting, coming back up inside this order block, you can execute here with a stop loss above the breaker here. So is it clear, folks, with the what I shared at the next the slides here? If it's not clear, you can ask me questions in the chat. So now we'll be looking at breaker plus BPR. Okay, so Mco asked a very nice question. In the market maker model, in the last bullish or bearish candle, we take the whole candle or just the body. We take the whole candle with the wick, and we expect to see a fair value gap or a bullish or bearish PDA forming there. Okay, so now I'll be talking about the breaker plus BPR. This is our last formation. This is our last high probability formation, folks. A balanced price range. Okay, when price has two fair value gaps inside breaker alongside each other, that's when it becomes a high probability setup. A BPR is when price has two fair value gaps alongside each other. It's one of the highest probability formation with breaker. We'll be focusing on a BPR to form in the premium zone of second and third leg of breaker. I know that you guys have confusion about the second, first, and the third leg. This lecture is coming inside the Reaper breaker, so when I'm talking about the Reaper breaker, this will get way more clear. Okay, folks, so just hold on and being a little bit patient. I'll talk a lot more about this in our coming topics. A BPR can also form in the discount range of a breaker, but this formation is less common in price. So before I showed you guys the inversion forming in the discount leg of the breaker, a fair value gap forming in the discount leg of breaker, and that's what making a breaker high probability. But here we want to see a BPR forming in the premium leg of the breaker, okay, not in the discount leg. If a BPR is forming in the discount leg, this will be considering as a low probability, which is less common in chart. Very less of the time, suppose 10% to 15% of the time, you will see price forming a BPR in the discount range of the leg. Okay, you will see most of the time price forming a BPR in the premium side. So how's the formation? This is the formation, very simple, easy to understand. We have a higher high, new higher high. We are predicting to see a bearish breaker forming and plus a BPR here. So this is just the pattern. I'll take you guys in the actual chart. I'll show you example, and that's the time when you will have, when it will make a lot more sense to you. So we have a fair value gap here at the manipulation leg. Okay, this is the rule. Then the new fair value gap will have to be right next to the old fair value gap that was in the manipulation leg. Okay, so we are expecting to see a fair value gap forming at the manipulation leg near to the swing high, this swing high. Okay, and then the new fair value gap forming right next to the old fair value gap. And this here we will consider it as a BPR. So this, I showed you the BPR that was in the premium leg. Now I'll show you BPR in the discount leg. And this is the formation which is very less common in price. you will see less times, but most of the time you will see this formation forming. So we have a fair value gap in the manipulation lag in the discount range. Okay, from this low to this high, this fair value gap is coming at the discount. Then from this high to this low, we have this fair value gap coming into the discount. Okay, so both of these fair value gap are staying in the discount. A BPR is only gets generated when prices two fair value gaps right next to each other. Okay, that's when we consider it as a BPR. So now let's look at the actual formation in chart. BPR in premium lag. Okay, I'm showing you guys the BPR that is in the premium lag, right? So we have a stop hunt, higher high, new higher high, price generated a fair value gap where in the manipulation lag. That's where we want to see price forming a fair value gap. Then price formed another fair value gap where in the new lag after the stop hunt, right next to the old fair value gap. Okay, now what will we expect to see? This is our BPR. We'll be outlining the fair value gap that is on the manipulation lag. We will expect to see price hitting the fair value gap from the manipulation lag. Okay, that's the reason I'm only marking the fair value gap from the manipulation lag, not this fair value gap. We will not mark this fair value gap. Price can hit this fair value gap, but this is not enough for us to expect a high probability scenario. Once price comes back up, hit this fair value gap inside the manipulation lag, that's when it will become a high probability scenario. And at next, we are also expecting to see immediate rebalance. Okay, we want to see price not going lower, closing a candle's body below, but retracing at the same time, hitting this BPR and then going down. So the same logic we can apply here from the order block. Do you guys remember I told you guys that as soon as price generates a fair value gap after doing a stop hunt and price makes a bullish candle, we will use this bullish candle as the order block and we will use it to predict resistance in the coming price action. And as you can see, price went up. The bodies of the candles should remain inside the BPR. They should not go above the BPR. Okay, candle's body should remain below the BPR, as I told you guys here. If you missed your entry here, you can use this last up close candle that hit the BPR, the first up close candle that hit the BPR, as an order block to execute at this candle. At this candle you can pyramid here, okay, by using the rules here. A high probability scenario is created when price is getting resistance / support from the BPR immediately. What do I mean by immediately? What do you guys see here? Price generated a fair value gap, a BPR, and then is coming back up immediately. So when price does that, this is our high probability scenario. Long retracement leads to low probability scenario. What do I mean by long retracement? So suppose price left this fair value gap unfilled, this BPR unfilled, and then is going lower, having this type of formation, coming back up, getting resistance from our down close candle here. This will make this scenario a low probability. We want to see price immediately rebalancing the area here, providing liquidity inside here, and then going down. Does it make sense, folks? Knowledge 22, yes, we don't have to wait for a break of structure like before when I was showing you the actual breaker pattern. I told you guys to wait for price to close a candle's body below the breaker, and then we were looking for execution, right? But this time we will not wait for price to close a candle's body below. If price is doing this scenario, we'll execute at this candle. If we are missing our entry here, we'll execute at this and this candle. This is the high probability scenario. Plus price will have to have a unfilled fair value gap, unfilled new week opening gap, or like suppose a BPR that will have to be unfilled in the discount range. Why in the discount range? Because we are expecting lower prices. If those 5 rules are meeting and then price is presenting this scenario, you do not hesitate to execute, and you do not need a market structure shift here. Once price closed a candle's body below this fair value gap here, once this fair value gap failed, as I told you guys in the inversion lecture, breaker plus inversion, I told there that when price is closing a candle's body below this fair value gap from the manipulation lag, price is having a market structure shift. That means our price is changing its trend, and once price comes back up inside this BPR, we are executing here with a stop loss above here. We are slowly approaching towards more advanced lecture, folks. Okay, so if this don't make sense to you, please let me know, because when we are approaching towards advanced lecture, you won't understand anything, okay, if you're not getting your things clear here. So I'm giving you guys a little bit more time. If this thing is clear, let me know, and I'm gonna take you guys in the next lecture. So far, are you guys enjoying what I'm presenting in front of you? Making this template, folks, it took a lot of time from my part. I really put in the work to make things easier for you guys to understand, right? I'm only talking about the straight stuff. So if you guys are enjoying it, please hit the thumbs up button, and that will inspire me. That will motivate me to give you more clarification here, okay? If you guys are enjoying my template so far, I hope you are enjoying, you are learning and finding it informative so far, okay, folks? And yeah, that's the only thing that I'm expecting from you, a thumbs up. So now we'll be looking at the BPR that can form a discount, okay? Before, at our last slide, I showed you guys that the BPR that is forming at the premium leg, at that is our high probability scenario. When price is forming a BPR at the discount leg, this is not a high probability scenario, but it forms, okay? It forms often, and we'll be looking at this. So we have our BPR at the discount leg right here, okay? According to the dealing range from this low to this high, this fair value gap is coming here. What is our rule? For a new BPR to form, price will have to close a candle's body below the old fair value gap from the manipulation lag. When price does that, okay, it becomes our what? BPR, a balanced price range. So we'll expect to see when price has a fair value gap, sorry, a BPR, a discount lag, we'll expect to see price activating the breaker first and then coming back up, hitting this fair value gap, sorry, hitting this BPR. We are not expecting to see an immediate rebalance here, okay? Immediate rebalance is what? Price coming back up before activating a breaker and hitting this BPR, okay? That's what we refer to as a immediate rebalance. But here, as you can see, price retraced lower, closed the candle's body below the breaker. That means what? Price activated this breaker, then came back up inside this BPR. We only expect to see this long retracement when this BPR is a discount. Is the rule here clear? When price has a BPR at the discount of the breaker, we will expect to see price leaving the BPR unfilled first, activating the breaker, and then retracing back to the breaker, plus using it to get resistance / support towards our draw on liquidity. What is our draw on liquidity? At the very beginning, I shared the targets, 3 or 4 targets, yeah. So these are these will be working as our DOL, a relative equal low, a swing high or swing low, a unfilled fair value gap, a unfilled BPR, a unfilled new week opening gap or new day opening gap. This will be working as our DOL every single time price forms a breaker. One of those targets will be there in front of you. When price has a BPR, the premium of the breaker, will expect to see price filling or tapping into the BPR immediately before activating before price activates the breaker. So here we have the BPR at discount lag, so we are expecting less. So we are expecting more retracement to a downside, then price should come back up, and this is our high probability scenario. When we have a BPR at the premium lag, we do not expect to see price activating the breaker first, rather doing a immediate rebalance and then going lower. I hope everything is clear. Now I will take you guys how to take early entries using the first, second, and third leg, which of the breaker, which I refer to as Reaper. Okay, so this is a very advanced theory. I hope you guys understood what I shared before in the previous slides, because you will need it to understand the concept that I'll share here and in the next slide, which will be the reclaimed breaker. Okay, FW is asking, absolutely appreciate all you do, bro. Thank you. Out of curiosity, how old are you? I'm 22. My birthday is coming in the 4th December. So I started trading when I was like 18 years old, and from that moment I was continuing with ICT. At 2019 I found ICT, and when I was 19 years old, and since then I'm continuing with ICT. You are doing an amazing job explaining things. Your graphics are very clear. Thank you, Brianna. I thank you for like finding it informative. Freestyle, about time. All the entry models must be appear in the macro zone, or else. Could you explain again? Yes, every single entry, every single time price is retesting a BPR, a inversion, a fair value gap, those retests are happening inside macros. Okay, so I'll take you guys back inside this chart here. So when price is coming near to this BPR, price should be inside in a inside in a trend continuation macro, because the setup will appear before the macro. Okay, the setup can also appear inside the macro, but most of the time you will see that the setup forming outside macro, but the execution price activating the setup inside macro. So this tap here is forming inside our macro time period that I shared with you all. There was manipulation macro, there was trend continuation macro. So we'll look for setups to form inside those time periods according with our logic. Yes, Rio, we are only expecting to see this setup forming inside macro. Outside of macro, if this setup is forming, we are not taking it as an entry. Rio is also asking, do you have a plus to the macro window, or is it strict? I already talked about it. I think you missed it. So I'll suggest you to go back and listen to the macros that I shared. As a high probability, there was low probability macros too. There was macros like that I use personally. So everything was there, and everything is answered. The question that you were asking now, Rio. How much are you in funding? I'm not a fund. I'm not relying on a funded account to make my ends meet. I've always been trading with my own personal funds. I've grown up in Canada, so I had a opportunity to save money, and I saved a lot of money. I was working part-time jobs since I was like 16 years old. So since then I was like saving money, and somehow it all connected with my trading, and those savings actually helped me a lot when I started my trading journey. Are you his chartered student? I'm not his chartered student, but when he was doing his mentorship, I was basically like getting all the information from the third party, but I'm not his chartered student. um thank you for the amazing comments, folks. So now I will talk about entries inside Reaper advanced theory. This is the highest advanced level of a breaker theory that you guys will find anywhere. Okay, so this strategy I used to take entries before breaker gets activated, and I call it entries inside Reaper. Okay, to take entries inside breaker, you have to have a good understanding of higher time frame support and resistance levels, means high probability PD arrays. I'll share about high probability PD arrays in our coming topics, but for now, know that if you cannot identify the high probability PD array from the higher time frame from where price will get reject or support, your breaker won't work. So first thing, as I shared as the first rule, is that you will have to identify higher time frame support or resistance level. We can look for two types of entries from a Reaper: inversion and reclaimed order block. I'll focus in the inversion. So how is the formation? Now let's talk about this, folks. I know the Reaper sounds a little bit like new to you, but once I present the formation, it will make a lot more sense. So what do you see here? We have a higher time frame PD array here. This is our first rule. Price will have to form a breaker inside a higher time frame PD array. So we have a higher high, lower low, new higher high. So price did a stop hunt here. We are expecting to see price forming a bearish breaker here. So price went below, closed the candle's body below. Our breaker is now activated. So this lag is what is Reaper. Okay, I'll teach you guys how to take entries inside breaker using this Reaper lag. Okay, once price is trading inside here, you will be able to take entries by getting confirmation from this lag. We will look for entries once price is going through the Reaper. So once price is coming down, okay, we'll be using logic from Reaper, from this lag of the breaker, to predict new PD arrays. We will use old PD arrays from Reaper to take new entries. The PD arrays that will form here, we'll use that to take new entries. I'll show you guys in the coming slides. We can also predict a new PD array to form with Reaper in the third leg of breaker. This is our third leg of breaker. This is first leg, this is second, and this is the third leg. So I marked it for you all here. The Reaper is the first leg of our breaker. The second leg is the manipulation leg. I already showed you guys how to take entries using the manipulation leg. Do you guys remember that there was a inversion formed here? There was another inversion that formed here. There was a BPR at the manipulation leg. So I already shared how to take early entries using the manipulation leg. Now I'll be sharing how to take early entries using the Reaper, the first leg of the breaker, and this is our third leg of the breaker. So what we'll be doing here using Reaper is that the PD array that forms here, okay, we'll be using that to take entries in the third leg of the breaker. So how is the formation gonna be? I'm giving you some time to look at here and identify a PD array that formed here inside the Reaper. Do you guys see a PD array here? So I'm using Forex Factory as my breaker, sorry, as my broker. You have your personal account. Yes, I've always been managing my personal account. How often do you use a Reaper? Very often. If I'm taking an early entry, okay, if you guys go back the day before today, I shared an entry on Telegram and I explained it, and that entry was using the Reaper. Okay, so if you guys go back and look at the execution there, I explained it, but I didn't explain about the Reaper, which I'll do here now. That execution was using the Reaper, so you can go back and watch the recording from my public Telegram group. What broker do you use to trade indices, forex.com, ovanda.com. These are the best regulated brokers with low spreads that you will find out there. Why I use forex.com? Because that's a broker that sends your money directly to your bank account with minutes. So suppose if I'm withdrawing like 5 to 10k, I'm only waiting like 10 minutes, and in 10 minutes that balance is account, so that money is in my card. But opening an account with forex.com is very hard, because you will have to submit your actual legal information, like your date of your ID cards, your passport and stuff like that, your tax information. So yeah, if everything is clear, they will open a bank account, they will open a trading account which will be connected with your bank account. So let's come back to our Reaper explanation. We have a fair value gap here, okay, which is an inversion fair value gap. Now we will use this inversion fair value gap to take entries in the third leg of our breaker. Okay, this is our first leg of the breaker, and this is our Reaper. Okay, we have a stop hunt. Before we actually identify our how we will take our execution using this inversion, we will have to identify a breaker here. So we have a stop hunt here, price formed a new higher high here, so this down close candle we are predicting to use as a breaker. So this is our inversion fair value gap. This inversion here, folks, is one of the most powerful PD area to take early entries with breaker. Okay, so this is very powerful, folks. If you see it, and if price is respecting the logic that I'm going to share with you here, don't hesitate to push the button here. Okay, we will wait for price to go below the inversion and close a candle's body. For bullish breaker, a close of a candle's body above the inversion. This inversion is in a bearish breaker, so we'll wait for price to close a candle's body below the inversion before we execute in the marketplace. I still have a lot of things to share, so don't thank me yet. Okay, so I still have some other topics left to share. Our stream is already 3 hours, so it's going beyond what I expected to see. I thought it will be max 1 or 2 hours and then I'll complete, but see, it's going well over 3 hours. Anyway, I'm not tired, and I hope you guys are not tired and enjoying my explanation. What we will wait to see in price here, doing the same exact logic that I shared with you all before, but this time we'll wait for price to close the candle's body below the inversion, and I'll show you guys how it happens. Once price does that, we will know the change in trend happen, and we can look for lower prices. So once price goes below the inversion, okay, we are not executing here, not here. This here is a turtle soup entry, and I'll teach you guys how to take entries like this in our turtle soup lecture, not here. Here I'm specifically focusing on breaker, how to take entries with Reaper. Okay, this is what gives us a chance to take early entry before price activates a breaker. So the formation in the first leg, entries and stop loss, I'll share all that stuff here. So this is our first scenario. We have our Reaper here, right? We have our breakers here. When we are using it as to take new entries, we will call it a Reaper, not a breaker. This is our first leg of our breaker. This is our second leg of breaker. This is our third leg of breaker. So using a Reaper, we are expecting to take entries in the third leg of the breaker. And as you can see, price came down, closed the candle's body below the inversion from the Reaper, and that's when the market structure shift happened. As soon as this candles open, folks, and goes up, you are executing here at this level. At this week, you are executing. Price is going up. Price opened here. Okay, now price is going up. When this candle is bullish, you are executing here without any kind of hesitation. As soon as price hits the inversion that is inside the Reaper, we expect to see immediate rejection towards DOL. You expect speed. So when this candle is going below the inversion, you wanna see speed, okay? Because this is still a bullish PD area. Price can use this PD area to continue its trend towards buy side liquidity. That's the reason I'm telling you guys not to execute here, not to execute here, not to execute here, but here. Why here? Because this execution is our high probability. Why? Because once price closes a candle body below a old inversion, we know that the market structure shift happened. Now we can take entries using this inversion. And as soon as price closes the candle body below, we'll wait for price to generate next candle, and this candle should go up, and we will be executing here. Entry inside Reaper inversion. So as soon as price hits the inversion again, you will be executing it this week. Okay, stop loss above the swing high. So here our rules has changed because we are using this Reaper to take a new entry. That's the reason we'll put our stop loss above this candle's body, above the swing high, but above the candle's body right here. Okay, so even if price is coming back up after closing a candle's body below it, this order block should show rejection in price. Okay, the price should not go above this order block. That's the reason you can put your stop loss either above this order block or above the swing high. I consider this swing high is as a little bit of safer because price can easily come up, the wick can do the damage, price can go up, hit the rejection blocks here and then come down. So if we are putting our stop loss here, this we can consider as a high probability scenario. So this is our scenario 2, which is high probable than this one. Okay, this here we are looking at an immediate rebalance, but this here, folks, what's the difference here? What's the difference compared to this price action here in this lag? This time here price didn't do a, no, this is not a breakaway gap. Okay, so this time price didn't do a immediate rebalance here, rather it generated a new fair value gap. Okay, that's what making it as a high probability scenario. We have a this is not a BPR. Why it's not a BPR? Because we don't have a fair value gap at the manipulation lag, rather we have a fair value gap at the first lag, sorry, at the third lag, and the inversion that we are using is from the Reaper. So how will we take the early entry here? I know you already know the answer. We will be focusing inside this fair value gap. Okay, this is our high probability PDRA. Once price goes through the Reaper inversion and generates a new fair value gap alongside, we consider it as a high probability setup. So this here is also a high probability setup, but this outstands this scenario. Okay, either of these scenario will repeat, folks. I'm sharing different types of scenarios that will repeat. This will not repeat at the same time. This can repeat, these two scenario can repeat at the same day, but not at the same macro. Either this scenario is coming or this scenario is coming. Either of these you are executing. Okay, but this is the highest probability scenario compared to this one because we have a new fair value gap right next to the old inversion. So now what we will be expecting to see, the same thing. We'll wait for price to close a candle's body below, we'll wait for this candle to go above and do a immediate rebalance. If price is doing that, we'll follow the rules from here, we will execute here. But if price is not following this scenario and leaving this area unfilled or untapped, okay, there's no price action here, no price didn't retrace here, we'll expect to see price retracing, doing a immediate rebalance right here, okay, before activating a breaker. Price can also activate a breaker and come back up, hit the inversion and then go down, but this is the high probability scenario using the first leg of breaker and taking entries in the third leg of the breaker. So is this slide clear, folks? Let me know in the chat before I take you guys into the next slide. Let me know if it's clear. Thank you for letting me know. Now I'll be moving to our next scenario with the Reaper. Here I'll teach you guys how to take entries using the second leg of the breaker by getting confirmation from the Reaper. How to take early entries inside second leg of breaker with the Reaper. Okay, our main confluence that we'll be using is the Reaper, but we'll be taking entries, we'll be taking entries inside the second leg. I'll show you to you here. We'll be focusing inside the Reaper for a new PD array to form in the second leg of breaker. Okay, and now in the third leg there's no PD array forming. We have a PD array forming, that is PD array forming in the Reaper, then in the second leg, which is the manipulation leg. So what do you guys see here? This is our first formation to take entry using the Reaper. This is same as the inversion model that I showed you guys, breaker plus inversion. Do you guys remember? I showed you guys that inversion is coming at the premium side of the breaker, right? But this time we'll be using the confirmation using Reaper. There I didn't show you guys the Reaper, but this time I'll be showing you guys the Reaper and how to take entries with the confirmation with Reaper from this inversion. So we'll be marking out our Reaper. Okay, as soon as price hits inside the Reaper, comes inside the Reaper, we'll be looking for entries. So we have a fair value gap here that we want to see failing. We identified a potential breaker, right? We have a higher high, new higher high that is forming inside a higher time frame PD array. Then we have our down close candles. Price has both swing highs very clean, so we are expecting to see these down close candle working as a breaker. A new PD array fair value gap formed inside the second leg of breaker, which is here. Now we will wait for price to go below this fair value gap with speed and close a candles body below this will confirm our market structure shift. So in our last slide I showed you guys the PD array that formed here, then at the third leg. This time we are looking at the PD array that formed here, but we are also using the confirmation from the Reaper. What is the confirmation? Okay, price formed the fair value gap inside the Reaper. So what kind of price action we'll be looking at? The same as the inversion that I showed you guys with the breaker plus inversion. We have our Reaper here. Okay, just give me a second because I marked the Reaper wrong. These down close candles are our Reaper. Entry will be inside the fair value gap that turned into inversion. So as soon as price closes the candles body below this inversion fair value gap, we will use the same logic that I taught you guys before. Price coming back up, hitting this fair value gap, and then going down in the premium. So here, as you can see, we have our inversion. We are looking inside this fair value gap. Okay, folks, this Reaper. We are looking for a new PD array to form at the second leg according inside the Reaper here. So our new PD array formed a fair value gap. Now we wait to see this fair value gap getting filled. This fair value gap that you are seeing in the new price leg, it can be here or it cannot. This doesn't matter. Okay, I'm sharing this fair value gap with you all because this is also possible for price to form. But if this fair value gap is not here, it doesn't matter. We have a fair value gap here which is inside the Reaper. So we'll be taking our entries here, and our stop loss will be above the swing high candle's body. This is the swing high. We'll be putting our stop loss above the candle's body right here, and we'll be targeting, if we are taking early entries using this Reaper plus this inversion, we'll be taking targeting this sell side liquidity. What is this? This is our low hanging fruit. From this low, sorry, from here to here, price will give you 2R if you are putting your stop loss here. Okay, that's a very nice trade. And the same way, folks, I'm telling you guys again and again, price will not form anything outside what I'm showing you here. 7 setups that I showed you guys, plus the Reaper, plus the reclaimed breaker block that I will be showing you. These are the only things that price does when it's forming a breaker. Hulk, I already talked about how to validate a stop hunt. Okay, just go back when I started my stream and you'll hear me saying that how we can validate a stop hunt. Okay, there are a couple of rules. Price will have to have a clean swing high visible. Without a clean swing high, a stop hunt is not valid. So now let's move on to our next topic, how to take early entries inside third leg of breaker with the Reaper. So far I showed you guys how to take entries using the first leg of the breaker, then the second leg, which is the manipulation leg. Now I'll be showing you guys how to take entries using the Reaper, the third leg of the breaker. If there's no potential high probability PDA on first and second leg of the breaker, we'll shift our focus on the third leg and look for early entries there. In this case, to take early entry, we will need a strong target, relative equal high or low below bearish breaker or above bullish breaker. So without a high probability target, we will not take this specific entry. This specific entry is an advanced entry and it requires a high probability target. If there's no high probability target for price to go to or provide liquidity, these setups will not work, folks. Okay, so be careful in that regard. So let's identify our breaker here. We have a clean swing high here. Price cleared the swing high, went above and did a stop hunt. We are expecting to see a bearish breaker forming. Okay, plus do you guys see a difference here? We have a relative equal low down here, right? So this is included in the rules. So look at here. In this case, to take the early entry, we will need a strong target, relative equal high or low below bearish breaker and above bullish breaker. Okay, so we have a bearish breaker. Now we are expecting to see price having a relative equal low just like this. This relative equal low can be here or can be in an old price leg. Okay, it's not like a must rule that price will have to form a relative equal low down here. Price can form a relative equal low in an old price leg, but it will have to be lower, okay, than our breaker. So we have our Reaper here, and we have a PD area that formed inside the Reaper. If we mark the Reaper and outlined it, extend it out on time, you will see that this fair value gap is forming inside the Reaper here. Early entry with this strategy, I'm warning again, is only allowed when price has a near term relative equal high or low. So relative equal low, what do I mean by near term? Like this, okay folks, price will have to generate or leave a relative equal low very near to price when it's when you are taking early entries with a Reaper. So the next formation is like this. Same logic, folks, the same logic again and again. only different is the formation is different. Okay, in our earlier slides I already showed you guys how to take entries inside this price lag. Okay, here as you can see we have a fair value gap here that formed inside this reaper, so we'll be extending the reaper here, and any PD array that forms inside our reaper, we can use it to take early entries. I'm showing you guys a fair value gap here, but price can also form a volume imbalance. I showed you guys examples with that. Price can also form an order block here. I also showed you guys examples with that. So whatever I'm showing you guys, that's it. That's the only breaker that price will form. Okay folks, other than what I'm showing here, there's no other breaker. Trust me, there's no other formation that price can have. This is the only formations that price will have. So everything that price can do with a breaker, I'm showing you here. And as you can see, suppose you are not comfortable taking entries here, okay, you can wait for price to activate the breaker, and if we still have lower strong target like the unfilled fair value gap, unfilled BPR, relative equal lows, then we can still execute here. As you can see, price did close the candle body below, generated a fair value gap here, right? Fair value gap at discount is very powerful, right? I already talked about this. You can take another entry here. So I'll share another high probability scenario with Reaper here, and this is the high probability scenario with Reaper. What's the difference here according to these scenarios? Sorry, compared to these scenarios, not according. What's the difference here? Do you guys see it? I already marked it so you can see it, but before I explain it, just try to talk with yourself with your own logic what I'm gonna say. So this time we have a breaker inside the Reaper. Okay, we have this breaker here, then we have another breaker which is forming at the second leg of our price. Okay, this is our manipulation leg that did the stop hunt, but we can use this breaker to take early entry. Okay, we'll be here in this scenario, in this kind of scenario, when price presents a scenario like this, we'll be looking for price. When price forms these down close candles right here, we'll also be marking it as a breaker block, and we will expect to see price forming a new PD array, specifically a fair value gap, and that's where our entry will be. I think I don't need to explain it anymore here. I guess you guys already understood it, right? So we have our Reaper here, and this PD array is forming inside this Reaper, and that's what making it a high probability. Okay, inside our breaker, a price forming a new breaker, and then we have a new fair value gap forming. So what are the rules? We are not just executing once we see this breaker, okay? Price will have to form a new PD array alongside with this newly generated breaker at the second leg of second leg here, okay? So price generated break fair value gap here. As soon as price closes a contest body below, retest this breaker here, okay? As you can see, this this candle price retested it. You can execute here, or you can wait for price to fill this fair value gap. Your execution can be here with a stop loss higher. So is everything clear with Reaper, folks? I'll be moving to reclaimed order block, sorry, reclaimed breaker block. So before I do, I want to make sure that everything that I shared here is clear to each and every one of you. I saw a screenshot you shared in private group. Few of the trades has manipulation lag inside the macro. Is it okay? Yes, when price is doing this, this should be inside the macro must. Okay, this is a must rule. Our entries should always be inside the macro. Okay, folks. This setup, the formation can happen outside of the macro. As you can see, price did a high resistance liquidity run here, so we are expecting to see high resistance liquidity run outside macro. Inside macro, we are expecting to see low resistance liquidity run. So high resistance and low resistance liquidity run will get more cleared in our upcoming slides. So now I'll be taking you guys inside a new theory, reclaimed breaker. How can we use a breaker that fails? Okay, the same logic that I shared inside this slide. Let me show it to you all. Do you guys remember this slide? Here we talked about how to predict a new PD array forming in the new curve of the price action using old order blocks. Okay, so if you guys didn't understood anything here, I'll suggest, or if you guys missed it, I'll highly suggest you to watch it first and then watch the reclaimed order block, sorry, reclaimed breaker lecture. Okay, because if you don't understand this concept here, you won't understand the reclaimed breaker concept there. In this concept, I'll show you how to use a failed breaker. This concept here is same as reclaimed order block. Only difference is this time we will look at the price lag that has a stop hunt. So when I was talking about using reclaimed order block to predict new PD arrays, that time we didn't have a rule like price will have to have a stop hunt. But this time, as we are using old breaker, our rules say that we will have to have a stop hunt, okay, before we are choosing the old breaker to predict the new PD array. So how is the formations gonna be? So we have a sell side market maker sell model here. Do you guys identify any breaker here? Can you guys see it before me marking it? So as you can see, we have a higher high here, a new higher high. So these down close candles here are working as our breaker. Then we have another higher high, new higher high. So this down close candle here working as our breaker. So let me mark that for you. We have our old breaker here, right? We will project the last down close candle prior to the move up. Only difference is we will have to have a stop hunt this time, okay? And as you can see, we are only marking the PD arrays that has the last down close candle that has a move up with a stop hunt. As you can see, we have our last down close candle prior to this move up, and this move up cleared out the buy side liquidity from here, and then it went lower, right? We will not be marking a order block, the last down close candle, without a stop hunt, okay? We are not gonna mark this. We are only gonna mark this PD arrays when we are trying to predict a new PD array. But when we are using reclaimed breaker, this is the logic we will use, the price leg that has a stop hunt. So the rules are same as before. We'll be looking to see speed when price is going through the old breaker candle, the last down candle. We'll be expecting to see speed. Without speed, none of these concepts work, folks, okay? And then what we'll be looking for, here we have a different rule. Near to the old breaker, okay, folks, we will be expecting to see a new breaker forming, okay? So before, in our reclaimed order block, if you guys remember, I told you guys that we'll be looking for a fair value gap forming, okay, plus a new breaker. But using the old breaker, a fair value gap is more high probability. But using a old breaker, we'll be predicting a new breaker. This time we are not expecting to see a PD array forming here, but we are expecting to see price using the old old breaker to get support towards buy side liquidity, plus forming a new breaker near to the old breaker. And as you can see, price did actually form the breaker here. We have a low here, okay? Then price went up. You can buy here, or you can wait to see price forming a breaker, okay? This is a very high probability scenario. Price will form a breaker, folks. In a new price leg, in a new market maker buy model, there will always be a breaker that you will see, okay? So we have a low here, new lower low. This up close candle is working as a breaker, and as you can see, we will expect to see price forming a fair value gap here. Why? Because we have a old down close candle, old order block prior to a move up, and as I told you guys, when we have this, we expect to see a new fair value gap forming here. So we have a new fair value gap forming here. We can use it to buy. We also have another confirmation that price has a breaker here. We are only focusing on the price leg that did a stop hunt. The rules coming here again. When we are using reclaimed breaker, we are not using a down close candle without a stop hunt. When we are using a reclaimed order block, we are using the down close candle without a stop hunt. From market maker sell model to market maker buy model, last down close candle before a stop hunt, okay? So this is our market maker sell model, and we are expecting to see new PD arrays forming near to the old breaker. And for that, what are we gonna use? Last down close candle before a stop hunt. So we have our last down close candle before a stop hunt, last down close candle before a stop hunt. Here, no stop hunt, no stop hunt. These candles are order blocks, not reclaimed breaker. We will extend it out on time, and we will expect to see price forming a fair value gap right next to this old reclaimed order block. From market maker buy model to market maker sell model, last stop close candle before a stop hunt. So this here, I show you guys an example of market maker sell model to predict a market maker buy model, okay? But when you are predicting a market maker sell model from a buy model, you will be looking at the last up close candle before a stop hunt. I'll show you guys the formation in the actual chart, and that will make a little bit more sense. We'll be looking for old resistance to work as a support when we are looking looking for buys. Okay, so these are the old resistance levels that price used to uh, get resistance towards sell side liquidity, right? This was our old breaker, and as you can see, price came back up, retested the breaker, and then went lower. Here we will use the same level, okay, that previously provided resistance for price. Now we'll be using the same level to expect to see support in price. When price is going above the last down close candle from the sell side of the curve, it should show sign of speed and volatility. Okay, so when price is closing a candle's body above the last down close candle of reclaimed breaker, we want to see speed. A price can form a new PD area here, but we are not looking at that. We are looking at price using this level, this last down close candle before a stop hunt, for to get support towards buy side liquidity as a support level. Okay, we'll be looking for a new bear breaker to form near to the old breakers, just like we use reclaimed order block to look for new PD areas. How will you expect to see, and where will you expect to see a breaker forming? Okay, that's a very important question, and this is getting answered here. Near to the old breakers, you will expect to see the new breakers forming. That's the only thing that price does. You didn't know it so far, that's why you never saw it. Now go and look at your chart. You will see at the old breaker, near to the old breakers, price formed a new breaker. So let's look at the formation in the actual chart. We have a breaker formation here. We have a higher high, new higher high, price went below. This is our last down close candle prior to a move up with a stop hunt, right? So we'll be marking this last down close candle, and when price is coming near to it, we will expect to see speed, price going higher, closing a candle's body above, and then retesting this breaker to form a new breaker or to get support toward buy side liquidity. So this is our old breaker. Now we'll be using it as a reclaimed breaker. Why are we not using this down close candle here? Because this down close candle has no stop hunt. This here is a reclaimed order block. This here is a reclaimed breaker block. When we are using reclaimed order block, we are expecting to see a new fair value gap forming. When we are using an old breaker block, we are expecting to see a new breaker forming. Okay, I hope it's clear. Now let's look at this formation very close. We have this old order block, and as you can see, price went up as we expect to see. Price formed a new PD area here, new fair value gap. Plus at the same time, price used this fair value gap to get support. Our logic was from this last down close candle, this reclaimed order block, this should project a new PD area, and it did. Now how will we use this old breaker? We can use this old breaker to expect to see a new breaker forming, or we can use this breaker to get support towards buy side liquidity, to expect price to get support towards buy side liquidity. What do you see here? At this candle, price closed the candle's body higher, right? This candle closed higher above this last down close candle prior to this stop hunt, and this candle, as soon as price closed this candle here, we will expect to see the next candle coming lower, hitting inside the old breaker. This is the logic that we are using here. We are not using any logic from a candle here, okay, or this old order block, but we are using this old breaker to see price using it as a support. I hope it's clear, folks. And as you can see, price got support from here and continue its trend higher. Where will you put your stop loss here? You will put your stop loss right below this old breaker, okay? This week this week that you see, folks, this is where your stop loss will be. So here again, we are using very narrow stop loss, and we are targeting this swing high, the nearest drawn liquidity, or suppose if you can identify a relative equal high or unfilled fair value gap or something like this, we'll be targeting that. So anyway, you are getting a 2R with a stop loss down here. Price using reclaimed breaker to get support, okay? Old resistance turned into support. If you look close, you will see price is doing immediate rebalance from the reclaimed breaker. right here. Price is doing immediate rebalance after closing a candle's body above this last down close candle prior to this move up with a stop hunt from the reclaimed breaker as soon as it closed the candle's body above. So you will have to be fast in pushing button here. So as soon as price is coming down, okay, retesting this breaker, you will have to push the button here. If you are getting late in pushing the button here, you will miss the trade. That's it. There are no chance of entry here other than this fair value gap, but this fair value gap is not a surety. Okay, I'm not giving you 100% of guarantee that this fair value gap will form, but what I'm giving you a confirmation that with high probability price will repeat this scenario. This fair value gap can form here or not, but this thing will repeat. So you will have to be very first, do a lot of tape reading, a lot of back testing with this concept for you to execute here. If you do not do a lot of back testing or tape reading or demo trading, trust me, you will see it after, but you will see it in hindsight, but in the real actual chart you won't see it. So I'll show you guys another example with reclaimed breaker. This time we will see a choppy price action, and as you can see, it's very easy to outline, folks. The old breakers, you can easily outline it. The logic is very simple. Okay, so we have a higher high, new higher high here. We have our last down close candle. Price is using it as a breaker, right? So this is our old breaker that we will use to predict a new breaker. Do we have any other breaker here? Yes, look at here. We have a swing high here. Okay, sorry, so I forgot to mark these candles as bullish candles. So these are bullish candles. We have a swing high here. We have a relative equal high. Price came up, okay, cleared out the buy side liquidity from here. So this down close candle becomes our breaker. So we have another breaker here. So let's mark this. This is our breaker that we are marking. Then this is our breaker. We also have reclaimed order block that we'll be using to get to predict new PDRAs forming in our chart. So do you guys see how I put it everything, and now everything is coming together in our trading, right? I taught you guys the actual breaker, how a breaker forms. Now we know how a breaker forms, how many types of formation is there. Now we are talking about market maker buy model, what we will be expecting to see, when we will expect to see a new PDRA forming, when we will expect to see a new breaker forming, how price will use a old breaker to get support, everything, right? So as you can see, we want to see our rule says we want to see when price is going, when price is near to the last down close candle prior to a move up with a stop hunt. We want to see speed in price. And do we have a speed here? Yes, this candle moved higher, closed the candle's body above this last down close candle prior to this move up with a stop hunt. We are only focusing on the price leg that has a stop hunt. Okay, folks, I'm reminding you guys again. And as you can see, this fair value gap became our breakaway gap, okay, because this is lower and this is this fair value. So when price is forming a fair value gap inside the breaker, okay, inside the old breaker that we are using as a reclaimed breaker in the new price action, the fair value gaps that will form here, the fair value gaps will be low probability and it will work as a breakaway gap. Okay, that's how I outline a breakaway gap, and that's how I saw price not respecting a fair value gap, okay, because of the logic here. Now you can see that price formed another breaker here. We have a lower low, new lower low, so this up close candle becomes our breaker here, right? This is a this is a complex price action, folks. So before in our previous slide I showed you guys a easy price action, okay, but this here is what price will repeat often. So we have a order reclaimed breaker here. Now we will expect to see a new breaker forming here, plus price to get support from this old reclaimed breaker. And as you can see, we have a lower low, new lower low. These up close candles are working as a breaker. You can execute here with a stop loss below here, or you can execute at this candle As you can see at this candle, price is retesting this breaker, and I already taught you guys how to take entries here, right? We are seeing an immediate rebalance here, price is doing that, and we have also have a fair value gap here, a small fair value gap, a small little separation right here, right? So price will come down, hit this fair value gap. If you are missing entry here, then you can execute here, and you will expect to see price going higher. Once price is actually going higher, you will put your stop loss below here, below this last down close candle prior to this move up with a stop hunt, because if price is coming down and going below here, that means what? Price already hit a premium PD area, now it want to go lower. We don't want to see any retracement lower, folks. We want to see price continuing its trend, getting support from this breaker, and that's it. We want to see price forming a new breaker near to the old breaker. This is what price can do. Price can also do that, not form a breaker, but actually use this old reclaimed breaker to get support towards buy side liquidity. Yes, old buyers plus new buyers. Okay, so this is the logic that we are using. Just let me know that if everything is clear in our previous slide. We'll be moving forward into our next slide. Is everything clear that I shared here in the reclaimed breaker? So now, so far I showed you guys how to take like short-term entries targeting 2 hour max 4 hour. Okay, so the every single model that I shared with you all before, that model will generate minimum of 2 hour trade, and maximum you are holding is 4 hour. I will also show you how to predict your target using standard deviation, which is coming later in our lecture. But this time I will teach you how to hold trades by using higher time frame. Okay, we'll be executing a lower time frame, but we'll be holding trades according to the higher time frame PD area. When price is delivering liquidity in a trend aggressively one-sided, either buy side or sell side on higher time frame, we will expect to see price forming short-term liquidity levels after hitting a lower time frame PD area on lower time frame, and that's where our strategy will work best. I know it's a little bit of confusing because a lot of things we are putting here together, but once I show you the chart, the formation, everything just like before will make sense to you. In this strategy, we will use higher time frame PD areas for price to get support long, and for short we will be looking for price to get resistance from the higher time frame PD area. Our high probability breaker will form on lower time frame inside higher time frame PD area at optimal trade entry level. So when we are going to hold trades using higher time frame, we will be looking to execute on the higher time frame level, on the lower time frame at the OTE level. Okay, folks, it will make more sense once I show you the formation. In writing it becomes a little bit confusing, but when you see the actual chart it makes a lot more sense. So the formation that we will be looking at is gonna be on the higher time frame. So here we'll be looking for three types of formation on higher time frame. Okay, so as you guys as I told you guys that when price is in a trend, this strategy is only applicable when price is in a trend. Okay folks, so how will you know the price is trending? When price is generating consecutive down close candle or up close candle in a row, and price is leaving a fair value gap like this, this formation is happening on higher time frame. Okay folks, I'll take you guys on the lower time frame and you will see like how we will expect to see like a PDRA, a breaker forming inside here, and this level exactly will come at the OTE. This is the fair value gap. This is the first formation. The second formation that we'll be looking on the higher time frame is with the implied fair value gap. So what is the implied fair value gap? It's a hidden fair value gap. Okay folks, when we have a candle here and right next to we have two candles, right next to each other we have two candles, and the wicks are crossing each other. Okay, when price is doing that, these wicks will be measuring the wicks and will be marking the 0.5 level, the consequent encroachment of the both wicks, and this will be our implied fair value gap. The third formation will be with the volume imbalance. Okay, so this price action that I'm showing you here is forming on higher time frame folks. Remember, once price is retesting the level or coming back up inside this implied fair value gap or this fair value gap or this liquidity void, we will drop down to lower time frame and we will look for setup. There are rules. When price is coming back up, it will also have to generate relative equal lows for us to make the setup a high probability setup. So now we'll be looking for the formation on lower time frame. So here as you can see, we have this same price action repeating on 3 and 1 minute chart with a lot more candles. On 4-hour, hourly and 4-hour chart, you will see less candles, but we confirmed that price is trending. How did we know that price is trending? Price is having couple of consecutive down close candles in a row with an unfilled fair value gap, with an unfilled implied fair value gap, with an unfilled volume imbalance. So a question can be asked from you that why am I not showing you a order block here, or suppose other PDRAs here, because other PDRAs are not high probability as these PDRAs. So what I'm sharing here is my experience, the patterns that made me profitable. So you don't need to know about all the formation, but the formation that will actually make you profitable. So we have our fair value gap, implied fair value gap, and volume imbalance. Everything here is unfilled. Okay, so this price action is happening on 3 minute and 1 minute chart. Now what we will do is that we'll be marking the higher time frame PDRA. When we will wait for price to reach inside this higher time frame PDRA, and then we will look for a breaker forming. So suppose from where price will reject, okay, from where price will retrace and hit these unfilled PDRAs, we will expect to see price hitting a lower time frame discount PDRA. So what can be the lower time frame discount PDRA? Go back to the beginning where I shared the fifth rule, which is the target. We will have to have an unfilled fair value gap. We'll have to have an unfilled BPR, relative equal lows, unfilled new week opening gap or new day opening gap, and that's what makes our setup high probability. A high probability target makes our setup high probability. So suppose we have an unfilled fair value gap here, or an unfilled new week opening gap, a relative equal lows, price cleared it out. Now we will expect to see price retracing higher. Okay, so when price is doing that, it's going inside this volume imbalance, this implied fair value gap, and this fair value gap here, which was unfilled. Okay, and at the same time when price was going up, it's also generating relative equal lows. This is the same thing we want to see on lower time frame. Okay folks, if price is not generating this relative equal lows when it's going and reaching for the higher time frame PDRA, this is not a high probability setup. Trust me, it is not. What I'll suggest you to to avoid the setup. And here comes our higher time frame PDRA. On lower time frame, as you guys know, that higher time frame PDRA will be a lot more, it will take a lot more space. On lower time or on higher time frame, these PDRAs may seem a lot smaller, but on lower time frame this PDRA will become a lot higher. So that's the reason I put it another rule here, that we will look for price to reject from the OTE level, optimal trade entry level. Look at the last rule. Our high probability breaker will form on lower time frame inside higher time frame PDRA at optimal trade entry level. As our higher time frame PDRA is taking a lot more space on lower time frame, is confusing for us to get to select like from where price will exactly reject, right? So to give you more confirmation, you can add the OTE from this swing high to this low. Our OTE level will come somewhere here. If you measure it, the 0.62 and 0.79 level, these are the OTE levels, and it will come right here. Price hit our OTE, and do you guys see a breaker forming here? Yes, a breaker, it is here. So we can look for all the entries, all the patterns that I showed you guys before, the 7 high probability breakers, the Reaper formations. We can look for entries with breaker here. Okay, we can also look for entries with other formation that I showed you guys here. Once price hits the OTE, this is a turtle soup. So these lectures are specifically coming in the turtle soup. Turtle soup day. I'll teach you guys how to take entries right at the top here, but for that you will have to follow some rules. You will have to learn how to see the breaker first, okay, how to see the inversion first, and then the turtle soup will come, because this is the advanced is gas. Okay, the turtle soup is the advanced level of entry that I will teach you guys. And for me personally, to take entries with turtle soup, it took 2 years. So I started taking entries with turtle soup in 2022. So from that time I was mastering turtle soup, and so far I believe I did, and I was able to identify high probability setup with turtle soup, and that's what I'll be sharing in our coming days. Okay, so we have our breaker here. We don't have any other, sorry, we have a PDRA right here at the second leg, okay, of our breaker. So we can take an early entry from this breaker, right folks? We have our Reaper here. Inside the Reaper we have an inversion at a discount price lag. So what we will be expecting to see price doing next, we will be outlining this fair value gap, which is now inversion fair value gap, plus price confirmed that it wanna go lower, continue its trend lower from this inversion as it closed the candle's body below here. So this is the type of formation that you wanna see next. Price hitting this fair value gap and coming lower. So you can put other types of formation that I showed you in the previous slides here, okay, and you can repeat the same kind of logic again here when price is trading inside the higher time frame. So here another thing is that folks, price can also go up, okay, on the higher time frame. So we'll have to leave some room for when you are trading like this, okay. If price is generating an inversion like this, then you can only manage your stop loss very narrow. You can put your stop loss up here, but suppose there's no fair value gap here, so where will you put your stop loss? Same again here. Or if you are patient enough and you watched price closing a candle's body below the breaker, you can execute at this candle right here, which did a immediate rebalance at this breaker with a stop loss above here. We still have our high probability target left intact, right? Price didn't clear out this really equal low, so we can target it. This formation alone will generate you 2R, and if you are holding longer, targeting a higher time frame level, then these trades alone will give you minimum of 5R. What I was getting is like 1 to 8R, but these are very rare. Okay, these are very rarely happens on the higher time frame, because I shared very specific formation, folks. Unfilled fair value gap, implied fair value gap, and then a volume imbalance. Each and every one of these are unfilled. Plus there are rules. Price will have to be in a trend. Price will have to hit the OTE. Price will have to generate relative equal lows. So a couple of rules here. If everything is aligned and you can see the setup forming on lower time frame, do not hesitate to take it. Here inside here we'll be looking for 7 types of fair value gap, 7 types of breaker that I showed you guys forming here. Okay, this can form here. We can also have PDRAs inside Reaper, we can have an inversion in the premium leg of the breaker, or we can have a fair value gap at the discount leg of the breaker. So any type of formation can form here. This is not a specific formation that this breaker will form. No, it's not like this. Any types of seven breaker that I showed you guys, the high probability breaker, it will form here. And when price is activating this breaker or hitting this OTE, our time will match too. Okay, price will also hit this OTE level plus this inversion, plus price will activate this breaker inside our macro time periods. So I hope everything is clear here. Let me know in the chat if you guys have anything to understand more here when breaker is in a trend. Now we'll be moving forward to our next slide, which is time distortion with breaker, understanding high resistance liquidity run and low resistance liquidity run. Plus this concept will help us to avoid high resistance liquidity run. The algorithm refers to time first, not just simply a price run. So we are looking at time before looking for any types of setup. Okay, before we look for a breaker form, we are looking at the time. Our time will have to match with the breaker. Okay, I shared with you all the manipulation macro. This is when price will do market structure shift. Then I shared with you all the macros that are like trend that will continue the trend. So it's all there in the beginning of the lecture. So if you go back and listen to it, you will be able to see it. Okay, so we focus inside macros because that's when price does the expansion, delivers liquidity with low resistance. Outside macro, price will most of the time will deliver liquidity with high resistance, means price will get choppy. Okay, that's the time we expect to see price becoming choppy. Outside macro, price will do consolidation, seek and destroy, manipulation. Simply, if I put it this way, macro is low resistance liquidity run, that means high probability. Outside macro, high resistance liquidity run, that means low probability. So we'll be avoiding everything that is outside of the time periods that I shared with you all. If you want to be a little bit more cautious, you can use the time periods that I personally use, and I refer to it as HYDRA's high probability macros. Okay, those macros are very high probability, but you can, it depends on you what macros you are using. I shared all the high probability macros, and that's the macros that you can use. So what do you see here? Okay, we have a low resistance liquidity run here. Price is not choppy here. Simply just think like this. Okay, folks, you don't have to use complex logic to identify high resistance or low resistance liquidity run. When price is not choppy and delivering one-sided, that's when it is low resistant. Okay, when price is getting choppy, like here, look at that. We know the price is gonna clear out this swing high, but is it clearing out like straight like it did here? This movement here in price was a straight movement, but here, as you can see, this movement is not a straight but a choppy price action, right? Price also generated a breaker here, but never activated this breaker, rather continued higher and cleared out the buy side liquidity here. So don't worry, this type of price action that you see formed here forms usually outside of our macros. So the low resistance liquidity run is happening inside our macro. high resistance liquidity run that you see here is happening outside of the macro. Go and look at your ES chart right now. You'll see the same thing happening. The macros that I shared inside the time period, most of the time, no, I'm not guaranteeing you that 100% of the time, but if you only look at today's chart, you will find out that most of the time price did low resistance liquidity run inside macro. Outside macro, most of the time price was doing high resistance liquidity run or consolidation or manipulation or seek and destroy. So inside macro, we expect to see low resistance liquidity run. Outside macro, we expect to see high resistance liquidity run. So once price get backs inside the macro, we'll be expecting to see low resistance liquidity run. So I hope this concept of high resistance and low resistance liquidity run is clear to you folks, because it's very simple, folks. We are looking for price to deliver liquidity with speed. And when it happens, when is it happening inside our macro? Outside of our macro, we are avoiding taking any types of trade or predicting what's going to happen. All of our analysis should be inside of our macro, and that's what's happening here. The examples that I showed you guys, okay, if you go back and look at the examples, you will see that the high resistance liquidity run is when the high resistance liquidity run is happening, price is generating targets for us, okay, relative equal lows. That's when the relative equal lows gets generated, okay. And inside our macro period, when price is hitting a high probability PDRS, suppose a fair value gap at discount with breaker, or a fair value gap at premium at breaker, or a inversion fair value gap at discount or premium, either of these, when price is hitting it, that price action is hitting inside that price action is happening inside our macro levels. When price is coming inside the macro, this is the price action that we expect, a speedy price action with less choppiness, right? Compared to this choppiness here, price is way more clear here. So is it clear in this slide? Everything that I talked about, is it clear now? Do you understand the high resistance and the low resistance liquidity run that I showed in the previous charts? Is it clear, folks? Do we have to close trade if we do not hit target before macro starts, before macro overs? Yes, I'll highly suggest you guys to close your setup if you are already in a trade, that if price is going after like the macro, going outside the macro, and you are already in a trade, close it. There's no need to hope, because we have a lot of macros, okay, and we are only looking for 7 high probability setup. We are looking for these things to repeat in price, and inside either one of the macros you will find that this price is repeating either one of the setup very clean way, and that's when you execute. So the rule is you will have to be very patient, okay. What are you saying, Dr. G? Is the entry time always between X50 to X10? Doctor, I think you didn't heard when I was talking about the macros. I'll suggest you to go back and listen to the lectures again. I already talked about it. So now I'll be taking you guys in the next slide, implementing standard deviation to project target. Okay, so how this alone will give us more confirmation that we can hold our trades. So suppose if we have a target lower and it's also aligning with the standard deviation, then we can use it to hold our trades. Standard deviation is used to project a measured move of a specific price lag, okay. What price lag we'll be measuring, I'll also share that with you here. The best way to project price is by using manipulation lag. The price lag that did the stop hunt, we'll be measuring the lag and we'll be projecting it out on future, and we'll be targeting those levels. So this is the 5th setting from our mentor for our standard deviation projection, okay. I'm putting it here so that it becomes easier for you guys to use it. how can we use standard deviation with breaker? So we have our breaker here, higher high, new higher high. We have our last down close candle that are working here as a breaker. So where's the manipulation lag here? We'll be using this manipulation lag to predict pre-D arrays. Sorry, to predict targets by using standard deviation. Can these macros be used for features? Everything that I'm talking here, AMCO can be used in features. Okay, this is only for features. Everything that I'm sharing here can also be used in forex and crypto, but it is high probability for stocks, specifically features. So we have our manipulation lag here. What we'll be doing is that we'll measure this manipulation lag and project the prices. This is the price lag that we will use to project our target. And how will we do it? We'll put our fib according to the settings here from this high to this low, and we'll be targeting -1 standard deviation, -2 standard deviation. Okay folks, these are like the golden targets. I'll share more targets. There are golden targets that are coming in the next slide, but just for now, know that -1 standard deviation and -2 standard deviation is ideal for us to hold trades. So once price goes below a breaker and activates the breaker, we will expect to see price continuing its trend at the next candle. Okay, and as you can see, price did continue its trend at the very next candles. Price hit the 1 standard deviation. That's where we will take a partial. Or suppose if you took a entry from this fair value gap, right? Do you guys see a fair value gap here, which is coming inside our Reaper, right? We also have an order block here. So if you are taking your entries here, your TP can be here, and you will get more than 3R. I think if you are targeting here with 1 standard deviation, you will get easily 4R because your stop loss is here, right? -1 standard deviation is our low hanging fruit, that if price is activating a breaker, price will also hit -1 standard deviation with high probability, and this is our low hanging fruit. This is our nearest level of target. -2 standard deviation from breaker. Manipulation leg can also be used as a market reversal zone. -2 standard deviation, I consider it as a good delivery, usually presents an opportunity to get 2 to 3R. So if you are executing from this breaker here, you will get more than 2R, more like 3 to 4R. So most of the time, if I'm holding a trade longer, suppose I had an early entry from here, I'm holding till -2 standard deviation, because that's an ideal lag for price to reverse. Okay, so we are not just using this standard deviation blindly to like see price getting rejected from -1 or -2 standard deviation. We will also use other PDRs that I will show you guys in our coming in another day. Okay, we still have 3 or 4 topics left from our today's lecture that I'll be sharing with you all in our upcoming days. Okay, so I hope everything is clear using how we can use standard deviation to project target. This is what gives us a little bit of extra confirmation in price, and this is what we can use to project our target and get confidence in our trade. Implementing standard deviation to project target golden reversal levels. So sometimes you will see that price is not rejecting from the -2 standard deviation, which I showed you guys as an ideal place for reversal, but this is not 100%. If price is still coming down and continuing its trend lower, we have other two levels from where we will expect to see price getting reversed. So what are the two levels? Negative 6.5 standard deviation and negative 6 standard deviation. And how will we know that price will go there? For that, we'll have to wait patiently for my upcoming lectures. That's where I will show you guys that how to predict this, how to predict the price will come down all the way here. From the breaker manipulation leg, these levels are ideal place for price to reverse if price is not reversing from the negative 2 standard deviation. Your ideal reversal zone must be aligned with higher time frame PDRA. Reason higher time frame PDRA is always greater than lower time frame PDRA. So this reversal zone has a logic behind it. Negative 2 standard deviation, negative 6.5 and 6 standard deviation. This has a logic, and this logic will be shared in our upcoming lectures, okay, with a lot of examples, just like I showed you guys before in our breaker formations. Now this is the last lecture before we are moving towards our final lecture. Okay, this is our last topic before we are moving towards our next topic. So importance of 20, 40 and 80 levels in price. These levels, okay, so suppose price is trading at 1920, 1940, 1980. These levels will work as a strong support or resistance level. Okay folks, so these levels in price are very important. So suppose if 20, 40 or 80 level is aligning with our breaker trade, we can use these levels, these price levels, as a extra confidence. What I'm showing you here is we are not using these levels to take trades, but we are using these levels to get confidence in our trades. Okay, that's what matters. And mental health, I had to do a lot of things to find out these things, and what these things helped me is that it helped a lot to improve my mental confidence. Okay, if price is forming a fair value gap inside 20 level or inversion at 40 or 80 level, that's what working as extra confirmation for me. So what are these? In stock price is very sensitive when it's delivering liquidity at 20, 40 and 80 levels. You will see price using these levels as a support or resistance. So how will you know the price will use one of these specific levels as a support or as a resistance? It will depend on the setup. Okay, so suppose if the setup is a bearish setup, then we will wait to see price getting resistance, okay, from these levels. But if these setups are bullish setup, then we will use these levels to get support for price towards buy side liquidity. We can use these levels as a support and resistance to get a narrative on price. We are not using these levels to execute on a trade, rather we are using it as a narrative, like why price should go there. Okay, I can see a 20 level. Okay, I can also see a breaker with a fair value gap, so a lot of things are aligning, right? So these levels will work as extra confirmation in our trades. So this is gonna be our last lecture in today's the first day of our breaker. Okay folks, I know like this lecture is like 4 hours now, right? So me personally, I've been talking since then. That's the reason I put it away 3 or 4 topics for another day, because I believe it requires a little bit more time, right? Everything putting together is not good. So this is our 4 candle formation. And what is this? We'll be looking at this here. When price is trading inside a lower time frame high probability PDRA, we can use 4 candle formation to expect speed in price. Now we will use this theory to predict to count candles. Okay, this is the only time I count candles to get a confirmation from price that it will continue its trend higher or lower. The theory can also be used on higher time frame to decide bias. Okay, this theory I personally use it on lower time frame, but you can use it on higher time frame to get a narrative or to decide your bias. We will have a separated lecture on how to decide bias in our coming trading in our coming lecture days. So what do you guys see here? What do you guys see here? We have a fair value gap forming here, right? Alongside with the order block, this is, sorry, alongside with the mitigation block, this is not a breaker. Why? Because price didn't do a stop hunt here, right? So what's the logic of 4 candle formation? A 4 candle formation is like we are predicting price to expand at the 4 candle once price hits a high probability PD area. So we have a fair value gap here, right? I'll take you guys a little bit back. We have a fair value gap here. So once price hits the fair value gap, we'll start counting the candle. Price hit the fair value gap at the first candle. This is our first candle. This is our second candle. At the third and the fourth candle, we expect to see expansion. Okay, first and second candle can stay inside the fair value gap, but if price is not rejecting from here, we will expect to see price rejecting with speed at the third and the fourth candle. The same logic can also be used when we are trading with breaker. Okay, suppose price is this is a breaker. Suppose this is a breaker and price did a stop hunt here. We have a fair value gap, which is a high probability setup, right? So what we will do that when once price hits the fair value gap inside the breaker, we'll start counting the candle. The first candle, we are expecting it to stay inside the breaker. The second candle, if we are not already seeing the expansion towards sell side liquidity, we will continue counting the candle. The third candle and the fourth candle, this is when we will expect to see price getting volatile or speed or continuing its trend towards sell side liquidity. Tips: as soon as price steps inside our high probability PD array, we will start counting the candle. We will expect to see price getting speed or breakout from the PD array at the fourth candle. Okay, so third or the fourth candle, we will expect to see price getting. No, the fifth candle we do not count it. Okay, we only count till fourth. If price is not showing any expansion at the fourth candle, fifth candle doesn't matter, we will close our trade. So this rule is only applicable with four candles. That's it. We are not counting candles after that. The same logic, the same price action can repeat on higher time frame. So when it's repeating, we can use the same logic there. Okay, folks. So this is the end of our first day of breaker, and I hope you guys found everything useful. Yes, we can look for this 4 candle formation in any time frame. Basically on lower time frame it can be 5 minute, 10 minute. This is not bound with rules. What is bound with rule? The formation that I showed you guys on breaker, that is what is bound with rules. Okay, so I hope you guys enjoyed and found my lecture informative. I'll close it here, and most probably our inversion lecture, which was supposed to be occurring on 24th October, will get delayed. So if it's getting delayed, I'll let you guys know. And till then, if you guys have any questions, folks, you can ask me in the Telegram group. We have a group there, right? So suppose you have a question, or if you are not you didn't understood this topic even after listening my lecture again, you can ask for more examples, and I would love to show you guys more examples on specific topics that is confusing to you in our coming lecture days. Okay, folks? Okay, sorry, there's a mistake here. Okay, so these candles were supposed to be down close candles. Anyway, folks, you understood the logic, right? So I'll be providing a new template for this slide, because here the candles was supposed to be like black, but I drew it here with I put it with mistake on like the green candles. Everything that you show here inside the templates, everything I draw it from my mind. Like with 3 years of experience, I saw this price action repeating so many times, it like stuck in my mind. Okay, So if I see this formation, only this formation, I'm only executing at that time. So the folks who missed the first half, I'll highly request you to see watch it again, because a lot of things will not make sense to you in the next half part of the lecture, because at the first part I explained it already. So I'll catch you guys in our next lecture, which will be on 24th. Hopefully I will not get it delayed. If I can finish it, if I can finish making all the contents, I'll present my lecture on 24th, which will be on inversion. And this lecture was 4 hour long, folks. I shared from the basic level to the advanced level of breaker. So I hope you guys understood. I'm saying it again. If you guys have any question, you can ask me in the Telegram group. I'll be available there. If you are hesitating answering it in the public group, you can text me personally or email me with the template, and I'll love to share more examples about that. Till then, peace guys, and I'll catch you guys later. And the PDFs, okay, so the PDFs are not free. If you are interested, you can already take the screenshot. I'm streaming on 4K, but if you are not satisfied with the quality, you can buy these templates or PDFs. I'll be selling these PDFs for $30 for each session. So if you want all the PDFs, all the templates, I shared over 40 templates here. Okay, folks, so let me check how many templates I shared here. Over 38 templates. Okay, so the 38 templates, if you want all of these in high quality, just let me know, and you can pay me via PayPal to get all of these, plus a recording version, because everything was here coming with after one another, right? So if you are taking screenshots, then you will not understand like what I showed you here, what formation was coming after what formation. But if you want to buy it, you can buy it from me. I will share the recordings as it is, with each and every slide coming after each other. So till then, folks, take care, and I'll catch you guys later. I'm closing it here. Peace.
Hello folks, good morning. So in this recording, I'll show you guys how I use higher time frame breaker to execute on lower time frame. Okay, so this will be another theory that we'll discuss in our coming lecture days, but today I'll just show you guys a hint of how I use higher time frame breaker and how I execute by using a higher time frame breaker on lower time frame, specifically on 1 minute and 3 minute chart. So as you guys can see, I'm showing you guys a chart from hourly on Dow, and we have a lower low here and then a new lower low right here. So price went below this low, did a stop hunt, and then retraced higher. These up close candle, all of this becomes our breaker. But when we are outlining a higher time frame breaker, we are not gonna be outlining all of it. Okay, our best reaction from a breaker will happen from the last up close candle in a bullish breaker, in a bullish scenario. Okay, so when we are looking at higher time frame breaker, we'll wait for price to go inside the breaker that we have the last bullish candle and close the candle's body above. Okay, just like it did here, and we'll only mark this one because we are looking at higher time frame, so the fluctuations that you will see, it will happen very less. But as we are trading on lower time frame, once we draw down to lower time frame, drop down to lower time frame, you guys will see how I use the movements, because on lower time frame we expect a lot more movements, a lot more retracement than higher time frame. So as I told you guys, on higher time frame we'll only be focusing inside this last up close candle, and once price closes a candle's body above the last up close candle on higher time frame, that's the time when we will drop down to the lower time frame and see what's happening there. So on higher time frame, if we see a breaker, we'll wait for price to close a candle's body above, and then we will drop down to 3 or 1 minute and look for another breaker forming inside our macros. Okay, so you can see here the price close a candle's body above. Once I drop down to the lower time frame, you guys will see the price forming another breaker inside this breaker on lower time frame. Okay, that's how it works. I'm not teaching you to execute on higher time frame. I'm teaching you how to scale on lower time frame using higher time frame PTA. So we are not executing on higher time frame in this breaker, okay, but we'll be executing on lower time frame using the logic from this breaker. Now we know that our bias is bullish. Price closed the candles body above this breaker. That means what? Price activated this breaker. Now we are on 1 minute chart on Dow, and as you guys can see, price closed the candles body above on higher time frame, right? And this blue shaded box is our higher time frame breaker, and price is trading above it right now. But we'll be looking inside this breaker to find a breaker, okay, inside this higher time frame breaker to find a breaker on lower time frame. So first we will mark from where price can possibly reverse, okay. So the best place for price to reverse is after taking out relative equal lows. That's what I basically focus when I'm trading with breaker. Either I'm targeting the relative equal high or lows, or I'm waiting for price to clear out a relative equal high and low, then possibly generate a breaker. So do you guys see any relative equal lows down here? We know that from higher time frame our bias is bullish, so we'll be looking for a bullish breaker to form. Look at these lows here. What are these lows? These are relative equal lows, okay. Price didn't go below this low, so we don't have any breaker here. Price is trading off mitigation blocks and order blocks here. Then we have trend line liquidity right here. If you put a trend line here, it will very beautifully respect it. Then here at this low we have relative equal lows down here, okay. Once we drop down to lower time frame, we will identify the best place for price to reverse. Your best liquidity is relative equal high and low for market to reverse. So at first we will identify on lower time frame if we see any equal low and equal high. Okay, so how we will spot it? We'll spot it based on the higher time frame order flow. From the higher time frame order flow, we know the price to close the candles body above the hourly breaker, so we know that our bias is bullish and we have a short-term target here like higher time frame buy side liquidity, and we were able to identify relative equal lows on the downside. Now we will wait for price to clear it out and get inside our macro. As you guys can see, price came all the way down, cleared out all the liquidity levels, and price is now trading inside our macro, okay. When price was trading here, it was inside 920 to 940 macro, but there was no possible or potential breaker that formed here, right? Do you guys see it? There was no stop hunt here. There's no stop hunt here either. Price only did stop hunt at this level, and we are looking for bullish trade. So that's the reason we are waiting for price to get inside our macro, and price actually did got inside our macro here. From higher time frame, we know that our bias is bullish, so we will be looking for bullish breaker to form inside our macro. Now we are getting inside 950 to 1010 macro, and do you guys see any breaker here? Price basically cleared out the relative equal lows from here. Now we are inside our macro. Now we'll be looking for a potential setup, right? A breaker here. We do have a breaker here, the last stop close candle. So let's see if price forms any potential setup here, or we'll wait for price to get inside our silver bullet macro, okay. We are not trading inside a silver bullet randomly, but we are focusing inside one specific time period. What is it? 1020 to 1040. So price basically closed the 950 to 1010 macro. Here's nothing more to watch, so we'll be waiting for price to get inside 1020 to 1040 macro. Before we do that, can we identify any more relative equal highs? Yes, as you guys can see, we have relative equal highs up here, then up here. Ultimately we will be targeting this relative equal high from the higher time frame. So this is our potential breaker, right? We have our low here, lower low, new lower low. Now these up close candles here are working as a potential breaker. And as you guys can see, price came price delivered buy side liquidity, and it closed the candles body above here, above the breaker. And look at the time right now, 1020 to 1040. Inside the time period, I told you guys that a breaker will form just exactly. I teach you that you will wait for price to close the candle's body above, and then you will execute from that, okay, at the next candle. There are other ways to execute. I also taught you guys that in our first day of bootcamp. So this is a high probability breaker. It's the price activated the breaker at 10:20 to 10:40, but look, price, when did price form this breaker? Before our macro started. So price can form a breaker before our macro starts, but we'll be looking at price to activate our breaker, okay, when we are trading inside a macro. And just like this, price will activate a macro activate a breaker inside a macro like this. And as you can see, it's our silver bullet macro 10:20 to 10:40. Price did close the candle's body above, and then at the next candle we execute. This is our rule, and we target minimum 2R. The max that I go is 4R, but basically I'm trading for 2 to 3R, okay? So it was a beautiful trade that I took last week. This is the same logic that I use from the higher time frame to trade on lower time frame. Now I will take you guys on the same chart, okay, another day. As you guys can see here, this is the same breaker that we traded here on Monday, okay. Now we'll be looking at Tuesday, and price is now retracing back to this breaker. Now there are a couple of rules when price is trading back to a old breaker. We'll be using those rules, and now I'll be sharing those rules with you all. But this is a very important lecture. That's the reason I didn't share it in the first day. In our coming lecture days, I'll be talking a lot deeper about these rules. When price is passing through a breaker, we expect immediate rebalance. So price did pass from this breaker, right? Do you guys remember the second slide that I showed you guys? Price closed the candle's body above our last up close candle from this hourly chart, and then we dropped down to the lower time frame and we traded a bullish breaker, right? So this is the same thing happened here. When price is closing a candle's body above for the first time in a breaker, we'll expect to see an immediate rebalance like this. When price is retracing, we'll also talk about that. So when price is retracing back to a previous breaker, we will expect rejection from the last bullish candle breaker. We are not expecting to see price drop a lot, but we will expect to see price rejecting or getting support from this last up close candle, okay. That's the only candle that we'll be looking at on higher time frame. Price will be sensitive at these levels, 0.75% and 0.25%. So what we will do, we'll measure the last up close candle like this, okay, and we'll be looking at 0.75 and 0.5 level, because these are premium levels. This is a premium level, this is a discount level according to the measurement of this last up close candle, and this is where price will be sensitive, and this is how I use a higher time frame breaker, okay. I'm not looking at all the bullish candle, but I'm looking at the last up close candle. When price closes the candle's body above, then I'm looking at the immediate rebalance if price is doing that, and when price is retracing back to the breaker, I'm measuring the last up close candle and expecting a bullish breaker to form at the 0.5 level. Once I drop down to the lower time frame, you guys will see a breaker will form here, okay. So now you guys know that when price is retracing back to an old breaker, how to trade from it. We'll measure it, then we will wait for price to get sensitive at these levels. Our high probability setup will form at 0.5% most of the time, okay. Most of the time you will see price getting back to the discount level according to the measurement of this last bullish candle, and this is where we will wait for price to form a breaker. But sometimes what price does it, like when it's trading inside here 0.75, it also does form a breaker, but our high probability is 0.5. And this theory is only applicable on higher time frame. When we are trading on lower time frame, we'll consider all of the up close candles, okay, because on lower time frame a lot of fluctuations, a lot of movement can happen. which on higher time frame is very less of the time it happens. Okay, even price is having a lot more volatility on higher time frame, we are safe. That's the reason we on higher time frame we are using the last up close candle, but on lower time frame we'll be using all of these up close candles or down close candles if you are trading from a bearish breaker. So now let's look at another rule. When price is retracing back to a old breaker, okay, we'll be expecting to see high resistance liquidity run. So what do I mean by that? When price is retracing back to a old breaker, we'll expect to see price delivering in a high resistance liquidity run like this. Look at the delivery here. That's what I call a low resistance liquidity run price, because price is in a hurry to deliver liquidity to a certain level. But here price is not in a hurry. Price is just trading like in a seek and destroy mode, plus delivering with a lot of choppiness, less volatility, right? So when price is racing back to a previous breaker, we want to see it deliver in high resistance liquidity run and generate equal high and equal low. So when price will generate equal high and equal low, it will work as a high probability target for us. We are expecting to see a reversal from this breaker, right? So we need target for that. And what can be a good target, any better target than a relative equal high or low? Relative equal high and low, folks, it works as a magnet for price. And high resistance liquidity run generates high probability target for us as we are trading with a reversal model. We are trading here with a reversal model, right? We are expecting price to reverse from certain levels with a breaker. So we need high probability target for us to execute. And I hope you guys understood. When price is retracing back to a previous breaker or an old breaker, we will expect to see price delivering in high resistance liquidity run and generate relative equal highs for us, and that will work as a strong target when we will drop down to lower time frame, and it will give us much more confidence in our trade. Like, we are not just holding randomly, we are targeting a certain price level. We want to see price going there, and it's all based on logic. I also hope that you guys understood it. If not, a deep lecture will be coming very soon in our coming trading lecture days. So now I'll take you guys on the 1 minute chart, okay? And as you guys can see, this is our higher time frame breaker, the hourly breaker that I showed you guys, and this is the measurement of the last bullish candle. And as I told you guys, that a high probability breaker will form on lower time frame inside the 0.5 level from the higher time frame breaker, right? So what do you guys see here? Price is trading inside our 920 to 940 macro. This is my high probability macro. This is the highest probability macro that I use, and we have a swing low right here. Price cleared out a swing low, then we have relative last bullish candle working as a breaker here, plus we have relative equal highs here, then we have relative equal highs here, then ultimately we have a lot of relative equal highs up above this swing high, right? Near to this swing high. So we have a lot of relative equal highs resting towards buy side liquidity, and price is trading now inside the 0.5%, where we expect to see a breaker forming. So do you see now how everything is aligning with time and logic? So we have a low here, we have our last bullish candle working as a breaker here. Now we'll wait for price to close the candle's body above, and we will expect to see an immediate rebalance. Okay, when price is going through a breaker, we'll expect to see immediate rebalance. When price is retracing back to a breaker, we'll expect to see price delivering high resistance liquidity run, plus generate high probability target for us. Okay, so price cleared out the relative equal low swing low from here. This last up close candle working as our breaker, and as you can see, price closed the candle's body above the breaker inside our macro, and then this candle, when this candle opened, it came right down to the breaker, and this is what I call immediate rebalance. I already showed you guys a couple of examples in our first day of lecture, and as you can see, price did came down here. You will have enough time, folks, to execute here, or any level here when price is retracing back to our breaker inside here, okay? And then when once you execute here, your stop loss will be below the breaker, okay? Because on lower time frame we are considering all of these down up close candles as our breaker. On higher time frame we are only considering the last one, okay? And then you will be targeting 2 hour, or if you are holding all the way up here, I believe it was a 3 hour trade that I took last week. So I hope you guys found this trade review session informative. A lot more trade reviews will come in future. This week I will drop a lot more, and plus our lecture on inversion, it was supposed to be on 24th October, and it's not gonna be happening at 24th October because I'm yet to done making a lot of templates for you all, so I'm not done yet. So I believe will be I will give you guys the lecture on inversion on 28th October. Okay, folks, you guys will just have to be patient, and I'll share these kind of jams, this kind of review videos in between this time period. So our next lecture is going to happen on 28th October at 3 p.m. Eastern Standard Time. Okay, folks, so I'll catch you guys then, and in between I'll do a lot more reviews. Peace. Hello, folks. Welcome to our day 2 of 3-day HYDRA workshop. Our day 2 is gonna be about macro profiles and inversion. So just confirm me if you can hear me loud and clear, and after that we'll start. Good afternoon, Sylvia. It's 2:30 here, and it's a very nice day. It's a sunny day. The last couple of sunny days before winter gets started, right? So I was like outside enjoying the weather. So I just came back home to deliver what I was supposed to hear. Thank you, Sylvia, for letting me know. We'll start. I'll wait just 2-3 minutes more for couple more people to join. I'll give them time as we are supposed to start at 3, but I'm gonna start at 2:30. Mr. Man is saying, could you do a quick trade breakdown of Dow trade from Friday? On Friday at the end, I'll keep that in mind, Mr. Man. If I forget at the end, and if you're still here, just remind me. I think the mic is good from my side, Vatuan. So if you just check your volume, I believe it will work out. Volume is a bit low. Okay, I'm just gonna increase a little bit. I hope you guys can hear me now. I changed the volume a little bit more. Okay, so let's start, folks. Okay, so today I'm gonna share a couple of profiles with you all. That these are the only things that I look in chart when price is inside macros. Okay, I already shared macro time periods in our day 1 lecture. So today I'm gonna share the profile of like the whole market structure that happens and what I look for inside this macro time period. In day 1 I shared the setups with breaker, right? So we'll also be looking for breakers in our market profile. Plus today I'll share another entry model with you all, inversion. Okay, in our day 1 we already talked about a couple of inversion setups with breaker, but today specifically we'll be talking about how to take entries by using failed fair value gaps. Okay, this is gonna be different from what ICT is already teaching in his mentorship and on free YouTube. So I hope you guys will find it informative and educational. Thank you, folks. So let's start. So this is our day 2 of macro profiles and inversion. In our day 2 topic, I'll be talking about 3 topics. Okay, so the first one is gonna be AMD cycle at macro. I'll be sharing the complete market structure of what I look for, only the high probability condition. Okay, and the market structure that I'm about to share with you all is gonna repeat every single day. Okay, it's very easy to look at. If you just go on your own chart after I'm done sharing the profiles, review Friday, the week before, and the even months before. As long as you want to go back and just look at the macro time periods, like suppose 820 to 840, 920 to 940. We have a couple of macros, right? So the market structure that I'm gonna share with you all here, if you just go on your chart and look at the time intervals, these 20-minute time intervals, you will see the same specific price action repeating again and again. Okay, so our first topic will be AMD cycle, accumulation, manipulation, and distribution. How price does it inside macro, how price generates liquidity, what kind of liquidity price generates before getting inside the macro zones. The second topic is going to be about macro profiles, high probability market condition. Okay, and the third one is going to be high probability inversion and the profile to trade
using the inversion models. Okay, so these are the three topics that I'm gonna cover today, and that's gonna be all. So let's start with our first topic. Let's discuss something before we start our first topic. Let's talk about AMD. Price repeats some common market structure inside macros. So today we'll see these common patterns, and the six or seven pattern that I'm about to share with you all is gonna repeat again and again as I'm saying it. We will look for three stages of delivery in price action at macro: accumulation, manipulation, and distribution. These are the three phases that will occur inside 20-minute time interval. Okay, I'm only teaching you how to trade inside macros. When price is not trading inside macros, we'll just avoid what's happening. We don't need to know what price is doing outside of the macros. Okay, our setup will form before the macro gets started, but our setup will get activated inside the macro. So these are the three phases. Accumulation, most of the time it will happen before the macro gets started. Okay, so suppose there is a macro 920 to 940. The accumulation of orders, this phase will get started at 9 to 910. Inside this time period, accumulation of orders. Manipulation is gonna happen at suppose 911 to 920 inside the time period. Okay, and the distribution, that's what we expect to see inside macros. Okay, so three phases: accumulation, manipulation, distribution. Is very easy to understand. The way I'm gonna show you all, I believe, is the easiest way to understand market structure. Understanding AMD cycle will give you an idea of how price engineers liquidity. Okay, so we are not going to be covering all types of liquidity today, but we'll cover high probability market liquidities like relative equal highs, trend line liquidity, when price is consolidating, how to trade that. Accumulation, we expect to see it before macro. Accumulation can come in before macro. Okay, so most of the time in high probability condition, you will see that accumulation, this phase is happening before macro is getting started. Okay, price will engineer liquidity, and that's what we will refer as accumulation of orders. Manipulation, we expect to see it at macro. If manipulation is happening inside macro, it's a high probability condition. If there are some conditions when manipulation will occur before macro, and that we will consider as a low probability condition. We are looking for specific things inside time, folks. We have a lot of macros, so if price is not manipulating inside macro, we'll just avoid this macro and look and wait for another macro to start. And the last phase is going to be about distribution. Mostly in a high probability condition happens at macro. Okay, it's not 100% of the time, but most of the time. Okay, so, suppose 80 to 90% of the time in a day, in an intraday session, you will see price delivering liquidity from one swing low to another swing low, one discount PD area to another premium PD area, one premium PD area to another discount PD area inside macros. That's how price delivers liquidity. So these are the three topics that I'm going to cover with market structure, complete market structure. So let's start with our high probability macro profile 1. Okay, this is the first macro profile that I'm going to share with you all. So for that, let's look at the structure. So this is the structure that we are looking at. Price is consolidating here. Okay, we have relative equal high here, relative equal low here, below this swing low. It's just a structure. I'm going to show you the whole market and how this looks inside market very soon, so hang on. This is one of the highest probability market structure that forms at macro. Okay, this condition right here that you are seeing is the highest macro condition. That's why I put it in the number 1 spot, because this repeats every single day. Okay, if you are patient enough, you will see it repeating inside either 1 or 2 macros every day. In this condition, price generates liquidity in a form of relative equal high or low in both sides of the market. Okay, we are not considering what's happening in price before this phase. Okay, here as you can see, price is consolidating, but before price delivered liquidity very nicely. So we are just avoiding what's happening here. We are focusing inside this price fractal, where price generated relative equal high and low in the both sides of the marketplace. High probability in this condition, when price generates liquidity in both sides, okay, relative equal high and relative equal low, is to wait for price to show its hand. Okay, and how will we know the price is showing its hand to us? We will wait for price to deliver liquidity in one side and then target the opposite direction. Okay, so this is what's happening here. We have our relative equal high here, we have our relative equal low here. So when price is in this condition, okay, when price is just accumulating orders right here, we are not looking for anything. We want to see which side of the liquidity price takes first. Okay, so we have our relative equal low here, relative equal high here. So if price is clearing out the first relative equal lows, we are gonna target relative equal highs. It's that easy, that simple. Okay, folks, if price is clearing out equal high first, we'll be targeting relative equal lows. So this model specifically, okay, note it, specifically we'll be looking for this structure to form inside 1 minute, 2 minute and 3 minute. That's where this condition is high probability. I'll be sharing a high probability market structure in higher time frame, but this here, right here, this model is limited to lower time frame, and that's where it is high probability. Okay, so you guys already know that we are ignoring what's happening in price before price accumulates order here. Price generates relative equal high and low. That's what we are looking at. So once price does accumulation, okay, we'll wait for price to show its hand, deliver one side liquidity. So here, as you can see, price went below relative equal lows. So I wrote it here again for you guys to make it easier. If price takes out equal high first, we will target equal low. If price takes equal low first, we will target equal high. As you guys can see, price cleared out relative equal low down here, so we'll be targeting relative equal high from here. Okay, I'll be sharing the entry and all the criteria, managing the stop loss very soon. So in this condition, we have couple of rules. Without these rules, this condition is not a high probability. So what are the rules? The first rule is price have to get support in a bullish condition or resistance in a bearish condition from a higher time frame PDA. Okay, so suppose price is clearing out relative equal lows first. So below these relative equal lows, we'll have to find out a higher time frame PDA. This is a bullish scenario, right? Price is clearing out relative equal lows first, so we are looking for a bullish trade. So on higher time frame, we'll be also looking for a bullish PDA, specifically below this relative equal low. So this higher time frame PDA can be anything. It can be a fair value gap, it can be an order block, it can be a volume imbalance. We just need to see a PDA that is below where price is providing liquidity first. Okay, so if price was delivering liquidity towards relative equal high first, we would have looked for a higher time frame PDA up here. But what happened here? Price cleared out a relative equal low first, right? So we'll be looking for a higher time frame PDA down here in the discount range, because we are looking for a bullish scenario. So what's our second rule? Once higher time frame PDA is identified, we can manage our stop loss accordingly. So why do we need higher time frame PDA? We need this higher time frame PDA to put our stop loss, okay, to manage our stop loss. Below this higher time frame PDA, we can put our stop loss below there. So at what time frame we'll be looking for this higher time frame PDA? This market structure, we are looking for this to happen on 1 minute, 2 minute and 3 minute, and we will consider 5 minute and 15 minute chart as our higher time frame PDA. So that means what? Once you identify this structure forming in 1 minute and 3 minute, it will go to 5 minute chart and it will look for a higher time frame PD area where price is delivering liquidity first. So if price is delivering liquidity towards relative equal low first, it will it will go to 5 minute or 50 minute, then you will look for a discount PD area from where price can get support. If price is clearing out relative equal highs first, you will go to 5 or 50 minute time frame, and then you will look for higher time frame premium PD area, because we will be looking for shorts then, right? Manipulation and distribution must happen inside macro. Okay, so this right here, when price is generating orders, right, when price is generating relative equal highs and relative equal lows, this is what happening outside macro. We are looking for this stop hunt to happen inside macro, and the distribution price went up, clear out the relative equal high. That's what we are looking to see inside macro as well. So let's find out our accumulation, manipulation, and distribution phase here. It's very easy to spot in this scenario, okay folks? So we have our accumulation of orders here until price clears out one side of the liquidity. That's our accumulation phase. Once price goes below these relative equal lows or highs, that will be our manipulation phase. Here in this picture you can see price cleared out relative equal lows first, so this is our manipulation, and we have relative equal highs left. This is our distribution phase. So very easy to understand accumulation, manipulation. We are looking for the manipulation to occur inside a higher time frame PD area, and the distribution cycle, we are looking for this distribution to target these relative equal highs up here. This scenario often provides two opportunity. Okay, so the first opportunity that will come is from turtle soup. The second opportunity that will be coming is from the breaker. Okay, now the price did a stop hunt here. I already taught you guys how a breaker looks in our day one lecture. As you can see, as price did a stop hunt here, the up close candle that will be here, and this price leg is gonna work as a breaker. So suppose you missed the entry here, we are only looking for one trade. Okay, if you took a trade here, then we are not gonna be looking for this breaker to work out. If you missed the entry here, because the movement happens very fast, as we are looking inside 1 minute, 2 minute, and 3 minute chart, these are very lower time frame, and you will have to be very cautious how price is delivering, because in seconds price can move from one direction to another, and you will just be like looking at it. So without experience, I believe like it's very hard to execute here. So if you miss the execution right here, you will still have a chance to enter from this breaker. So once price activates this breaker in this condition, we will wait for price to retrace lower. Okay, trade come inside the breaker, the up close candles that will be here, and then move higher. And you guys know the rules when how to spot a high probability breaker. Price will have to go above the last up close candle here, right, close a candle's body above, and then generate a fair value gap here, and that will be our high probability condition. Once price drops down to this breaker, we'll be looking for another distribution phase right up here. Okay, so let's look at it with some market structure, and this is what I consider this market structure is what I consider as one of the highest probability market structure, folks. Okay, this thing repeats every single day, and I managed a lot of trade execution in hindsight. Okay, live trade execution, plus I managed live trades streaming on YouTube by working with this model. So as you can see here in the first picture, we have relative equal high and lows in both sides of the marketplace, and we already know that relative equal high works as a strong buy side liquidity, relative equal low works as a strong sell side liquidity. So I put some note here. When price generates relative equal high and low in both sides of the market, this opportunity provides a plus turtle soup setup. Okay, you will wait and see where price is providing liquidity first. Okay, we are not looking for any trade inside here. When price is consolidating, we are not doing anything. We don't care what price is doing. We will only outline relative equal highs and lows, and then we will wait for price to go either one direction first. Okay, we don't know at what direction price will go, and it doesn't matter. You don't have to know. You will wait for price to show its hand, and once price delivers one side liquidity, you will target the other direction. As you can see in the second picture, the opportunity is here now. Price provided liquidity to one side of the market. Now you can target the opposite direction from here. Once price clears out the relative equal low from here, you will be targeting the relative equal high here. But one very important thing to keep in mind is that you are not just executing here randomly. What do I mean by randomly? You will have to go to the higher time frame to look for that higher time frame PDA from where price can get support. Because remember, we will also have to manage our stop loss, and that's where we'll be putting our stop loss below that higher time frame PDA. So two things to keep in mind: if price is getting support from any higher time frame PDA here, it can be a higher time frame fair value gap, order block, breaker, etc. Okay. Stop hunt takes place at specific macro zones, so keep in mind if this stop hunt is happening inside macro or not. So I already showed you guys, we are looking for accumulation phase outside macro. When this stop hunt is happening, it should be happening inside macro. Okay, these are very specific rules, folks. Okay, this stop hunt must happen inside macro, and only then it will be considered as a high probability setup. So why inside macro? Why not outside macro? So inside macro, that's when price becomes volatile. That's when price delivers liquidity with speed. Okay, in other time when price is not trading inside macro, that's what price does. It accumulates orders most of the time. Inside macros, it does the manipulation and distributes the order. So that's the reason this stop hunt must be happening inside the macros. And as you guys can see, once price clears out the relative equal low, one side delivery, will be targeting the other side right up here, and we'll be putting our stop loss below that higher time frame PDA. So now let's look at this structure on a market profile. So let's remind you guys about our rules once again. Identify strong liquidity, okay, relative equal high or low. The second rule is identify higher time frame PDA for manipulation. At what time price is forming this structure. So this is very important, the last part, because that's where the time is aligned. We'll be looking for this structure to form inside a specific time. Okay, folks, and look at this structure right here. Price generated relative equal high, relative equal low down here. So we identified our relative equal high and relative equal low. Okay, then our second rule says we'll have to identify a higher time frame PDA. So this trade, I actually took it live on, I believe, on this Thursday. Okay, there was a stream on my YouTube that was on by the title, I need one more trade to pass a funded challenge. So if you guys go in my stream, in that free stream, and just look for this setup, you will see it. Okay, why am I mentioning about the stream? Because here I didn't identify the higher time frame PDA. If you go in my stream, you will be seeing me identifying the higher time frame PDA and putting my stop loss accordingly right below that higher time frame PDA. So this structure is very easy to understand, folks. We identify relative equal high, then we identify relative equal low. We wait for price, okay, to get inside the macro zones, and the macro zones can be any zones. It can be 820 to 840. If this structure is repeating inside 8 o'clock, we'll be looking for price to do this stop hunt at 820. If this structure is happening at 9 o'clock, we'll be looking for this stop hunt to happen at 9:20 inside that time period. Okay, because we know at 9:30 we are expecting distribution, so that's what is happening here. Price accumulated order generated relative equal high and low. We don't care what's happening here. We are not looking for any setup until one side of the liquidity is getting delivered. So air price delivered liquidity here, okay. As soon as, so what's the entry criteria? As soon as price hits the higher time frame PTA, that's where you will enter, and that's where I entered in that stream. And as you guys can see, the execution was here and the TP was above the relative equal highs. Okay, so do you guys see a breaker here? As I mentioned in my previous slide, that if you miss an opportunity here, price will also form a breaker with a fair value gap once price is going clearing out the relative equal highs here. So these up close candle right here will be working as our breaker, okay. And with this breaker, when this breaker will be high probability, when price generates a fair value gap alongside with it. And you guys know what to expect after. Once price hits this fair value gap, we don't want to see price closing any candle's body below this fair value gap, because if price does closes a candle's body below this fair value gap, this will work as an inversion, and that's what I will teach you guys in our future slides. So as long as price is not closing a candle's body below this fair value gap, we can use these up close candle as our breaker, okay, and put our stop loss below here and execute here, target to R from here. So in this market structure, in this market profile, price always provides two opportunities. The first one is the highest probability scenario, and the second one only when you are missing this entry, okay. You are not taking two entries together, you're only taking either one or the other one. If you miss this one, then you are looking for a trade to enter with breaker. So where's our AMD cycle here? This is our accumulation phase, right? This is very easy to understand. Where is our manipulation? Right here. Where's our distribution cycle? Right here. And manipulation and distribution, both of these phases are happening inside macro. So a lot of you will be like, HYDRA, where's the other market structure, right? There's nothing else. That's it, okay. That's the only structure that you are looking inside macros. When price is accumulating this order, you will be looking for price to clear out one side of the liquidity, then deliver liquidity to the other side. That's the only thing is happening inside the macro, okay, specific macros. There are other profiles that I'm about to share with you all, but this is one of the highest probability scenario, and the good thing is this requires no bias. So you don't have to have hold any bias from the higher time frame, okay. The only higher time frame you are looking at when price is forming this structure is 5 minute and 50 minute. Take note folks, we are looking for this structure to form inside 1 minute, 2 minute, 3 minute. At what time? Inside our macros, okay. Then we are looking for the distribution and the manipulation happening inside the macros, and that's it. That's the structure here, and it requires no bias. Once you identify the higher time frame PTA, that's where you will put your stop loss below that higher time frame PTA, and you will target the opposite direction. And that's how market will repeat the same structure, okay. There is nothing more to it. That's it, and that's how simple it is. You guys have the specific time periods right now, right? You guys know about all the macros. I already shared about forex macro, stock macro, and the crypto macro. So the newer folks who couldn't find the crypto and the forex macros, just go above, a little bit above in our private Telegram group, and you will find it there. And inside these macro time periods, if you see price repeating this structure, okay, we are not looking for any trade here. Why? Because this interval, this price action is happening outside macro. So when price generated this fair value gap, okay, so a lot of you are gonna be like, okay, price generated a fair value gap, I'm gonna go short here. But this short condition is not high probability here, right? The short happened, but it wasn't a high probability condition. What was the high probability condition? Taking the turtle soup entry from here. And that's how price will repeat this condition. I'll be sharing another example with you all. So what do you guys see here? So previously, in our previous slide, I shared this market structure, okay. So this is the most common market structure. This price will form when this structure is repeating, this relative equal high and relative equal low structure. But there's another structure that repeats, and this is the structure. What do you guys see here? Price is delivering sell side liquidity, right? That's why price changed its trend and now it's shifted to deliver buy side liquidity. So what's happening here? Do you guys see relative equal high or low? So let me mark that for you. We have relative equal high here, right? We have relative equal high here, then we have relative equal low here. So what happened here? Price generated relative equal highs, relative equal lows, so both sides of the liquidity in marketplace. So what do we do here? We wait for price to clear out one side of the liquidity. What do you guys see here? Price tapped here below this relative equal lows. We are not executing here. Why? Because we are waiting for price to get inside our higher time frame PDRA. So once price gets inside our higher time frame PDRA, that's when we'll be looking for a trade setup, and that's where our high probability condition will be happening. So we have our relative equal lows down here. Price cleared it out. We know that once price clears out one side of the liquidity, and if there's relative equal highs above, okay, then we'll be looking for a bullish condition. If price is clearing out relative equal high first and then there's relative equal lows intact, we'll be looking for a bearish condition to form. So our trade setup will be from here, targeting the relative equal highs above, putting our stop loss below the higher time frame PDRA. Okay, folks. So I'm not looking at the chat window. Once I'm done explaining each and every macro profile, then I'll be answering your questions. I hope you guys will be patient enough. So this is very simple, folks. Okay, this structure is happening on 1 and 3 minute. Listen to me closely. 1 and 3 minute, and we are looking at these small time frames for this market structure to happen. There's more details to it in our coming slides. I'll be sharing it with you all. So we got our first opportunity. Once price cleared out the relative equal low form here, we entered, we took our trade from this higher time frame PDRA, targeting the relative equal high first. Okay, we got our first opportunity. So suppose you missed it. Do you guys see a breaker here now? So once price went below these relative equal lows, we had couple of up close candle here, right? So that's what we had as a relative equal high. So what was the rule? Do you guys remember me saying in the previous slide that when price is activating a breaker in this scenario, we also want to see a fair value gap forming with it. Okay, without this fair value gap, specifically one PDRA. That's what I'm saying. We are not looking for a trade from the Reaper. Okay, we are not looking for a trade from the first or second leg, but only from the third leg of the breaker. If you don't know what I'm talking about, first, second, and third leg, I already discussed about it in our first day mentorship, first day topic. Okay, so go back and listen to it and come back to it again and you will understand. So it's very specific. We are only looking for one PDRA. Once price clears out the relative equal high, we'll be looking for price to form a fair value gap here. If price don't form this fair value gap, we don't have any opportunity. Once price forms this fair value gap, then and only then we know that these up close candles will be working as a high probability breaker, and we will execute once price steps inside this fair value gap inside our macro times. Okay, and where will be our stop loss? We'll also look at here. Our stop loss will be below the fair value gap that will get generated once price clears out the relative equal highs. Okay, folks. So I'll take you guys back to our previous slide. What do you guys see here? Okay, this is another market condition. The slide that I shared with you now, this is another market condition, but both of these conditions are similar. How they're similar? They both have relative equal high and relative equal low in both sides of the market, right? We wait for price to clear out one side, then we enter here. If we miss this opportunity, then and only then, once price clears out the relative equal highs, we'll be looking for a fair value gap forming at the candle when price is clearing out the relative equal high. The candle that cleared relative equal highs, That's the candle we are looking for a fair value gap. Isn't it specific? Yes, only one PDR. It never gets any easier than this, folks. And we have our fair value gap right here, and that's the high probability condition. Only if you see this fair value gap forming, that's the only time when you will know that this breaker will work. Okay, why am I putting a rule here? Why am I only referring to this fair value gap? Because as you guys can see, prices both side of the liquidity in marketplace, both are strong liquidity. So price cleared out one side of the liquidity, then price can easily reverse from here after it provides liquidity up here, right? So let's go back, let's come again to our this slide. So what happened here? Once price cleared, price was delivering in a downtrend, right? So we know that our trend is shifted here once price cleared out the relative equal lows, but price can still continue lower from here. How will you know the price is done? Price is not done yet. Once price generates this fair value gap, listen to the rules, folks. The fair value gap will have to get generated at the candle that clears out the relative equal highs. Okay, the candle that clears out the relative equal highs, if that candle has a fair value gap, only then you will consider these up close candle as a fair breaker. Without this fair value gap, this breaker alone will not work. Okay, if it's working, if you are seeing it working, it's only gonna be like 10-20% of the time. The percentage of this in this scenario a breaker working is very, very less, because we already got an opportunity from down here. Once price confirms that it wanna deliver towards buy side liquidity, that it changed its direction. And how will we know that price changed its direction? It wanna continue deliver towards buy side once price generates a fair value gap alongside with these up close candles. Okay, folks, I repeated myself a couple of times. I hope it's clear. We are only looking for a breaker trade with this market structure when price is clearing out the relative equal highs and at the same candle price forming a fair value gap. So once price forms the fair value gap, we'll wait for price to trade inside the fair value gap, and that's where we will enter, and you will see price coming down here and trading here inside macro times. Okay, folks, this is very specific in market, that when market generates this fair value gap, price will come inside this fair value gap inside a different macro. So we are looking for a trade setup here inside one macro, right? So price will get done somewhere here delivering with one macro, then price will get inside another macro. We are trading 20-minute intervals, right? 920 to 940. So suppose this distribution here happened at 920 to 940, we'll be looking for this distribution to happen at 950 to 1010. So let's look at the writings here. A breaker can form before macro at consolidation phase outside macro, but entry must be inside macro. So what do I mean by that? Our breaker that formed here, when did it form? It formed way before our macro started here, right? This breaker got accumulated or got engineered inside the accumulation phase. Okay, this is our accumulation phase, this is our manipulation phase, and this all of it is our distribution phase. So our breaker will form outside macro, but price will activate and make this breaker a high probability when inside macro. So this was it for this first structure. We have our accumulation, manipulation, and distribution. If you guys have any questions, feel free to ask me, and I'll love to answer it. What's your average win rate on 2-hour trades? So average that I get, it depends on month to month, week to week. So on average, I get like 60 to 80% of the win rate. But remember, folks, my win rate is not gonna be your win rate. I trade these market profiles specifically, okay? But I have my experience behind me, okay? So at first, when I started, I didn't execute it by following these profiles. So that time my win rate was around like 30-40%. I was losing very bad. I was blowing account. So once I learned about this market structure, once I found it out in charts that this market structure get repeated inside time again and again, my win rate got increased highly. Okay, 60 to 80%. That's what I average each month. Okay, it's not specific that this month I'll be like doing 80%, but on average I do 60 to 80%. So I can give you a guarantee that if you're following what I'm saying rule by rule, and you are only looking for this scenario to happen inside macros, you will do the same 60 to 80%. And it's very easy to spot, folks. Okay, you don't need to learn anything else for this market structure. You don't need to learn any bias. Okay, go on your own chart. It doesn't matter what chart you are looking, forex, stock, crypto, just go inside the specific time periods that I shared with you and look for this structure happening. So EM is asking, what do you base your first entry on? So the first entry that I'm taking is based on price clearing out the relative equal lows, then price hitting the higher time frame PD area. Go back and listen to me again. I told you guys that we are only executing once we identified the relative equal lows. Okay, once price clears out one-sided liquidity, only then we are looking for a higher time frame PD area, because we don't know which side will price clear out first. Price can clear out relative equal high first, relative equal low first. So there's no point of judging or analyzing chart before price does it. Once price clears out the relative equal high or relative equal low, that's when we'll go to 5-minute and 50-minute chart, and we will look for this higher time frame PD area. Okay, below relative equal low, if price is clearing out relative equal low first, that's when we'll be looking for a bullish PD area at the discount in 5 and 15-minute chart. If price is clearing out relative equal high first, we'll be looking for a discount PD area on 5 and 15-minute chart. I hope it's clear. It's very easy. Jai is saying, so price will enter a higher time frame PD area at 20 to 40 macro, then market structure shift and retracing breaker or fair value gap generated 50 or 10. So we are not waiting for a market structure shift. Do you guys see any market structure shift here? Yes, it happened way up here. But we already know that price shifted its structure when price cleared out the relative equal lows from here. Okay, this is advanced theory on market structure. You don't need to know. You don't need to like outline the general market structure shift to know that price changed its trend. You will know that price changes trends once price clears out this relative equal low, hits the higher time frame PD area, and then goes up, right? But if you are very new and you still want to be safe, there's nothing wrong to wait once price comes up here. But it's very easy to spot in price, folks. Okay, I'll be sharing the execution videos with you all, so you guys will understand that this structure repeats. And I'm just saying to you again, we have a private Telegram group, right? So go on your own chart once I'm done delivering the lecture, and just specifically, you don't have to look at higher time frame or anything. Just look at this 20 to 40, this 20-minute macro intervals, and look for this profile, and come back and tell me that you couldn't find any price action that is similar like this inside any single day. Every single day inside macro periods, this will be repeating. In the breaker entry, the low was sweep where we placed the stop loss. I don't know what you were asking me. In the breaker entry, the low was sweep where we placed the stop loss. This low, we are not putting our stop loss below here. What are you guys doing? Are you guys not listening to me carefully? What did I told you guys about managing stop loss here? We are putting our stop loss below the fair value gap that gets generated once price clears out the relative equal high. Okay, we are not putting our stop loss this time below the breaker here. We are putting our stop loss below the fair value gap that gets generated. Is it clear? In this market structure, this market structure is very specific. We'll have to identify relative equal high and low in both sides. Okay, once price clears out one direction, we'll go to 5-minute and 50-minute chart and we'll look for a bullish or bearish PD area. Once price taps inside this bullish PD area, we'll drop down to 1 and 3-minute and we'll execute here. We'll put our stop loss below. We'll be targeting the relative equal high here, and this breaker is not a high probability here without this fair value gap. So I'm saying it again. Once price clears out the relative equal high here, you want to see price forming a fair value gap at the same candle. Once price forms the fair value gap here, only then you are looking at these breakers. Only then these breakers are high probability. And you are not putting your stop loss below the breaker, but below the fair value gap. I hope it's clear. Now let's move to our second macro profile. Okay, the first one that I shared is very easy to understand. Even to me, that's what I believe. Like even if I'm explaining it to a very beginner, he will understand the first profile. The second profile will contain market, like more in-depth market knowledge. So let's start. So what do you guys see here? We have an accumulation phase here, right? Then manipulation somewhere here, and the distribution towards buy side liquidity. So what are we looking at here? We are looking at market maker sell and buy model phases. Okay, the way I'm gonna teach you market maker buy and sell model here is way different than what other people teach us. Okay, what other people sees and how other people look at this market maker buy and sell model. The way I use it is very simple, just the way I shared the breaker structure, just the way I shared our high probability macro profile one. This will be very easy and simple to understand. So the first profile, the first phase in our market maker buy model. Okay, here we have a market maker buy model. So in this market maker buy model, we'll have the first phase as a consolidation. The second phase will be the first stage of distribution. I'll explain a lot more about this. Okay, just wait. Then we'll be looking at the second stage of distribution. Our last profile will be smart money reversal, smart SMR. Okay, so what's the high probability condition here? The high probability condition is second stage of distribution. Okay, and we'll be talking a lot more about this. So let's focus here. We have an original consolidation here. Now price breaks out of this consolidation, goes above, retraced back to this original consolidation before expanding higher, and this is what will be referred to as a first stage distribution. In our second stage distribution, okay, in first stage of distribution, we are not looking at any stop hunt here. In our second stage of distribution, we'll be looking for a breaker forming. In the market, I got a lot of questions, like, you know, from my day one lecture, is that at what market condition in a market maker buy and sell model we'll be looking for a breaker. So the question is getting answered today in the second stage of distribution. Now, okay, what do you guys see here? We have a low formed here, then a lower low, then price went above. We have our up close candle here that is working as a breaker. Price closed the candle's body above the breaker, retraced back to the breaker. Our expansion happened. Price hit a higher time frame premium or premium PD area. Then the market reversal happens. Okay, so we are not looking for anything here. This phase is already happened in price action. What we'll be looking for, our high probability condition is gonna be this phase. Okay, the phase that is about to happen. This is already happened, the market maker buy model. Okay, now we'll be focusing inside market maker sell model, and we already know the market maker phases. In our first profile, we'll be outlining a consolidation phase. In our next profile, we'll be outlining the first stage of distribution. So in first stage of distribution, we'll have a single low. There's no stop hunt. Okay, we are looking for a stop hunt and a breaker forming in the second stage of distribution. Once I show you guys the actual chart, it will make way more sense than just look at the market structure right now. Clear your mind, just focus here. Okay, just stop thinking about what you look at chart every single day. It's not gonna be same as what you were seeing, but it's gonna be different, but easy to understand once you clear your mind. So are we good? We have 4 phases in a market maker buy and a sell model: consolidation, first stage distribution, second stage of distribution, and then SMR zone, smart money reversal. We'll be talking about each and every one of these step here in our further slides. Okay, the high probability condition here is the second stage of distribution. We have a low here because that's where our breaker will form. Here we'll be focused at the second stage of distribution after SMR. Okay, so we don't know when this is happening, but we will know what is coming in the marketplace once this smart money reversal is happening. Okay, once this smart money reversal is happened. So once this smart money reversal happens, we'll be looking at second stage of distribution. So let's outline our second stage of distribution. So why am I putting so much importance into second stage of distribution? Because the second stage of distribution has a stop hunt, often generates high probability breaker. That's where our breaker will form. Often delivers liquidity in a low resistance. So from this, once price forms a market structure like this in the second stage of distribution, a low and then a lower low, these up close candles becomes our breaker. Very easy to understand if you understood everything from my day one. Okay, so once price completes this market maker buy model, we will look for a market maker sell model to happening and contain each and every phases that it did here. Okay, but we'll be focusing inside the second stage of distribution in the new market cycle. Is it clear, folks? Our market structure, our smart money reversal happened here. Okay, we don't have to know from where price will reverse. We don't have to know anything that is happening here. We are focusing at the second stage of distribution once the first stage of distribution happens. Okay, so price generated a breaker here. Do you guys see it? High, a new higher high. So these down close candles becomes our breaker. So price goes below this breaker. That's when price is retracing back to this breaker. This is our first stage of distribution. We are not looking for any stop hunt here because a stop hunt already happened here. A stop hunt will happen in the second stage of distribution. So price came down, right? Formed a new high, low, new higher high. Then these down close candles becomes our breaker. And this is what we will be looking for a high probability condition. Second stage of distribution targets relative equal high and low original consolidation. So this, once this happened, okay, once we identified that we have a second stage distribution with a swing high, with a breaker, we will be targeting the original consolidation down here that will be coming with a relative equal lows. Okay, so did you guys understood? Market maker buy model, that's it, folks. This is the market maker buy and sell model with our breaker. Okay, because we are focusing in only one specific model, so we'll only be looking for this one model repeating inside the market maker buy and sell model. There are other people who are teaching market maker buy and sell model, but they are not teaching it with breaker. I'm teaching it with you breaker, and that's why it's looking different. It's getting specific. Other people are looking for every trade setup. They're looking for fair value gap, order block, blah blah blah, and all that stuff. We are not looking for that. We are looking for price to form a breaker in the second stage of distribution. And how it gets easier? It gets easier because we are not predicting anything here. Once price gets done delivering liquidity here, we'll be looking for this in the new market cycle. Price will be doing the first stage of distribution. We are not focusing here. We'll be looking for the second stage of distribution right here. So how will you know that this second stage of distribution will happen here? Every single time, folks. This is the must be condition for a market. Okay, every single time price will form this breaker near to the old second stage of distribution. So we already identified, right? I'll take you guys into the actual chart and we'll look how this forms. But for now, as a structure, know that we have a second stage distribution here in the market maker buy model. We are looking for trade in the market maker sell model, right? So where will we expect this second stage of distribution forming? Near to the previous second stage distribution. So this distribution happened where? In the market maker buy model. So when price changes trend, when price is delivering in a market maker sell model, we'll be looking for this structure to form near to second stage of distribution from the market maker buy cycle. Okay, is it clear, folks? Second stage of distribution is high probability condition for macros. Okay, so this everything here, we are not looking at this, we are focusing at this price leg here that will form near to a old second stage distribution. That's why it is easy to spot, because once you identify the second stage distribution, in hindsight you'll be looking for a new breaker to form near to the second stage distribution in the new market cycle. And this price action, we will be looking for this price action to happen inside our 20-minute intervals that I shared with you all, 820 to 840, then 920 to 940, 950 to 1010. There's a couple of macros, so every macros are 20-minute, and this price action will happen in 20-minute. So this here, okay, you can use this structure on 1 minute, 2 minute, 3 minute, 15-minute, hourly. There's no rules for this structure. You will see it repeating in 1 minute chart, you will see it repeating on daily chart, and that's how you will know that where price will form breaker in a complete market maker buy and sell model. So our last topic here, second stage of distribution will often form near to the previous second stage distribution. So I already talked about this. Once we identify this market cycle, right, because we are identifying and outlining this cycle in hindsight, that's why it gets easier to understand where price will form new breaker, because this already price did it in past, right? And we are outlining this structure in hindsight. So we'll be focusing, once we are done outlining the second stage of distribution in hindsight, in our new chart, in our new market cycle, we'll be looking for a new breaker to form near to the second stage of distribution. I hope it's clear. Now I'll take you guys into the actual chart and I'll show you guys how it looks. So before I do that, do you guys have any question about the structure here? Trust me, folks, market maker buy and sell model, you won't find anyone explaining it easier than this. Okay, I'll be showing you where the breaker will form. In hindsight, you will be marking out these, right? And in future, you'll be looking for a new breaker to form near to the second stage distribution. It never gets any easier than this, folks. Yes, Brianna, we'll be looking for accumulation, manipulation, distribution inside here, inside our second stage of distribution. Okay, this is where we'll be looking for this forming. This structure is coming with a breaker, right? We have a low here, lower low, these up close candles becomes our breaker. This condition is specific, I'm just showing it to you as an example. This is gonna be happening in the second stage of distribution. So suppose it's a market maker buy model, okay, and it already happened, this second stage of distribution already happened. You will look for the same condition to repeat when price is distribution liquidity in a new market maker buy or sell model, the same one. And the benefit is this structure will form again near to the old structure. So I hope everything is clear here, right? So now let's go to the actual chart. So what do you guys see here? Just remember the phase. We have 4 phases: consolidation, first stage of distribution, then second stage of distribution, and the last one is smart money reversal, right? So we'll be looking for all of this in hindsight in previous market cycle. So what do you guys see here? This is a market maker sell model. So market maker buy model is yet to happen, right? So what we'll be doing here, we'll be outlining 4 market phases in hindsight in this market maker sell model. So we have our first phase, original consolidation, right? Then what's our next phase? First stage of distribution. Where did it happen? Right here. Once price breaks out from this original consolidation, okay, we don't know where price is going, and we don't care what's happening here. All we care is gonna be what's happening here, okay? And we'll talk about this. So this is our first stage of distribution. Once price goes below this original consolidation and then retraces, as soon as you see it, this is our first stage of distribution. And don't worry about it, okay? You are not spotting it live, you are spotting in hindsight. And that's why it will become easier when you are trading live in this market condition. Now let's spot our second condition, second stage of distribution. Now in first stage of distribution, we are not looking for a stop hunt, right? In the second stage of distribution, we are looking for a stop hunt plus a breaker to form. Do you guys see a stop hunt and a breaker in a second stage of distribution here? This is our second stage of distribution. We have a high here, right? Price delivered liquidity after the first stage of distribution. That's what we expect. Then price retraced higher, and now we know that price is doing a second stage of distribution. We'll be looking for a stop hunt to happen, and that's what happened here. We outlined it, we marked it, and now when price is coming here, we'll be looking for this same structure to repeat here, okay? And we were able to identify our first stage of distribution, our second stage of distribution. Now we'll be outlining the smart money reversal zone. This is our smart money reversal zone. This is where the trend shifted, okay? So it goes back to the original thing again. This is our original consolidation, accumulation of orders. Price broke out from here, right? So this becomes our first stage of distribution. So this is our first stage of distribution. Now we are not looking for anything to happen here. We are letting this go and happen in price, okay? We are focusing inside the second stage of distribution that comes with 2 rules. It will have to form near to the previous second stage of distribution, okay, right? Plus it will have to have a stop hunt. Without a stop hunt, our second stage distribution is not a high probability condition. So do you guys see a second stage of distribution here near to this old second stage of distribution? Do you guys see a stop hunt? Now this is our second stage of distribution. Now look close. Where did it happen? Near to the previous stage of second distribution from this market cycle here, right? So isn't it easy? Isn't it getting easier? All of this you are outlining in hindsight. Now only thing you are waiting for price to happen is price to form a first stage distribution. Next, once price goes near to the second stage distribution, you are looking for a new breaker to form. Isn't it easier, folks? Now do you see a breaker here? Here in this condition, we are not looking for any trade setup. So this condition is a low probability condition, right? So every breaker that will form here is a low probability breaker. We are looking for a high probability breaker to form here in the second stage of distribution that is happening near to the old second stage of distribution. And this is where it gets magical. This price action is repeating inside macro. Now let's outline the breaker here, okay? Because some of you, I know that you don't really want to put in the work. You guys, I don't know why a lot of you guys complained about that day one. You guys were like, all I shared is the basic stuff. Day one was supposed to be basic because I'm taking you guys from the basic to the advanced level with a breaker model, right? We are only looking for one model. I'm not gonna teach you how to take trades with fair value gap, with order block, That's not what I'm doing here. I'm only gonna teach you how to take entry with one fucking model, and that's what you are looking. That's it, okay? Market maker buy and sell model. You are not looking for any fair value gap or anything. You are looking for a breaker to form, and where I'm sharing you the rules at second stage of distribution. This stage of distribution, where will it happen? I'm also telling you that near to the old second stage of distribution, right? When will it happen? Inside macro. How will it happen? It will have a stop hunt, right? Just the way a breaker forms. Does anyone ever taught you this market maker buy and sell model easier than this? I don't believe it. Okay, so we have our breaker here. We have a low, right? Then price went below this low. This up close candle right here becomes our breaker. Now here we don't have a rule specifically like in our previous market profile. We had a rule that price will have to have a fair value gap, and only then we are taking this trade. But here we don't have this rule. In day one, I shared couple of breaker condition, right? A breaker comes with a fair value gap. A breaker comes with a fair value gap, a discount, and then a premium. You'll be looking for all types of those setup forming here at the second stage. And what do you see here? Price formed a breaker. Price closed the candle's body above the breaker. Did price retraced back to the breaker again? Gave you an entry? Yes, it did. Now I'm showing it to you in hindsight. Once price drops down, okay, when it's happening live and price is dropping down here, you will have a lot of fucking time to execute here. Okay, trust me, you will have. And where are we targeting with this second stage of distribution? Original consolidation. Now, why am I showing this profile to you all? Okay, because a lot of you are asking me, why am I only teaching you to take 2-hour trades? Now here with this condition, I'm teaching you how to take 4-hour trades, 5-hour trades with this market maker buy and sell model. Is it clear, folks? If you guys have any question about this picture, feel free to ask me before I show you the next example of the same market condition. Dale is saying this is awesome. Never really knew this after 10 months. This took a long time for me to find it out, folks. Okay, so the knowledge that I'm sharing with you all, I know that you guys already know it. It worth way more than $80. Okay, so some of you were also complaining about that. I don't know why. What's happening with you all? But this took a long time for me to understand. Years, okay, folks. It's not months. Me, I'm addicted to these charts. So how did I found it out? By being addicted. Because look at here, I'm not sharing the market maker buy and sell model like other people. I'm sharing it with you by outlining a breaker. Where will a breaker form? How will a breaker form? When will a breaker form? And everything. Isn't it getting easier? Now let's look at our second example. What do you see here? So I'll give you guys 1 or 2 minutes. Okay, I'll go and drink some water because I'm feeling a little bit thirsty. Just try to outline 4 phases. Remember, do you guys remember our 4 phases? Original consolidation, first stage of distribution, second stage of distribution, then smart money reversal. Once that smart money reversal happens, we'll be outlining the first stage of distribution, and then we'll be looking for a breaker to form near to the old second stage of distribution in the new second stage of distribution. So now try to find it out here, and I'll come back in 1 or 2 minutes and I'll share with you all. Okay, folks, I'm back. So I already told you guys that there's we are looking for the first phase here, right? The original consolidation phase, and this phase will happen in two forms. So the consolidation phase will come in two forms with relative equal high and low and trend line liquidity. Okay, that's the only two form that a original consolidation can take. Other than this, there's nothing else, folks. Okay, there's nothing else. Either price will deliver with speed here, okay, near to the old original consolidation, but there's only two forms. In two forms, price can take in original consolidation: relative equal high and low, trend line liquidity. I already showed you guys in the previous example with relative equal high and low. Here you guys can see the trend line liquidity, right? So we have our original consolidation in a form of trend line liquidity, plus you can also see it as a relative equal low. Look at these lows, folks, how clean it is, right? Very clean. So where's our first stage of distribution? Once price breaks out from the original consolidation, right, and retraces back to the original consolidation, that is our first stage of distribution. This is here. Very easy to identify, because we are doing here is in hindsight. We are not predicting anything here, okay? All we are predicting is here. And with this information, our prediction here becomes easier. Now, where's our second stage of distribution? Now, do you guys remember, in our second stage of distribution, a breaker will form with a stop hunt. This is our second stage of distribution, right? Do you guys see any stop hunt here in the first stage of distribution? No. So there's one thing. You will see this is what the high probability condition. A market will repeat this condition 80% of the time. Rest of the 20% of the time that you will see price forming a swing low here. Okay, this is another type of market profile, and I'll also talk about that in our future slides. But in this profile, price is not doing any stop hunt in the first stage of distribution. All we are looking for a second stage of distribution. All we are looking for a stop hunt in the second stage of distribution. That's what is happening here. And where's our SMR? This is our SMR phase, right? Now, we are not looking for anything here. We are waiting for the second phase to get started, right? So we have our first stage of distribution. There's no stop hunt. Do you guys see any stop hunt here? No, just as there's no stop hunt here, right? So we have no stop hunt here. We are looking for a clean stop hunt with a breaker at second stage of distribution. And this second stage of distribution will happen where? Near to the old second stage of distribution. Now see how easy it is to identify a breaker with this when you have this market condition in mind. So this thing is not limited with time, okay folks? The same price action will repeat on daily and even on the macro forms in 1 minute, 2 minute, 3 minute, even on the second charts. And it's very easy to identify, even if you don't have, like, if you have 0% experience with trading, the way I'm showing it to you, okay, go and outline it in your own chart and you will see it. This is how easy it is. How do I know it? Because I was teaching live one-to-one to one person, and he didn't know anything about market structure or anything. So once I showed it to him and I was with him, I showed him, I opened a chart and I told him to outline this same condition. It took some time for him as he was new, but after a couple of time, it was very easy for him to understand these market cycles. So we are not looking for a breaker to form here, right? We are looking for a breaker to form in the second stage of distribution, and that's where it formed. We have a high here, then another high. This price action is happening inside the macro, and what price condition will be here? We'll be looking for breakers. The breaker that I showed you guys in day one, that's the breaker that we'll be looking here. Okay, now it will tell me, HYDRA, there's no entry here, right? Now consider this as a higher time frame. Drop down to the lower time frame, you will see a lot of entries forming here. from the Reaper, from the first, second, and third fair value gap, you cannot complain to me that you couldn't find the entry here. Trust me, with experience, every single time you will find the entry here, because I shared a lot of entry criteria with you all in day one, right? There wasn't one, two. I shared multiple entry criteria, multiple structure, multiple patterns that price will repeat here. Now let's look at our last example, and after that we'll be looking at our macro profile 3. This is gonna be our last example from macro profile, the second macro profile. And as you guys can see here, our original consolidation is coming in a relative equal high and relative equal low form, right? Price generated relative equal high here, relative equal low in both sides of the marketplace. Then price came down. This is where our first stage of liquidity is happening. First stage of distribution is happening. Then our second stage of distribution and third stage of distribution will also be looking for that. So we have our original consolidation here, our first stage of distribution. Once price breaks out from the low here, okay, because why am I outlining this here now? Okay, why am I not outlining this as our first stage of distribution? Now who can answer that to me? Because all we are doing is in hindsight here. Do you guys understand this? Okay, you only need to outline where price retraced back before an expansion lower, and that is our first stage of distribution. This first stage of distribution does not necessarily have to happen lower. It can happen inside the first stage of distribution and without a stop hunt. So once you are able to identify that, okay, this first stage of distribution will always form near to the original consolidation. Okay, we have our second stage of distribution here, high, new higher high alongside with breakers. So we have our stop hunt here, a new high form. These down close candles becomes our breaker, and as you guys can see, every single time price is forming a breaker here in the second stage of distribution, it also giving you an entry. Like look at here, price closing candles body below these down close candles, came back up, hit this breaker, and now it's going down. So where's our smart money reversal zone? This is where our smart money reversal zone. Okay, now we'll be identifying our first stage of distribution here. This is what happening, and now our second stage of distribution should happen always. That's a must be condition. Okay, second stage of distribution will always, folks, will happen near to the old second stage of distribution. What do you guys see here? Price went above the second stage of distribution, right? But look close, price did came back to the old second stage of distribution, and that's where it formed a breaker. We have our low here, new lower low that went inside here, right? So you don't necessarily need price to come all the way down and trade inside the second stage of distribution, but because price is also leaving signature that it wanna move towards buy side liquidity. What's the signature? Do you guys see the relative equal highs up here? Okay, do you guys see that? Yes, it's there. Once price is retracing lower, it's also generating relative equal highs right here. So how will you know the price will move higher? Once price comes near to the second stage of distribution, that's when you know the price will be expanding higher, clearing out the relative equal highs here. And the next market cycle that forms, you already know it. We have our liquidity in a form of trend line liquidity right here, right? This is our SMR level. Our second stage of distribution is here. So suppose you missed everything here. Don't worry, once price goes below here, right, price will have a SMR zone here, then price will have a first stage of distribution here. Then once price goes below or trading near to the second stage of distribution, we'll be looking for a new second stage of distribution forming near to this. And once price forms a breaker near to this, we will be targeting this liquidity down here. So here's another thing to understand, folks. Price is leaving this original consolidation liquidity every single time when it's doing the second stage of distribution. Okay, price will not clear out this original consolidation liquidity without a second stage of distribution. It's not gonna happen. There's no market profile that where the second stage of distribution didn't happen. Every single time price will have a second stage of distribution before it clears out original distribution phase, sorry, original consolidation phase right up here, right? As I showed you guys in my previous example, what do you guys see here? Did price clear out these lows first and then formed the second stage of distribution? No, it formed the second stage of distribution first and then hunt the relative equal lows. That's why the second stage of distribution is so high probability. Why? Look at the delivery outside of second stage of distribution. Market was choppy, right? Even when price was forming a breaker here, price was choppy right here, right? Price formed a lot of relative equal highs. So if you don't know how to look at market, you will just be, okay, I should be avoiding trading today because market condition is not good. Where market is forming a high probability condition, right? It has a relative equal highs. Price is trading near to an old second stage of distribution. Price is forming a breaker here. Now if you align other ICT knowledge, right, with this, right, we have a fair value gap right here, right next to this up close candle. So this fair value gap is also high probability, but you don't need to necessarily have all the understanding of ICT. If you just understand what I'm showing you here, that's enough. So that's it for our high probability macro profile. This was our second macro profile. Now I'm gonna take you guys into the third macro profile. So this is the whole market structure that I'm gonna share and talk about in market profile 3. What do you guys see here? Before I put the lipstick in, do you guys understand what's happening here? Yes, so as I told you guys when I started the stream, I'll be focusing on teaching you two types of liquidity: relative equal high and trend line liquidity. And price will form this relative equal high and trend line liquidity before macros, and at macros price will clear out the relative equal high and trend line liquidity, right? I already showed you guys the relative equal high, how price forms relative equal high and clears it out in our first macro profile. Now I'll be sharing you when price generates trend line liquidity, how price clears it out. In this profile, we'll focus on trend line liquidity. Before a macro starts, price will engineer three types of liquidity, okay? Relative equal high and low, trend line liquidity, and unfilled fair value gap. So these are the only three liquidities the price will generate before macros. So what do I mean by before macros? When price is accumulating orders, okay? When price is doing accumulation phase. Our accumulation phase is happening when? Outside macro. Our manipulation and distribution phase is happening when? Inside macro, right? So price is, now that we know that we have three types of liquidity that price form outside macro, so this price action must be happening outside macro, right? Because here, as you guys can see, a lot of trend line liquidity is forming plus a lot of relative equal highs. But the main structure here is the trend line liquidity. So when did price form it? Here. This is a must be rule. Price should be forming these relative equal highs or trend line liquidity before macro gets started. And at the macro, we know that this is our accumulation phase, this is our manipulation phase, and this is our distribution phase. And at macro, price will hunt this liquidity, and that's our high probability model. So there are a couple of rules. Now I'll talk about the rules. Price will have to generate trend line liquidity before macro. Okay, so these are very specific market condition, folks, and trust me, if you just go on your trading view, okay, look at this, mark the 20-minute, every 20-minute time intervals, and then look at these 20-minute time intervals. And the profiles that I'm sharing with you, you will find at least one profile. That's all price does other than consolidating. Okay, if price is not consolidating inside a macro, you will see this structure repeating. And I also shared with you that when price is consolidating, how to trade it, right? So here price is not consolidating, rather price is generating trendline liquidity before macro. At macro price will hit a higher time frame PDRA for support and resistance. Okay, so once we identify that price is generating trendline liquidity, we will wait for price to get inside our macro zone. Once price gets inside our macro zone, we'll see that if price is trading inside a higher time frame discount PDRA, because this is a bullish condition, right? Price is forming relative equal highs. So suppose price was forming relative equal lows, we'll be looking for a higher time frame premium PDRA. Just a vice versa of this condition in a bearish condition. This is a bullish example. In our coming examples, I'll be showing you the bearish example, but here this is a bullish condition. So once price forms the relative equal trend line liquidity, we'll wait for price to get inside the macro. Then we will identify if price is trading inside a higher time frame PDRA or not. Once we identify that, we'll be focusing, or we'll be looking for a breaker to form here. Reversal from higher time frame PDRA towards trend line liquidity. And if we can't identify this higher time frame discount PDRA, this trade is not high probability. Our trade idea is happening based on this higher time frame PDRA. Okay, once price gets inside this higher time frame PDRA, we'll be waiting for price to reverse, and this all is happening inside 20-minute time intervals. Model will form inside higher time frame reversal PDRA. So our breaker, okay, where will we look for breaker? We know the price formed our trend line liquidity, and that's what we are targeting, right? But where will we look for the breaker forming? Do you guys know that? We'll be looking for our breaker to form inside where? This higher time frame discount PDRA. So listen to me close here. Listen to me carefully. This market structure is repeating on 1 minute and 3 minute, and we are using 5 minute, 50-minute chart as our higher time frame. Once price does this kind of formation, we'll be looking for price to tap inside a 5 or 50-minute discount PDRA that will be here. And how will you know that that's the higher time frame discount PDRA that price will get reverse, right? That's where macro is coming. So when price is trading inside a fair value gap, suppose there are a couple of fair value gaps in that higher time frame. Close your eyes, you will see it. I know, because we all traders, we are addicted to charts. When we close our eyes, we see the chart. So close your eyes and look at 5-minute chart. Imagine that you are looking at a 5-minute chart. You are looking for bullish PDRAs, and now you see couple of fair value gaps, and you don't know which fair value gaps you are looking for. So the first fair value gap is that it will have to be in a discount zone, okay? Because we are looking for a bullish condition here. So the fair value gap will have to be on 5 or 50-minute chart in a discount, and that fair value gap will have to hit inside the macros. So once you identify the potential higher time frame PDRA, you will wait for price to get inside the times. And once price gets inside the time, that's the period when you will know the price will use this specific higher time frame discount PDRA for a reversal. Without this time, nothing is high probability on higher time frame. Stop loss can be below, above the higher time frame PDRA. So below when we are looking for bullish trade, above when we are looking for a bearish trade. Okay, below the higher time frame PDRA will be the safest condition. The newly generated swing high or low, or accordingly to the entry model. Okay, so this, if you are putting your stop loss below the higher time frame discount PDRA, okay, that will be considered as a safe stop loss. But if you are a little bit, you have the experience and you know that a breaker will form here, you can also manage your trade accordingly with the breaker that will form inside this higher time frame PDRA. TP at the beginning of the trend line liquidity. So Once we identify the trend line liquidity, where will we put our take profit? Now we already know that where we will put our stop loss. Our stop loss will be below the discount PDRA, right? We can also manage our stop loss according to the setup that will form here. Where will we put our TP? So you can target 2R. In this condition, trust me, you will get 2R minimum. But if you want to follow the market structure, you can put your TP where price started forming this trend line liquidity. Once I show it in the chart, it will make a lot more sense. So now let's take you guys in an example, and this is the example. What do you guys see here? Do you guys see the trend line liquidity? Yes, it is very easy to identify. The trend line liquidity is forming here, right? Price formed a high, low, high, low, high, low, high. So a couple of these, we are not looking for anything here, right? We are waiting for price to get inside the macro or near to the macro. We drop down to the higher time frame, right? We have a higher time frame fair value gap here, the hourly fair value gap. Price came inside the hourly fair value gap. There's no potential setup here, right? We have a up close candle here, we have a low here. So this up close candle is working as a breaker, but price didn't actually give you any chance to enter here. Why? Because price wasn't trading inside macro here. Look at the time period here. In this when price did this price action, look at the time. It happened 8:20 to 8:40. So there was no breaker that formed here, right? But there was a breaker. Look close. We have a high here, then higher high. So this down close candles becomes our breaker, right? We have a fair value gap where? At the Reaper. So this is the inversion. You outline the inversion. Price is trading back to the inversion. That's where you enter. So 8:20 to 8:40, that's the time period when we look for a breaker to form on lower time frame, right? And this is 1 minute time frame, and as you guys can see, price did form a breaker even in this macro. But we are avoiding all this. We are focusing in the newly distribution cycle. So 9:20 to 9:30, at 8:20, from the 8 to 9, price formed this trend line liquidity. When did price cleared out this trend line liquidity? At 9:20 to 9:30. Look at here. So here price didn't give you actually any chance. Why? Because price wasn't trading inside the macro. 9:20 to 9:40. Okay, this is an old example, old chart, so that's why I referred here 9:20 to 9:30. But we now consider our macro from 9:20 to 9:40. Okay, we extend it to 10 minutes more. And as you guys can see, inside this 10-minute interval, price formed a breaker. So price retraced back to the breaker and cleared out the trend line liquidity. Isn't it simple to understand, folks? Now let's go to our second example. What do you guys see here? Price generating continuously trend line liquidity, right? It's very easy to understand. If you put your trend line here, it will look like this, our trend line liquidity. Because price is respecting a trend line. Now on higher time frame, price cleared out the sell side liquidity from higher time frame. Price generated this relative equal lows. You are waiting for price to get inside the macro. What macro? We are not looking for any macro here. Our first macro starts at 8:20 to 8:40. So price did this formation. We know that price will form trend line liquidity when? Before our macro gets started. So we already identified that this macro, this trend line liquidity formed. Now we will wait for price to clear out or tap inside a higher time frame PD area. So this time we are looking at an example with a swing low, right? So we have our higher time frame sell side liquidity right here. Price cleared it out. These up close candles becomes our breaker. What do you guys see here? Did price close the candle's body above the breaker here? No. When did price close the candle's body above the breaker? Look very close, folks. At 8:20 to 8:40. Didn't it? It closed the candle's body above. That's when we know that this breaker got activated. Now, when price closed the candle's body above, it also formed this fair value gap. You either can enter here, okay, or you can also take consideration of this fair value gap. Now, in our coming slides I will teach you how to take entry with this fair value gap. Now, do you guys remember we have 4 cycles in our market maker buy model and sell model? Original consolidation, then first stage of distribution, second stage of distribution, and what? SMR zone. So I'm just gonna talk a little bit about this because it's coming in our future slides. This is our SMR zone, right? This is where market reversed. So in our coming market slides, I'll show you guys that how to take trades from the SMR zone using a failed fair value gap, using inversion. So you guys can also use this fair value gap to take trades. There will always be a chance for you to take an entry, okay folks? We are not worrying about the entry. Once we identify this market structure, that price has trend line liquidity, price cleared out the higher time frame, PDRA, then now price is trading inside the macro. Once we identify all these 3 or 4 steps, our entry is not in our thoughts, because either way, one or second way, we will get our entry. So this was our second example. This is very simple knowledge, folks. We are waiting for price to generate trend line liquidity. We know when price will generate this trend line liquidity before it gets inside our specific macro, right? So we identify price generated trend line liquidity. We wait for price to tap inside a higher time frame premium or discount PDRA. Price did it here. Now we wait for price to form a breaker, right? Price already formed a breaker here. Price activated the breaker when? Inside the macro. Then price tapped inside the macro and expanded higher. Cleared out all the buy side liquidity from here. Isn't it clear? So do you guys have any questions about what I showed you guys here? I'll also show another example before I move to our next profile. So let's move on to our next example. What do you guys see here? So before I showed you guys a bullish condition, right? Now in this profile, I'm showing you a bearish condition. So what's happening here? Price is continuously generated trend line liquidity, right? Look at here. All of this is trend line liquidity because price is respecting a trend line, plus price also generated relative equal low. So we know that relative equal low works as a magnet for price. Now we are waiting for price to get inside the macros. Price got inside the macros, price cleared out the swing high, okay? So here it can be a swing high, it can be a fair value gap, it can be an order block, but it should be, this PDRA should be coming from the higher time frame. It should be a higher time frame buy side liquidity, okay? So price formed the trend line liquidity, price formed another high, then a higher high, cleared out the swing high from here. This down close candles becomes our breaker, and this price action is happening inside ICT macro 850 to 910, okay? And now look how clean it is. Price formed a higher high here, new higher high. So this down close candles becomes our breaker. We wait for price to close a candle's body below the breaker. It did here. Plus price formed a fair value gap, right? So price still have a lot of relative equal lows to clear out. Now in this retracement, price is just retracing to accumulate orders to go lower. And as you guys can see, price hit the fair value gap. Couple of times it gives you a chance of entry couple of times, and then it just moved to lower. So in this condition, where will you put your stop loss? Just as I taught you guys in the day one, okay? It depends on what condition is price presenting here. If price is presenting a fair value gap like this, you can put your stop loss above the breaker. If price is presenting a fair value gap premium, you will manage your stop loss accordingly. If price is presenting a fair value gap or inversion here or at the Reaper, right, you will manage your stop loss according to that. Go back to the day one lectures and you will hear me mentioning about this stop loss management and stuff. Is it clear, folks? So Medina is asking, are macro time windows same for all markets? No, it's not same for all markets. Okay, it's same. What I'm sharing here is applicable on stocks, but we have different macros for forex and crypto. So we are done with our high probability macro profile number 3. Now we'll be moving forward to number 4. And before I do that, let's share another example. Okay, let's make it a little bit more clear, because these are the only conditions that will repeat in price, right? So if these conditions are repeating, you should be understanding these conditions clearly. So we have our high probability macro profile, the same profile again. Now look at here. Okay, what's happening here? We have our trend line liquidity. Isn't it easy to identify? Okay, and when price is generating this trend line liquidity, this trend line liquidity is getting generated before our macro. Now price is generating this trend line liquidity. We wait for price to get inside our macro. Now in this condition I'm showing you, you don't have to use in this condition any higher time frame. Okay, if you don't want to use any higher time frame PDRA, it's okay. Once you identify how price is generating relative equal highs or lows, look at the price lag. Here will be our OTE, right? And we have a fair value gap right here. In our coming slides, I'll teach you guys how to take entries by using this fair value gap. Just for now, know that you can also execute from this fair value gap. And this is a very specific fair value gap. It's not like I'm just marking one fair value gap and I'm seeing it right now. In hindsight, I'm telling you, once I talk about this, it will make way more sense, folks. Okay, trust me, this is one of the highest probability inversion model. This is an inversion model, inversion macro profile. I'll teach you guys it soon. So price generated liquidity here. Price came down inside a discount PDRA, right? This is a bullish condition because price is generating liquidity where? In a form of relative equal high. So this is a bullish condition. Price came down, formed a low here. So now look, every single example that I showed you guys, once price hit the discount PDRA, only then it formed the breaker, right? So you can either take entry from here based on OTE or from this inversion fair value gap that I'll teach you guys, or you can wait for a breaker to form. Do you guys see a breaker here? We have a low here, we have a lower low. Now you'll tell me, okay, HYDRA price didn't give me any chance to enter here. Now wait, price did retrace all the way down to the breaker again. Look close, folks. We have our low here, right? Let me see if I can zoom it in. Yeah, I can zoom. So we have our low here, right? Price went below this low, new lower low. So these up close candles becomes our breaker. So what do you see here? Once price traded towards buy side liquidity with speed, there's no way you are entering here because it's too speedy. It's happening way too faster. But price did generate a fair value gap here, right? And price did give you time to identify the fair value gap. You can tell me, okay, HYDRA, it was too fast for me to identify. Now look, 1, 2, 3, 4. This price action is happening on 1 minute chart. So you got 4 minutes before price came down inside to this fair value gap near to the breaker. You got 4 minutes to execute. Now once price came down here, you guys already know what to do. You see the fair value gap, you execute here, okay, and you put your stop loss below the breaker here, and you target the beginning of the trend line liquidity. Now is it clear, folks? Naresh is asking how we handle the 9:30 market manipulation if it's happened before. If we were for stop hunt, or what can you explain? Okay, Naresh, I don't understand what you were saying, but this will happen inside macro. There's no way that this is happening outside macro. Okay, if this is happening outside macro, I'm not saying like it's 100% that this will happen inside macro, but this is high probability. When it's happening inside macro, only then you are taking it as an entry. Now don't get greedy. If you don't see this formation happening inside one macro, we have multiple macros throughout the day. Okay, if this is a very specific setup, folks, look at here. Price generated relative equal highs in a form of trend line liquidity, right? Price came inside, dropped down to a discount fair value, sorry, a discount PD area. Then price formed the breaker where? I'm also telling you where price will form the breaker, near to the discount PD area, inside the macro time periods. Okay, it never gets any easier, folks. Then price showed you a very clean breaker pattern. Okay, low, new lower low, up close candle becomes our breaker with a fair value gap. Price retrace back to the fair value gap. That's where you enter and target to R. Isn't it easy? Are there also macro times for gold? Am I talking about gold? Did you ever heard me talking about gold? Okay, folks, I don't trade gold. I don't have any idea if there's any macros on gold, and I'm not talking about gold. So what I'm talking here, focus on this. Suraj is saying how to identify manipulation versus distribution. Distribution is happening inside macro. Okay, manipulation is happening outside macro. So I believe you missed my first lectures from day 2. So go back to this stream and listen to it again. You will see me mentioning all the stages: accumulation, manipulation, and how it happens. So now let's go to our next profile. Oh, okay, so before I do that, I have a couple of notes here. High probability inversion forms at the SMR zone. So I told you guys that I'll be talking about this fair value gap, specifically this inversion fair value gap in our inversion model. Inversion at SMR zone can be used to confirm market structure shift. So this inversion, we can use it to confirm market structure shift. This is coming in our later slides. So now let's look at market high probability macro profile number 4. So in this profile, this is what we are looking at. Okay, now we don't have a trend line liquidity here, right? But we have clean swing highs. Before I told you guys when prices, do you guys remember our first profile? There I shared how to trade when price is consolidating. In our second profile, I introduced to you market maker buy and sell model. In our third profile, I shared how to trade when price is generating trend line liquidity, right? Now in our fourth profile, I will teach you how you can trade when price is generating relative equal highs and lows. All of these conditions, folks, will repeat inside each and every macro. Okay, the thing is, I don't know at what macros price will present this, but there's a way to know. Okay, what's the way? These liquidities, because this accumulation is happening outside macro, right? So inside macro, price is doing our manipulation and distribution. So we are outlining our targets in hindsight. Price already presented our target. Now we have our target. We are waiting for price to hit our discount PD area. Then we are waiting for model inside macro. Then we are waiting for distribution. Now let's look at this phase here. So once price generates relative equal high, right, and drops down, and we have this relative equal high intact, we'll wait for price to hit a higher time frame key level. Okay, this key level is a higher time frame PD area. So once price hits this higher time frame PD area, we'll wait for price to get inside the macro, and then we'll be looking for this condition here. But in this condition, there's another thing. In our market maker buy and sell model, I told you guys that in our first stage of distribution, we are not looking for any stop hunt, right? But I also told you guys that price can do a stop hunt in the first stage of distribution. So what will you do when price is doing that? So that's what I'm gonna teach you here now. So do you guys remember the 4 phases? Original consolidation, first stage of distribution, second stage of distribution, smart money reversal, right? Then we have our first distribution here. Now what's the difference here? Price came all the way down and cleared out the first stage of distribution swing low. In our previous slides where I introduced to you the market maker buy and sell model, there was no stop hunt. We didn't see the second stage distribution going below the first stage distribution, right? But this time our second stage distribution is going below the first stage distribution. That's what we'll be looking at. In this profile, we are focusing at SMR, at what time reversal happening. We will also focus at the first stage swing low to get taken out by second stage swing low. In this market profile, our first stage distribution low is getting taken out by second stage distribution, okay? That's why I marked it as a high probability macro profile. And let's look at this. We have our first stage swing low right here, our second stage swing low that formed here, and this is forming inside the macro. So a question can be like, HYDRA, how can I know the price will shift here? Very, very nice question, but a very basic question. Your question can be answered very simply. If price is trading inside a trend continuation macro, only then in this condition we are looking for a trend continuation. Now, do you guys know about the trend continuation macro? Yes, in the day 1 I shared these time intervals, the trend continuation macro, where price will continue a trend, and now I will teach you at what scenario we'll be looking for price to continue its trend. In this scenario, our target in this profile is relative equal high or low. Before the second stage distribution, market will generate more equal highs, and this will work as extra confirmation in our trades. So there's another way to know that market will not continue its trend here, rather it will reverse. The way is that price will generate relative equal highs before it clears out the first stage low. Now I know that it's sounding a little bit more complex compared to the other models, right? But trust me, once I show you guys the actual chart examples, it will become much more sense. So we can execute here once price clears out the swing low right here, or we can wait for a breaker to form right here after the second stage, after price clears out the second stage low. Sorry, after price clears out the first stage low with second stage distribution, second stage manipulation right here. So let's look at our example. This will make it a lot more sense here. So what do you guys see here? We have a SMR zone, right? So before we do that, we are outlining our targets. We have relative equal highs up here. Do you guys see it? Price formed a couple of relative equal highs, but didn't go above this swing, old swing. Price came all the way up and then went lower, right? Price hit this discount PDRA, and that's where our smart money reversal happened. So we were able to identify our smart money reversal. Now our first stage of distribution is happening here. Now in this market structure, okay, we are looking for price to clear out the first stage swing low by the second stage swing low. What do you guys see here? Price came all the way down, cleared out the first stage swing low, but not going below the SMR zone. This SMR zone should hold, okay? We are not executing right here. That's the main magic of this market structure, because market is already showing its hand to us, and once we identify this condition, only after then we are executing. And this right here is happening inside our execution is happening inside the macros. So our SMR market smart money reversal happened at the discount fair value gap right here. We are able to identify that market changed its shift. Now market went lower, generated a first stage swing low. Market came up, did another stop hunt, went below the first stage swing low. So we are not doing anything here. Okay, we are waiting for price to go above because we are looking for breaker to enter, right? So we have our breaker here, low, new lower low. So these up close candles becomes our breaker. So we'll wait for price to do the second stage swing low. Once price does this, we know that the change in delivery is now completely shifted. We can execute with confidence. And we have our breaker here. We have a fair value gap alongside with the breaker. Price came all the way down. Price activated the breaker. Okay, price went above, closed the candles body above the breaker. Now retrace back to this fair value gap and expanded higher. Yes, so the second stage swing low is also happening inside our trend continuation macro. So if you guys look at the time, okay, here it's happening at 10:50 to 11:10. And do you guys remember 10:50 to 11:10? What is this? It's our trend continuation macro. Price is doing its thing here. So this I will teach as a turtle soup in our day 3. So don't worry about this. Okay, don't think like I'm not gonna teach you. I'm gonna teach you that your $80 is like you will get way much more value than $80 here. So don't worry about that. I'll also teach you guys how to execute here, but not today. We are only looking for to enter with breaker with market maker buy and sell model. Okay, so in our first market maker buy and sell model, we didn't had a stop hunt here, right? In our first stage swing low, we saw that price went up, right? Price formed a second stage distribution near to an old second stage distribution. But this time is different. Why it's different? When price is coming down and clearing out this first stage swing low, this will also work as a confirmation. Now this scenario will repeat like less of the time compared to the other two scenarios that I shared, the trend line liquidity, the consolidation model, and the other models that I shared with you all. Now this one also repeats. So when it repeats, if you see it, if you identify it like this, it's easy to trade, right? Because price is opening its hand. You are outlining the SMR in hindsight. You are outlining the first stage swing low in hindsight. You are outlining the second stage swing low in hindsight. So once price does the second stage swing low, you are waiting for price to reverse and go above these last up close candles, and that's where you are executing. Now does it make sense? Yeah, so there you guys can see the 0.5 level. This is the measurement of this price lag from this high to this low. This is our dealing range, right? So I'm not doing a mentorship here, so I'm not gonna teach you guys about the dealing range and all the basic stuff. But if you are still confused about the dealing range, you will have to wait for me to launch the mentorship. There I will teach like from the A to the X, like from the basic, very, very basic hand-to-hand teaching will be there. But you will have to have the basic understanding of a dealing range. If you understand that, you know that we have our dealing range from this swing high to this low. Our discount, premium and discount level is coming here. And do you guys see how price respected the dealing range here? So when you put everything together, it makes sense. But when you are looking at like one by one, it becomes choppy. But because the thing is that we are outlining all this in hindsight, right? We are waiting for this in live price action. So all of this is working as a confirmation in our price. So let's go and watch our second example. I hope it will make sense. So let's look at our second example. Now here I put in a lot more information than I usually do in example, right? So here's a lot of things happening. What's happening here? We have relative equal lows down here, unfilled fair value gaps, but what we are focusing here, we are looking for first stage swing low to get taken out by the second stage swing, first stage swing high. This is a bearish condition, right? Previously I showed you guys the bullish condition here. So now we are looking for price to clear out the first stage swing high with the second stage swing high. So we have our first stage swing high, price reversed here. This is our SMR zone. Okay, all of this extra information is for you to understand. Okay, I'm not gonna go through all this extra information that market is shifting here. Is for you when you look at these charts alone, so that you understand better. These are the basic stuff. I'm not gonna go all through that. I'm only showing you the market structure that's happening here, the market profile. We are looking for first stage swing low to get taken out by the second stage swing, first stage swing high to get taken out by the second stage swing high. Once price does that, we will know that we have a breaker here. We have a high probability breaker here, but at the same time, price here formed two breakers. We have our first breaker here, we have our second breaker here. And price didn't actually gave any chance to enter the first breaker, but at the second breaker, as you guys can see, once price closed the candle's body below, after doing the stop hunt here, it went lower. It gave you multiple chance to enter. So I also drew the market structure here. Okay, so we have our SMR zone here, the smart money reversal zone, right? Once the smart money reversal zone happen, we'll be outlining our first stage distribution, which is here. Now this first stage distribution will have distribution high, will have to get taken out by the second stage distribution high. Does it make sense? It's getting taken out. So we are not doing anything here, folks. So try to understand that we are not doing anything here. Once price does clear out the first stage swing high with the second stage swing high, only then we are looking for these down close candles. And that's when we will know that this is our high probability setup. Does it make sense? So you guys can ask me questions about this macro profile if you have, before I move to our our next macro profile. Okay, Jai is asking, are also a reclaimed breaker those two down close candles near 1045? Okay, are you talking about this chart, J? 1045, let's see. Oh, I think you were talking about the last one. Yeah, so we are not looking for any reclaimed breaker here. Okay, I told you guys that we are looking for the first stage swing low to get taken out by the second stage swing low once we identify the smart money reversal. Once price does that, we will know that these up close candles that are here will be working as our high probability breaker. AMCO is asking, where is the entry and the stop loss in this particular case? Our stop loss and entry, I already told you guys about this, because I'm not teaching you guys a new PD array here to enter. This PD array I already taught you guys in the day one, and I taught you guys how to manage your stop loss with this. Okay, we have our fair value gap forming here. Everything that formed here is already taught inside day one. So go back to the day one. I believe that you didn't finish the day one clearly. That's why you guys are asking questions like that. Go back, listen to the day one lectures again. You will hear me mentioning about how to manage stop loss here. And once you are done covering the day one, come back to it again. It will make way more sense. So now let's look at the high probability macro profile 5. Okay, so now here we'll be looking at a retail concept, and we'll transform that retail concept into smart money concept. So this is a flag pattern, folks, right? I already believe the folks who have experience, we all started with retail logic, and as you guys can see, we have a flag pattern that forming here. We have high, then low, high, low, high, and this is basically price is forming a flag, and that's how retail teach it. So one price breaks out from this flag, you will execute here, right? Once price is retesting, and you will target higher. So this is a high probability condition, folks. Okay, not in this scenario. I'll teach you guys how to what's the high probability scenario here, but this retail logic, trust me, it repeats more often than you can think of. Okay, you didn't know about this pattern before, or ICT specifically don't teach this pattern, but I'm gonna show you guys how to trade this pattern. And once you see it, you will go on your own chart and you will be able to identify it very easily on lower time frame. So retail theory is liquidity for smart money. What they're doing here is not what we are doing, but this will form in chart, folks. Okay, this flag pattern, don't think like, okay, it's a retail theory, so it's not gonna come in chart. It don't exist. It exists. The same theory will form in chart, but we'll see it differently. How? So we have our flag forming here. So what a flag basically is, if you don't have any idea about it, it's a flag, right? Price is trending higher, then it's just consolidating here, right? So it formed what? If we see a flag pattern forming, we will wait for price to take out either one side first and then hunt liquidity in the opposite direction. So just as I taught you guys in the first macro profile, do you guys remember? There I showed you guys how to trade the relative equal high and low. We wait for price to clear out one side and then hunt the opposite direction. The same thing here. But what the retails are doing, look carefully. The retails are not targeting the opposite direction, rather, right, they're executing when price is breaking out of one direction, and they're targeting the same direction. What we will do, we will target the opposite direction. So once price, what's different with retail is that they're taking trades here. We'll look for price to come. Once price clears out the liquidity from here, right, we'll wait for price to come all the way down and then do the retest here. So how will the formation look like? We'll identify the flag, relative equal high and relative equal low. So just like the retail theory, price cleared out the relative equal high. So the retail will be entering here with a stop loss below here, because these are like double, triple bottom. This should hold in retail theory. Price should not go below here, because that's where the retail says to put stop loss. Why? Because that's a strong support level, right? Price couldn't go below this level. It's struggling here, so that's how retail sees it. But what will happen next is that this price will come all the way down, hunt the retail stop loss, and then move higher. Okay, sorry, then continue its trend lower. Okay, so what price is doing is that it's hunting retail stop loss. Right, so what retail will be doing here, they will be entering a trade here, right? And now when they got stopped out, they will be like, okay, now let's take the trade in this direction. Once price goes down here, they will be looking for a buy, right? They looked for a buy here. Now they'll be like, okay, price dropped down to a discount level. Now let's look for a buy again. And price does what? Price moves even lower. That's how it works. It's a very common pattern, folks. The same freaking thing will repeat. Okay, the same freaking thing repeats in chart every single day inside the macro period. So what you will be doing here is when price does this stop hunt, it's our manipulation phase, right? This is our accumulation of orders. This is our manipulation. So accumulation is happening outside macro, manipulation is happening inside macro, right? So this is a turtle soup entry. This is what I'm not gonna teach you today. This is gonna be specifically for day 3, but this also exists. You can take entry here. I'll make it easier for you guys. Now it will seem harder, like how can I take entry here? You can take entry here, but what we are doing here is we are waiting for price to activate a breaker. Do you guys see the breaker formation here? That's the magic with trading with one model. It becomes so simple when you are trading with one model and looking at market with one model, right? Where price did a stop hunt here, right? So these down close candles that are here will become our breaker. So price did a stop hunt. That's what retail don't know. In retail world, this doesn't exist. If you show this to any retail trader, they will think like, okay, this is not a pattern. This is not a common pattern. This is not a high probability pattern. They will not trade it. And that's what we are doing. We are trading it. Plus, there's more logic. It's not like price is just taking buy side liquidity. Then once price comes down here, we are taking trades. No, there's more details. We are looking for a breaker here. Okay. So our last down close candles will work as a breaker, and that's where we will take our trade, targeting lower price. Does it make sense? It's as simple as that. So this is the end of our breakers. Okay, we will not talk about any more breakers in our coming lecture days. We have one more lecture days. I'm thinking about doing another one with you guys. So I believe there will be day 4 too. Day 4 will be basically about your talking about your questions, like what you didn't understood. If you guys want to see more examples, then day 4 will be based on that. Now I'll show you guys or teach you guys how to take entry with inversion. So if you guys attended my day 1 lecture, or if you guys saw the recording, I already shared a couple of inversion model, like how to take inversion, how to take setup when price has a breaker has an inversion, right? Do you guys remember inversion in the premium lag, inversion in the discount lag, inversion in the reaper? Now today I'll show you guys how to take entry without breaker just by using an inversion. So before I do start, I'll take a 1-minute break. I'm just gonna go and drink some water or make a coffee, and I'll come back, okay, and start the lecture. I hope you guys will be patient enough. Just 1 or 2 minutes, folks. Let me know in the chat, folks, what I'm talking and sharing here, does it make sense to you? Let me know in the chat. Okay, I'm back, folks. So our high probability inversion profile, we'll be talking about 2 inversion profiles today, and the next inversion profiles that I'll be sharing, it will come with day 3 because it's specifically related with turtle soup. Okay, folks, so let's look at the inversion profiles. So now we are not looking for any breaker to enter, but we're gonna be looking for to take trades using inversion specifically. So what's the logic here? So we have as you guys can see, we have a price swing here, right? So we have a key level here. So this key level can be a swing high, can be a higher time frame premium PDRA, because this is a bearish condition, right? I'll show you guys examples of bullish, bearish in both conditions, but this here right now is a bearish condition. So the logic is very simple, folks. The way I'm saying it to you, it never gets any simpler than this. Even ICT himself is not explaining this simply. And it's not like it's simple and it doesn't work. It works at the same time. Once I'm done explaining the lectures with inversion, I'll take you guys in the actual chart, okay, without hindsight. I'm gonna show you guys exactly what I taught you guys, how easy it is to spot on actual chart. I'm gonna show it to you all. So we have our key level here. So this key level can be a swing high, a higher time frame premium PDRA. So once price hits the premium PDRA or clears out a swing high, we'll be looking for price forming a fair value gap. Okay, so where will this fair value gap form? When price is clearing out the old swing high or swing low or hitting a premium or discount PDRA, when price is getting inside that premium or discount PDRA, we'll be focusing at the last fair value gap that formed before price cleared out the swing high or tapped inside the premium PDRA. So suppose we have a swing high here, okay? So price went up. This is our last fair value gap that formed, right? So what we will do, we'll wait for price to go below this fair value gap, because this is a bullish fair value gap. And now we are learning how to trade from a failed fair value gap. That means what? An inversion. So for this fair value gap to become inversion, it will have to get failed, right? So how does it get failed? When price closes a candle's body below this below this fair value gap, that's when it becomes an inversion. And that's a high probability scenario, folks. Okay, once price closes a candle's body below the inversion, at the very next candle you execute with a stop loss above here or above the candle's body. It's gonna depend on the market structure. Okay, I'm gonna show it to you in our next couple of slides, in our next examples, but this is the simple logic. We are waiting for price to clear out an old swing high or low, and before price does that, price will have to generate a fair value gap, right? And once we identify that fair value gap and price clears out the old swing high or low or a premium or hits a premium or discount PDRA, we'll wait for price to go below this failed fair value gap, this fair value gap, and then we'll wait for price to close a candle's body below this fair value gap, and that's when this fair value gap will turn into an inversion. And when price does that, it's one of the highest probability market profile that you can find anywhere, okay, folks? Because you can manage your stop loss very, very tightly. You can put very narrow stop loss with this model. A high probability inversion forms after price hits a key level in price. Okay, so what's the key level can be? The key level can be old swing high or low, premium or discount PDRA, and the OT. So there are three things, okay? There are three specific things. This key level can be an old swing high or low. This key level can be a premium or discount PDRA. So suppose this price is hitting a premium breaker, okay, in a higher time frame PDRA. So we are not learning how to take trades on higher time frame, but how to execute on lower time frame. So you saw a higher time frame breaker and you are not executing here. So what will you do? You will drop down to the lower time frame, and the high probability condition is that another breaker will form with the new old breaker. But what if the old breaker doesn't form? This is what you'll be doing when a new breaker is not forming, okay? Once price hits the old breaker, we will expect to see price forming a new breaker near to the old breaker. But if it doesn't happen, this is the condition. This is the fair value gap that we'll be looking for, and this is our entry model. So our key levels are old swing high or low, premium or discount PDRA, and OTE. So let's look at the market structure. This is our key level, right? Price is trading higher. This key level can be old swing high or low. This key level can be a premium or discount PDRA. It can be a fair value gap, order block, a old breaker, anything, okay? This is just a key level. So once price hits this key level, we'll wait for price to generate a fair value gap here. So this fair value gap is not yet an inversion, because price can easily come down here, because this is a bullish fair value gap, right? Price can easily come down and trend higher. So how will you know that the change in market happened? When price goes below the inversion. This is the advanced market structure shift theory, folks. You don't need a market structure shift here. Am I teaching which breaker? I didn't taught you market structure shift. With anything here, I didn't taught you market structure shift. Everything that I'm teaching here is coming without a market structure shift, okay? We are predicting market structure shift by using this fair value gap. Once price closes a candle's body below this old fair value gap, below this inversion, that's when the market structure shift happened. So once price hits this hits the key level, you wait for a fair value gap to get generated, then you wait for price to close a candle's body, just like it did here, candle's body below the inversion, right? And then retrace back to the inversion at the next candle. You are not looking for a deep retracement. What do I mean by that? Suppose price came lower and then did a deep retracement. I'll show you guys examples on that, but that is not a high probability. This is what a high probability is. Price closing candle's body below at the next candle. Look at very close, folks. This candle, when it opened higher, right? It went higher. It traded inside this inversion. That's when you execute. So suppose you missed your entry here. At the very next candle, you will get a chance to enter. So this is our market maker buy and sell model. That's what is repeating here, right? We have our original consolidation, our first stage of distribution. This is our second stage of distribution, right? So now I'm teaching you how to take entries here. If you fail to take any entries here, we have our second stage of distribution forming near to a old second stage of distribution. So market is giving you how many chance to enter or take a trade? Multiple. So that's why when you see me like streaming and trading live in front of you, I never worry about a entry model, okay? Because I know if I the only thing that I need to understand is the market structure, what price is doing now. Entry, I'm not worrying about that. If I miss an entry, there will be more chance, okay? There will be more chance coming in a day, in a week. So now let's look at this in actual chart, okay? So what's happening here is our immediate rebalance. I already taught you guys about immediate rebalance in our day one. So from our first slide, we know that we'll have to identify a key level. This key level can be a all swing high or low, a premium or discount PDRA, or a OT, right? So suppose this is a all swing high or low. So what price did here? Price came all the way up, right? Traded, hit this all swing or cleared out the all swing high. Then what price did here? The last fair value gap. We are looking for the last fair value gap. Price came down, closed the candle's body below this last fair value gap, okay? It's this simple, folks. We wait and execute at the next candle, and look how price is, how the candle's bodies are staying inside this inversion, right? So where will you put your stop loss? Above this swing high. There's no way price is going, after price closes a candle's body below, okay? If price is going above this swing high, you are wrong anyway. So your stop loss can be very, very, very slim, right here, okay? With a breaker, our stop loss is a little bit big, right? But with this model, our stop loss is very small. We are executing here at this candle, or suppose you missed to enter at this candle, or suppose you missed here, then you can execute it here. Price will give you multiple chance to enter once it closes a candle's body below this fair value gap. In a bearish condition, once price closes a candle's body below inversion, you don't want to see price going above or closing a candle's body above inversion. This is the most important rule, folks, with this model. Once price closes a full candle body below this fair value gap after hitting a key level, you don't want to see the next candle and the next candle going above, Okay, the wicks can go above. I'm talking about the candle's body. Candle's body should specifically stay inside this inversion, and that's what you are seeing here. This is what I refer to as immediate rebalance, and I already taught you guys what immediate rebalance is and how you take entries with it in our day 1 lecture. And as you guys can see, price continues trend lower. This is our sell side liquidity. That's where we target. You can either trade 2R if you are a very beginner. Okay, if you don't have much experience with these charts, I'll highly suggest you to stay with 2R. And once you are experienced enough, once you are taking like a lot of trades and your win rates are high on a monthly basis, only then you can take like high reward trades. Like this is more than 2R, right? If this condition is repeating in market structure and you are seeing it, this is more than 2R. As long as candle's body is staying below or inside the inversion, is a high probability scenario. I already talked about this, so this is something that you don't want to see price going above. The wicks, okay folks, it does the damage. So it doesn't matter as long as price is closing its candle's body inside the inversion. The wicks, it's allowed to go above, but not above the swing high. If price is doing a stop hunt here again, then you are probably wrong. And if price does a stop hunt again, it's generating another entry model. Okay, so don't lose hope. Suppose you took a trade here, and no trade is 100% winning guarantee, right? So suppose price did a little bit more manipulation, price went above this swing high, then we will have a breaker, right? Once price goes above the swing high, these down close candles here will work as a breaker. So why are you worrying about an entry model? Even when you are losing, price is generating another entry model, right? So let's look at another example. So in our previous slides, I taught you guys about immediate rebalance. We'll be looking for to take entry when price is like doing something like this. Even in the previous slide, I showed you guys that once price closed the candle's body below, we are executing at the next candle. Now I'll show you guys how to take trades by using the same model when price is retracing, doing a lot more delivery and retracing back to the inversion. So this is an example here. We have our all swing high, right? So from the first slide, I'll take you guys back to the first slide. We have our key level. Our key level can be 3 PDRAs, all swing higher low, premium or discount PDRA, and OTE, right? So here we have a swing high, and what do you guys see here? Price cleared out the swing high, and then at the same time price generated a fair value gap here. Now what our rule says, we will wait for price to go below this fair value gap, right, and close the candle's body below here. So this is not an inversion yet, this is just a fair value gap. We will refer to this as an inversion once price closes the candle's body below. Now there's more to it, folks. Okay, we are not just looking for an entry here, you will also have to have target. Do you guys see the target here? Relative equal lows, right? Relative equal lows. This is a very small relative equal low, but this and this are very close. Now what do you see here? In our previous examples, we saw that with one candle price did a closure right below the inversion, but here price is doing closure below the inversion with multiple candles. So this is another scenario. Most of the time, okay folks, you will see price repeating this, but when price is doing this, you will be looking for this scenario. When price is not closing a candle's body, when price is not closing below inversion with one candle, one single candle, you'll be looking for this scenario right here. When price does closes the candle's body below the inversion with multiple candles, you will wait for a retracement. Now in our previous slide, right, we didn't wait for a retracement. As soon as price closed the candle's body below the inversion, we executed the next and the next candle, right? But here, what's the difference? Here price didn't close below the inversion with one candle, but with two candles. So in reality there can be 3-4 candles, it doesn't matter. If price is not going below inversion with one candle, then we'll wait for price to retrace back to the inversion again and then drop lower. If price is closing below this inversion with one candle, we look for immediate rebalance. That means what? We executed the next and the next candle. But if price is not closing a candle's body below this inversion with one candle but with multiple candles, we wait for a deeper retracement. Does it make sense? When do you expect immediate rebalance? Did I answer it? Yes, when price closed a candle, when price closed a candle's body with a single candle below the inversion, that's when we expect immediate rebalance. But what happened here? Price didn't close the candle's body below the inversion with one candle but with multiple candles, right? Now we wait for a retracement back to the inversion, and as you guys can see, this will be your OTE. So suppose you put your fib here to this low, this will also be OTE. If you are putting like other logic with other basic ICT logic, this will make way more sense. We also have another fair value gap here. So if you are just looking at this as a premium and discount like this, so we have our premium here, so this is a premium fair value gap, right? Price did a aggressive delivery here. So let me go back. So aggressive delivery here, there was no bullish delivery here, so we need a bullish delivery here. So what price did after hitting a discount PDRA, right? This is a discount PDRA, this is a discount fair value gap. Price did retrace back to this inversion. So now we know that price will retrace. How do we know? Because price didn't close below this inversion with one candle but rather with multiple candles, right? That's when price does this. This is very specific, folks, okay? When price does this, we wait for price to retrace back to the inversion and then hunt lower. So with this model, do you see how you can manage your stop loss? Very narrow stop loss. So do you guys have any question? If you guys have any question, feel free to ask me. When we don't have an entry with immediate rebalance, we will wait for price to retrace back to the inversion after tapping into a discount PDRA. Okay, so this is what's happening. If price is not showing any willingness to retrace after hitting a discount PDRA, we won't consider taking any new consider taking any new PDRA. Okay, here I made a mistake. Any new entry. Now it makes sense. Okay. Does it make sense, folks? You guys can ask me question if you have any. Okay, Amco asked a very nice question. Does inversion has to be in the same time frame, or we have to shift to lower time frame to see inversion after price has hit the higher level or higher time frame? Okay, so if you spot this price action, what price action? If you see price generated a fair value gap on higher time frame like this, you will drop down to lower time frame, okay, and you will look for a breaker forming here. But what I'm teaching you here is this is forming on 1 to 3 minutes. So there's basically we are not trading on second charts, right? I'm not gonna teach you how to trade on second charts in 3-day bootcamp. It will be included with my mentorship. I'll teach you guys how to take entries on higher time frame. Like in the mentorship, this is just a 3-day bootcamp, okay? I'm talking about 3-day, three different models in 3 days. This is not a mentorship. In a mentorship, you get to know about everything that there is in the market. So these rules are very specific. If you see this in a higher time frame, you will drop down to the lower time frame and you will mark this inversion from the higher time frame. You will look for a breaker forming here inside this inversion on lower time frame. So suppose this is a 4-hour time frame, okay, and this is happening on 4-hour. You will drop down to the 1 minute chart, and you will look for a breaker forming inside this 4-hour inversion. Does it make sense? Now we'll be looking at the inversion profile, the second one, okay? The second inversion profile. This is the market structure for second inversion profile. Do you guys remember me saying that in our smart money reversal zone, SMR zone, will be looking for an inversion, and that's where our high probability inversion will form. So what's our SMR level here? This is our SMR level, right? So we'll be looking for an inversion to form here, or a fair value gap. So this is our SMR. In this profile we'll focus, and this is one of the easiest one, okay folks. So far what I showed you guys, it's easy to spot on higher time frame. So the last one, the inversion profile 1, it's not bound to lower time frame. You can use the inversion profile 1 with lower time frame, with higher time frame, but that one is high probability on lower time frame, but it can also be found on higher time frame. But this one, okay folks, there's no rules. You will see it on lower time frame, higher time frame, exactly the same way. The same way it repeats on the higher time frame, the same way it will repeat on lower time frame. So in the previous slide, okay, let me take you back. When MCO asked the questions like, suppose this price action is repeating on higher time frame on 4-hour chart. So I told you guys, if this is happening on 4-hour, you will mark this inversion, you will drop down to 1 and 3 minute, and you will look for a breaker forming here. So with this model, what I'm gonna show you here, you are not gonna look for a new breaker forming, but the same thing repeating on lower time frame, okay? It will make more sense once I show you guys the chart example. In this profile, we'll focus at the SMR zone and the fair value gap inversion that formed there. The fair value gap and inversion that formed here. So what's the logic? We have our inversion here, right? So the logic is that when price comes inside a old SMR zone, we'll be looking for inversion there, and before price goes below this low, we'll be looking for to take trade by using this fair value gap from this SMR leg right here. Once price closes a candlestick body below the inversion, we'll look for high probability entry right here. Wait, okay, right now I know that it doesn't make sense, or it's getting complex. Once I show you guys the actual chart example, it will make way more sense. Okay, it's the easiest one. We'll look for a new PD area to form in the new distribution cycle near to the old inversion fair value gap from SMR zone. Okay, I'm gonna read it again. We will look for a new PD area to form in the new distribution cycle. That means what? We'll be looking for a new PD area to form here, and this is happening where? Near to the old inversion fair value gap from SMR zone. There will be an inversion. We'll be looking for a new PD area to form here, but our trade idea will be based on this inversion. If a PD area forms here, it will work as an extra confirmation, but we don't necessarily need a new PD area to form here. We can just execute based on this. This repetitive high probability scenario will appear every day on stock, forex, crypto. Okay, I'm not gonna show you guys other profiles in chart, but today I'm gonna take you guys on the Dow, and I'm gonna show you guys how this one forms once I'm done lecturing this. So how it looks in actual chart. So first we'll have to identify our SMR zone, right? So this is our SMR zone. And what's our rule? We will have to identify the fair value gap that formed inside this SMR zone. So price have had a buy side liquidity here, price came all the way up, cleared out the buy side liquidity. We are not looking for anything here, okay, but a breaker did formed here, right? We have a high, new higher high, so this down close candles becomes our breaker. Once price closed the candles body below the breaker, the next candle, as you can see, price did give you a chance to enter here, but we are not looking for anything here. We are looking at this inversion that formed at the smart money reversal zone, okay, specifically here we have our this inversion. We wait for price to close a candle's body below this inversion from the SMR leg. Once price does that, we'll outline it as an inversion and we'll look for price to trade inside here, just like this, okay. It's as simple as this. What's the difference? The previous one that I showed you guys, the inversion was forming here, right? Now we are looking for an inversion here in the SMR lag. So you don't have to know anything what's happening here. What you are looking to know is that once price comes near to the SMR zone, you will be looking for a fair value gap from the SMR leg. So you identified the fair value gap from the SMR, you extend it out on time, and you wait for price to close the candle's body below this old fair value gap. So when price does close the candle's body below this fair value gap, it becomes an inversion. So we already know the inversion. When price closes the candle's body below the inversion, the next candles that price will generate, the bodies of these candles should remain inside this inversion, okay. So the rules, I'm going to share the rules again. Inversion at SMR zone, we have our inversion at SMR. Wait for price to reverse and close, and the close of candle body below the inversion from SMR. So wait for price to reverse. Price did reverse here, right? And close the candle's body below inversion. Price did came down all the way down here, close the candle's body below here, below the SMR. A new PDRA forming near to old inversion. So we have our old inversion here, a new PDRA formed here. Do you guys see the new PDRA? Yes, this fair value gap. A new fair value gap formed near to this old inversion from the SMR leg. So we don't necessarily need it, okay. We can just trade based on this, but if price is also forming a PDRA here, we can also use this as an entry criteria, and this will give us more precision. When price is forming a new PDRA near to the old inversion from the SMR lag, we can execute here rather than executing here inside this inversion. Once price traded back to this fair value gap, we can execute here. We can put our stop loss above here. Once price closes a candle's body below inversion, the next candle body should remain below the inversion. So once price does closes this candle's body below the inversion, each and every candle that will open next, they should remain below the inversion. So this is a chart example from the daily Dow, okay. So on the daily chart on Dow, if we go and look at the daily chart, you will see it right now. So let's look at another example, and before I do outline it for you, I'll give you some time to use your eye to put the lipstick before I do that, okay. I'm just gonna give you guys 1 or 2 minutes. Do it on your own, and if you guys have any questions about this, ask me in the chat. Naz Life, I know bro, you joined later. I already talked about this, okay. SMR zone, how do you identify SMR zone? Go back and listen to the stream from the beginning. You will hear me mentioning how to identify SMR zone. So let's see, let's put our lipstick. So what's our rule says? We'll have to identify a SMR zone first, right? So this is our smart money reversal zone. And now the next thing that we'll have to identify is if there's any fair value gap in the SMR zone, an inversion fair value gap specifically. Do you guys see it? Yes, it's here, right? That's where price changed its trend, and that's where the fair value gap formed. We mark the fair value gap, we extend it out on time. Once price closes a candle's body below, as you guys can see here, price did close the candle's body exactly below this inversion. We are not looking for anything here, okay? We are waiting for price to close the candle's body below the inversion from the SMR leg. Once price does that, each and every candle that's opening here should remain below the inversion. Now you can use this entry, this inversion to take an entry here once price is trading inside. Where can you put your stop loss? Above here. Okay, you can put your stop loss above here, and then you can target 2R, or you can wait for price to form a breaker inside this inversion. And it did form the breaker here. We have a swing high here, a new higher high, so this down close candles becomes our breaker. Extend it out on time, and you will see price beautifully respecting this breaker, plus price formed a fair value gap right here. So if you missed a chance to enter here, price will give you another chance to enter here. Isn't it simple, folks? This chart example is from October 2023, 4-hour Dow. So we have our SMR zone right here, right? So we have another SMR zone right here. This is a smart money reversal zone. Okay, now price is yet to reach all the way up here, but every single time price reverses, folks, there will be a fair value gap. Now, do you guys see a fair value gap, an inversion fair value gap right here? Yes. Do you guys see it? The last one, okay, the last one before price reverses. Did price reverse here? No, price continued trend higher. Price reversed here at this leg. Price closed the candle's body below this fair value gap, right? You extend this inversion, just as I taught you guys in the first model, right? First inversion profile is here. So price cleared out an old swing high, right? In our first profile, I told you guys that price will have to go above a key level. That key level can be an old swing high, a premium or discount PDA, or a OTE. So we have our old swing high here. Price went above this old swing high. We have our fair value gap, right? The last fair value gap before price cleared out the swing high here and the swing high here, right? So we extend this fair value gap out on time, and we wait for price to close a candle's body below this fair value gap. Did price close the candle's body below here? No. We wait for a full body closure. Price did close the candle's body below, here, below this fair value gap. And what do you guys see? At this candle, price retraced exactly at this inversion. Let's look at our last example. Identify the SMR zone here. So did you identify the SMR zone? Yes. If yes, identify the fair value gap. Did you identify the fair value gap? Now, is it an inversion? Now, is price closing a candle's body below? Now, the condition here is different, okay, folks? The conditions that I showed you here is price is not going up after closing a candle's body below the inversion. But in the next example, I'll show you guys when it fails. Okay, how do you trade when price is failing the setup? I'll show it to you. So this is our SMR, right? We have our fair value gap right here. We have multiple fair value gaps in this condition. So which one do you trade? That's a very nice question. You can trade this one, okay? The newer one. In our previous examples, I'll show you guys, there was basically no other fair value gap other than this one, right? And even at this example, there was no other fair value gap. But when price has fair value gap in the new leg, we'll consider this one. We won't consider now this one or anything else here. Now this is the new fair value gap. We'll wait for price to close the candle body below here. So price did close the candle body below. We are executing according with our rules, but what do you guys see? Price retraced higher. That's what will happen, folks. Okay, it's not like every single time you'll see this setup and it will be like 100% what, like profitable. It's not gonna be profitable, but in this example, as you can see, price did give you opportunity here, but it failed. Next time, did price close the candle body again below this inversion? No, it didn't, right? So price went up. Now this time again, price closed the candle body below here, and price gave you opportunity here. Once price, you lost money here, you gained money here again. So this is our another example that I'm going to show you guys, right? We have our SMR leg right here. That's where price changes trend, right? We identify the fair value gap here. We have a fair value gap right here. This one, we identified it as our inversion. Now we wait for price to close the candle body here, right? Did price close the candle body below here? Yes, it did. And now look at that. So this one, in this one, price is failing. Okay, price did close the candle body below here, but price is reversing now. So when price reverses, now I'm gonna teach you how to take trades when this inversion fails. What do I mean by this inversion fails? When price closes the candle body below here, price should continue its trend lower from this level, right? But what do you see? Price did came back up again and close the candle body above here. So that's what you don't want to see. But if you see it, that's also another opportunity for you. When price is coming back up after closing a candle's body below the inversion right here, that's another opportunity. When price is closing a candle's body again above this inversion, you should know that the market structure shift happened and you were wrong here. And at the very next candle, you can see how price continue its trend towards buy side liquidity. And this right here, we'll use this condition just like before, right? In this condition, price closed the candle body above the old inversion from the SMR leg. Now we don't want to see price going below again and closing a candle body below. That we can do the damage. We'll put our stop loss below the inversion from here and we should be safe. And here, as you guys can see, after price gave you multiple chance to enter here, 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 here. So this last up close candle is working as a breaker. This is a low, right? If I zoom in a little bit, this is a low. So suppose this is a higher time frame. So it'll drop down to 1 minute and you will see a perfect low forming here, a low that formed here. This up the up close candle here will work as a breaker. So once price goes above the breaker, you execute at the very next candles. So this is it, folks. This is our day 2 lecture, and before I do close the session, I'll take you guys on the chart of Dow and I'll show you guys the example of inversion profile 2 specifically. Okay, so this is our actual chart from the Dow. Now I will look focus on this leg, this price leg here. So where's our SMR leg? Right here. This is our SMR zone, right? So let me mark that for you all. This is our SMR. Now we wait for we identified the SMR. Do we have an inversion here? Yes, we have an inversion. What do you guys see here? This is, I'm showing you an actual chart. This is Dow on daily time frame. Okay, now I'll show you guys this price leg. Sorry, not this one. Let's drop down to the 4-hour chart. Now let's look at this price leg on from the daily to the 4 hour. So this is our SMR zone, right? This is where price changes trend. Do we have a fair value gap? Inversion. Yes, we do have an inversion right here. Do you guys see what do you guys see here? So now this is, I'm showing you on higher time frame. You can use this narrative to decide your bias. Now the price is trading inside this inversion. As long as price is not going above this inversion, I can know that price is gonna stay lower. Okay, I know I can potentially recognize that price is trending lower. Okay, or price will continue its trend lower. Now let's show you guys a couple more examples. Okay, I'm just showing you randomly. Okay, I didn't outline it before, just a random example. Here, what's our SMR range? This is our SMR range, right? It's this easy to identify on charts, folks. It's this easy. Do we have a fair value gap here? Yes, we do have a fair value gap. We outlined it and extended out on time. Did price close the candle body below here? It didn't. So now we know that price will continue its trend higher. Once price closed the candle body below, right, it did here. We don't want to see price coming back up and going above this inversion again from the SMR leg. Now let's go and look for a couple others. What do you guys see here? So this is our SMR zone, right? Every single profile that I showed you guys, if I show it to you on chart, I'll be able to show it to you in hindsight this easily. Every single profile is this easy to spot on charts. So do we have a fair value gap here? Yes, we do have a fair value gap. Where's my horizontal? Yeah. Now let's see what price did here. So this is an old SMR zone, right? What do you guys see here? We extended out on time. Price didn't even reach here, let alone close the candle's body. But here, price did close the candle's body below, right? So what do we expect? Price not going up and closing any candle's body above, right? As long as price not coming back up and closing a candle's body above, as long as price is closing its candle's body inside this inversion, we can expect to see bearish delivery. Now this on 4 hour chart, folks. This same thing repeats on 1 minute. Okay, does it make sense now? So what do you guys see here? This worth way more than fucking $80. Trust me, it worth way more than $80. Okay, all the information that I'm sharing. Then here again we have our SMR right at this level. What do you guys see? Did price close the candle's body below here? No. Now price did close the candle's body below here, right? Once price did close the candle's body below, what do we know? The price will continue its trend lower. What do you guys see here? Now let me show you guys another example. What do you see here? This is a choppy price action, right? Anyway, I showed you guys a couple of examples on higher time frame. Right now, I'll take you guys on the 1 minute chart. Before I do close the session, I'll take you guys on the 1 minute chart and we'll see what's happening. Just a random. This is not even inside macro. Okay, so we have our SMR zone, the smart money reversal, right? This is where price continued higher. This is our fair value gap from SMR. We wait for price to close the candle's body below, right? Price did here. Now we know price will continue its trend lower. Now price came back up again. How many times did price use it to get support? To get resistance lower? Multiple times, right? So now what I showed you guys here is now that's a stupid question. I don't use any indicator. The indicator that I use is like new week opening gap to spot new week opening gap and new day opening gap. I don't trade with any indicator or anything. In my charts, there's no indicator. It's pure logic with price. So this is it, folks. This is our day 2, and trust me, if you go on your own chart and look for these market profiles, you will easily find it. Okay, I'm not gonna do it for you because that's something that I consider as a mentorship level, and this is not a mentorship. So when I do open a mentorship, you'll see me doing a lot more than what I'm doing here. Okay, there are a couple more profiles. How many profiles did I show you guys? 4, 5, I think 7, right? So 7 profiles. There are 10 to 12 more profiles left, and that's what I'm gonna cover in my mentorship. So this is the end of day 2. Our day 3 lecture will be on 5th of November, and there I will cover turtle soup plus couple more inversion models. Okay, folks. So I hope to see you guys again in day 3, in 5th November. Okay, folks. The time is yet to be decided. I'll let you guys know if I'm doing it in morning or in the PM session. So this will be it. If you guys have any question, you guys can email me or text me in the private Telegram group. I'll try to get back to you as soon as possible. Take care, folks, and peace.
Hey folks, good evening, good afternoon, good morning. Can you guys hear me loud and clear? Please let me know in the chat if you can hear me loud and clear, and after that we'll start in just 2 or 3 minutes. Thank you guys, thank you for letting me know. So I'm just waiting for a couple more people to join, and after that we'll start. So before I do start, I want to let you guys know that these lectures are going to be very advanced. So if you are just a beginner, it will be like very hard. It will be easy for you to understand. Okay, I made it easy for each one of you to understand. It doesn't matter if you're a beginner, you will understand the concept here, but when you go in your chart, it will be very hard for you to identify it because these things require experience to see it. And I'll help you to see it in live price action through my tape reading sessions on YouTube that I do for free. So yeah, if you are confused with this concept, you understand it here, but it's getting hard for you to find it out on chart, then come and see me trade in front of you live. I'm gonna do it every single day throughout the November session, throughout the whole month of November on my YouTube. And yeah, after that I'm gonna close the tape reading session on YouTube and I'll start tape reading only for the people who join my mentorship. Okay, first I'll share a couple of models that goes with turtle soup. First model is gonna be very high probability. I already shared one model that is like very easy to spot in chart in day 2. Do you guys remember I told you guys that this is A plus setup in turtle soup, and I took couple of trades. I identified couple of models live in my last couple of streams. Okay, so if you guys go on my YouTube and check out last 2-3 streams, you'll see me taking or calling markets by using the same model that I taught you guys in day 2 as a turtle soup entry. I'm gonna teach you guys couple more models today. I'll teach you guys how to take entry as a turtle soup in a turtle soup by using higher time frame pretty arrays on lower time frame. And trust me, you didn't saw anyone presenting this to you. Okay, the way I'm gonna present the turtle soup model, it doesn't exist anywhere else. Okay, so it's totally based on my experience, what I saw for last couple of years in chart. I'm gonna transfer my experience to you. It's not just a theory, it's what I saw in price repeating again and again and again. And when I teach you, when I show you these setups, you will understand. You cannot fake experience. Okay, so we will start right now. I believe yeah, I only see 25 people. I thought like more people will join. Maybe they will watch the recordings later on. So let's start, folks. So for you to understand turtle soup, how to take entries with higher time frame PD array by using higher time frame PD array on lower time frame, you will first have to understand the anatomy of PD array. What is this? High frequency algorithm will take measurement of a PD array into consideration, and based on that it will deliver liquidity with precision. Okay, I drew a candle here. So suppose this is a fair value gap on daily chart, on 4-hour chart, anywhere on higher time frame. And what time frame we consider as higher time frame? 15-minute, hourly, 4-hour, daily, weekly. Okay, we are trading on 5, 3, 2, 1, and 30-second. Whatever I'm gonna show you here works on every other time frame, but I saw these patterns repeating more on lower time frame than higher time frame, more accurately on lower time frame inside 5, 3, 2, 1, 30-second. Okay, so suppose this is a fair value gap, suppose this is an order block, and we will measure the order block like this. Most of you already know the concept of anatomy, how we apply this. You already saw me using it in live price action many times before, and today I will introduce to you by using the same theory how to take a turtle soup entry. So for that, I'll take you guys through the basic first. When we see a higher time frame fair value gap, we measure it like this. This is the high of the fair value gap. This is the upper quadrant, 0.75%. This is the midway, 0.5%. This is the lower quadrant, 0.25%, and this is the low, 0. Okay, this is the, suppose this is a fair value gap, so this is gonna be the low of the fair value gap. If we take the measurement of a higher time frame PD area and apply it to lower time frame, we will find precision from where price will reject. Okay, so this is, suppose this is a higher time frame fair value gap, you don't basically know from where exactly price will reverse, right? From where exactly inside that fair value gap price will reverse, and this is what gives you the precision. Price will, I wrote it down here, best rejection will happen from bullish scenario. Okay, in a bullish scenario, so suppose this is a BC and you want to take a trade from this by using this higher time frame BC on lower time frame, so you will expect best reaction from the high, the upper quadrant, and the midway. If price is going below the midway, you are wrong probably. Okay, price will go even lower, and that's what happens most of the time. Your best reaction will happen from the high. I will teach you guys how to take trades by using the high, what condition price presents in front of you to take trades by using the high of a fair value gap, what condition price presents to take upper quadrant and midway. Okay, I'll share the profiles, the way market will present this structure in front of you. I'll show you guys the same repeating structure in a bearish scenario. So suppose this is a bearish fair value gap, or suppose this is a bearish order block, so we'll expect the rejection in price from the low of the bearish fair value gap or order block, from the lower quadrant and the midway. The best reaction happens most of the time at midway. This is the high probability, but I'll also show you guys when to take trades by using low, when to take trades by using the midway, right? There's always a question like, HYDRA, how can I know the price will not reach at the midway? Price will reject from the low, right? How can price reject from the, how can I know the price will reject from the lower quadrant? And this is exactly what I'm gonna share with you from my experience. So I hope you guys understood how we use it. This is a fair value gap from the higher time frame. We see it, we put our measurement here, and this is how we measure by high, upper quadrant, midway, lower quadrant, and low. So here's a note at the below. You can see we are only measuring candle's body. Okay, we are not gonna measure the wicks. Wicks do the damage, and it's a part of manipulation. That's where the stop hunt happens. Okay, that's where the turtle soup happens on lower time frame. But what I'm gonna show you guys is a little bit different than what you already saw other people teaching about turtle soup. So liquidity is inside the body, that's why we will mark the body, and from this level, from the body inside, okay, from inside the body, we'll have the best reaction. So now let's go to our next slide. And as you guys can see, we have our first model here, turtle soup plus anatomy of PD area. So how does it works, right? So we have our bearish higher time frame PD area here. So this is our higher time frame bearish PD area. So what do we do here? We have a couple of rules. I'll go through it. So at first we identify our bearish PD area. Now let's see what our rules tells us. The first rule is to identify higher time frame PD area for potential rejection or support. It's very easy to identify, right? It's very easy to identify a fair value gap on higher time frame. So you saw the fair value gap, suppose you saw it, and now how do you trade it? Apply anatomy of PD area. Okay, this is the anatomy of PD area, and this is what you apply on your chart, the measurement of the PD area. You measure the chart like this. The third rule is drop down to the lower time frame. Okay, you see the bearish PD area on higher time frame, then you drop down to the lower time frame, and this is the structure that you are looking for. Okay, it will repeat, it repeats every single day. And the fourth rule is find out on lower time frame a all swing high or low. Okay, a swing high. If it's a bearish PD area, then you want to find a swing high. If it's a bullish PD area, you want to find a swing low, near or below high, near or below or inside higher time frame PD area.
So here's what is high probability. If the swing high, this is a bearish example, okay? So we have our bearish PD area here. We applied our anatomy of PD area here, right? Our high probability is we have a swing high or swing high below the bearish PD area. The fifth rule is wait for a stop hunt. Okay, we are not taking entry as soon as price goes above the swing high. Okay, we are not doing that. We wait for price to hit the higher time frame PD area. We apply the anatomy of PD area right here and wait for our best rejection. What did I show you guys in our previous slide? That the best reaction from a bullish or bearish PD area happens from the 0.25, from the low, and then the 0.25, and then the midway, right? This is our lower quadrant and this is our upper quadrant. So you will take entry after price clears out the swing high from here and hits the low, and this is where you take the entry. Okay, you see where price is showing you the best entry, and this is what you learn from your experience. But if you don't have experience, you are building it, you are demo trading it, then put your entry here, okay, just at the higher time frame bearish PD area, and you wait for price to reject from the midway. You leave some room for price to go up. You put your stop loss above the higher time frame PD area, and the ideal TP in this scenario is 2R. So our sixth rule is wait for price to reject, get support from the high probability anatomy levels. So these are the anatomy levels, right? So in a bearish condition, the high probability anatomy levels are low of a fair value gap, the lower quadrant, and the midway. We wait to see from which level price will reject. Okay, and how will you know the price will reject from these levels? That's what I'm going to show you guys in the examples. And this is where you take your entry, and this is what is your turtle soup. Okay, so I hope you guys understood. Now let's talk a little bit more about this structure. As you guys can see, price has relative equal highs here. Okay, so this is high probability, all swing high with equal highs plus below higher time frame PD area. So what did I told you guys? The high probability condition is we have a swing high with relative equal highs below the higher time frame PD area. Okay, price can also have this swing high inside the higher time frame bearish PD area, but the high probability is when price is a swing high with relative equal highs below the higher time frame bearish PD area. And as you guys can see, we have a lot of relative equal lows down here, and that's what you want to see when price is going for the stop hunt here, and when price is hitting this higher time frame bearish PD area. You want to see price constantly generating relative equal lows or trend line liquidity and not clearing it out. Okay, so suppose price is generating relative equal lows right here, and at the same time price is clearing it out, your trade is not as high probable as you think. You want to see price not clearing out these relative equal lows and trend line liquidity. So what it will do is that when price generates these relative equal highs, clean levels, it works for a magnet for price because these are retail stops. Okay, once price is done providing liquidity to a certain level, and which level? Above this swing high. Okay, what is this? Retail stops again, right? Retail buy stops, because these are relative equal highs. So once price goes above these levels, price is clearing out retail stop. At the same time, price is getting liquidity from our higher time frame bearish PD area. What is this PD area? This is a fair value gap. This can be an order block, this can be anything. Okay, but the best is when we have a fair value gap, and then this is where your turtle soup entry happens. Okay, I hope you guys understood the concept. The concept is you look at the rules. Okay folks, I really tried my best to put everything together here. So at first I'm gonna go through this again. At first, to identify higher time frame PD area, we don't have to know the bias. If the higher time frame PD area is bearish, okay, so suppose we have a CB, so we take entry from the CB, a bearish entry. We look for a bearish setup forming, and how will we know the price will reject from that higher time frame fair value gap? If you see this structure forming a lower time frame, that's when you will know that price will reject. When you see that price is leaving this relative equal lows on 3-minute, 2-minute, and 1-minute chart, or even 30-second chart, okay, this same structure will repeat on every single time frame. So suppose this is a weekly chart, you want to see price generating these levels on 4 hour, 1 hour. Okay, you can apply the same thing on hourly chart, but what I'm teaching you guys is not swing trading but scalping specifically on lower time frame. I'm saying you guys again and again, these entry models are high probability on lower time frame. These entry models works best on intraday sessions. So now let's go and look at our first example. So I did a recording of a I did made a recording of an example here. So at first I'll show you guys the example, and then I'll take you guys through what happened again. Okay, so watch it. Hey folks, so this is example number 1, and as you guys can see, as per our first rule, we will have to identify a higher time frame period, and now I'm on hourly chart on Dow, and as you guys can see, we have a bearish fair value gap right here, and it goes with our bias, which is bearish. And how do I know my bias, right? We have a breaker here, higher high, new higher high. You guys can't hear? Really? Okay, let me check. Just give me a second. Hey folks, so this is example number 1, and as you guys can see, as per our first rule, we will have to identify a higher time frame period, and now I'm on hourly chart on Dow, and as you guys can see, we have a bearish fair value gap right here, and it goes with our bias, which is bearish. And how do I know my bias, right? We have a breaker here, higher high, new higher high. So these down close candles becomes our breaker. Price closed the candle's body below the breaker, right? So price confirmed a advanced market structure shift. Price confirms its trend that it wanna go lower, and we have a fair value gap right here. Now we identified our higher time frame fair value gap. Now let's put the anatomy of fair value gap, anatomy of PTA right here. Okay, so this is our anatomy of PTA, and we applied it on our higher time frame PTA. Now as per our third rule, right, we will drop down to lower time frame and identify a swing high or a swing low. So here we are looking for a bearish trade, right? So we'll identify a swing high on lower time frame, and I teach you guys to trade on 3-minute, 2-minute, 1-minute, and 30-second chart. Now let's go to 3-minute chart. And as you guys can see, this is our higher time frame bearish PTA, this fair value gap. We applied our anatomy of PTA right here. Now we will identify a swing high. So what did I taught you guys about strong liquidity? A strong liquidity comes in two forms, right? Relative equal high, relative equal low, or trend line liquidity. And as you guys can see, we have relative equal high just with this higher time frame fair value gap, right? Price didn't traded inside this higher time frame fair value gap even on lower time frame. It left this relative equal high up here. So if you drop down to 1-minute or 30-second, you will see a swing high right here, but we don't need to. You already identified a strong liquidity level, so we will mark it. As for our third rule, we will wait for a stop hunt above here, right? We want to see price going above here and then rejecting from the high probability anatomy levels. What are these levels? 0.25, right? 0.5 and the low of this fair value gap. These are high probability levels. Lower quadrant and the midway. So now let's see if price comes towards buy side and shows a good rejection from here. And as you guys can see, price generated relative equal low, and that's what you want to see when price is that's what you want to see as your target. Okay, when you want to take a trade, you will have to have a strong target, and this will give you confidence in your trade that price generated it and when we see it, we know that these are levels that where price will come back again. So price left this relative equal low here, price generated another unfilled fair value gap, so a very strong confluence towards sell side. Now let's see if price rejects from here. Sorry for that. So price is getting support from this bullish order block, and as you guys can see, price hit the low of this fair value gap, and this is where is your turtle soup entry. Okay, your entry will be here, your stop loss will be above the higher time frame PT area, right? So this is our entry. Our stop loss is where, as I told you guys, our stop loss will be above the higher time frame PT area, and we will target 2R, right? And as you guys can see, 2R is like very near from here. So what I'm gonna do, I'm gonna target the swing low right here, and as we have a relative equal low right here, I will take a partial if I was in this trade. Now let's see if this trade is painting out or not. And as you guys can see, price didn't even went above the low of this higher time frame fair value gap. These levels, folks, are very sensitive for price. Okay, if price is going above 0.5% and closing a candle's body above, your short is not as strong as you were expecting, so you should not be taking that trade. But if price is staying below 0.25 and 0, the low of this fair value gap, this higher time frame fair value gap, you have a strong confluence that price will go lower. And we also identify the unfilled fair value gap, right? Unfilled fair value gap and relative equal lows attracts price like a magnet. And as you guys can see, price gravitated back to this relative equal low very fast, and ultimately it gave us our 4R. This trade was more like a 5R, so with this partial I'll consider it as like a 3R or 3.5R. So this was a beautiful trade, and our entry was here just at the low. Okay, so as I told you guys, our entry by using higher time frame PD area, by using anatomy of PD area, will be at the low when we are bearish. When we are bullish, our entry will be at the high, and we will expect a good price not closing a candle's body below the 0.5. There will be many more examples there I'll show you guys. Okay, so what did you guys saw here? There's another thing. Okay, I'll teach you guys candle counting. Okay, in our later lectures, a candle counting will be coming here. Okay, so when price rejects, price also leaves confirmation like here. This is one swing high, this is another swing high, this is another swing high. So 3 dive pattern is also visible here, and this is what I'll teach you guys in our upcoming lectures. Okay, also there was another entry, right? This is what I taught you guys in breaker lecture, a very clean breaker. As soon as price cleared out the buy side liquidity from above these relative equal highs, right, price rejected, and this is where you take your turtle soup entry. But if suppose you missed the entry, missed the turtle soup entry, and you are not experienced enough, you also got a chance to enter with this breaker, and price came back to this breaker, right? Price generated a fair value gap when it closed a candle's body below the breaker, and that's what you want to see. I told you guys many times in our first lecture that when price is going below these down close candles, okay, you want to see a fair value gap forming here. This is one of the highest probability breaker entry. Okay, and as you guys can see, price left this fair value gap unfilled. What we expect to see a immediate reaction. Okay, when price generates a fair value gap like this, we want to see price coming back up at the next candle, hitting the breaker, and then rejecting. But here what did you saw? Price left this fair value gap, right? Look at these lows right here. Price left these relative equal lows and then came back up and then showed a very good reaction. So this is a nice turtle soup entry that I showed you guys. I'll show you guys another example, but before I take you there,
Let's look here what I wrote. When price goes above strong liquidity, equal high, equal low, we can also consider it as a high probability reversal zone. So where was our relative equal high? Right here, right? And it gives us a high probability turtle soup entry when price goes above these retail stops. Okay, basically retail are not selling on lower time frame here, but this is how algorithm sees it. And price went above, good rejection, that's why you enter. And you are not entering randomly. I'm teaching you from the higher time frame. We identify a higher time frame PDRA, we apply the anatomy levels. Okay, we see how price is closing each candle's body. So suppose you didn't got a chance to enter here, at the next candle you guys saw the price came back up, retested the low of this fair value gap, right? And exactly this is where price stopped. After I close my session, after I'm done with my lecture, go on your chart, it doesn't matter, whatever pair, gold, crypto, whatever, apply the same theory and you will see turtle soup repeating in front of you again and again every day. You just didn't know, but now you know it. Now let's go to our second example, and I will show you guys how to know that price will reject from the low. Price will not go above 0.5 level at the second example. Hey folks, so this is example number. Hey folks, so this is example number 1, and as you guys can see, as per our first rule, we will have to identify a higher time frame PDRA, and now I'm on hourly. Okay, so I played the example 1 again. Let's go to example 2, and this is the example 2. Okay, I'm gonna play it now. So here's our example number 2, and as you guys can see, we have relative equal low right here in a form of strong sell side liquidity. Plus we already know that we are in a bearish trend from this delivery right here. We have two big down close candle on hourly chart right here. So here's a gem that I'm gonna share with you guys. When we have two fair value gaps like this in a single price leg and the delivery is aggressive, how do you know which one to use, right? For that to know, you will have to look at this part of price, and as you can see, we have a fair value gap right here, which is very high probability. Why? Because this fair value gap is making this fair value gap a high probability fair value gap, because this is a balanced price range, a BPR. Okay, so now we will apply our second rule in this concept, in this trade idea, that we will apply our anatomy of PDRA. Okay, so in our first example, I showed you guys a PDRA on higher time frame which was smaller than this one, right? So when we have, so this is a gem, write it down. When we have a small fair value gap or small PDRA in higher time frame, we can put our stop loss above that PDRA. But when we have a big fair value gap like this, best is to wait for price to come to 0.5% and then show rejection. Okay, so when we have a small fair value gap or a small PDRA on higher time frame and we apply our anatomy of PDRA, we will expect to see a good reaction from the lower quadrant. Okay, but when we have a big fair value gap or a big PDRA like this, we will expect to see price coming all the way up into the 0.5% and 0.75%, and our stop loss will be above or at 1. Okay, but that's not it. We are not gonna put our stop loss just because based on this theory. We will also go through other time frames to see if our stop loss is valid or not. Okay, so we already identified the strong sell side liquidity. We know the trend is bearish. We applied the anatomy of PDRA. Now let's go to lower time frames and build our confluence. Okay, so as you guys can see, this PPR, okay, I'm putting it here, and this PPR on lower time frame will give us more confluence when price is trading inside it. On 50-minute chart, we can also see another fair value gap right here. So what did I told you guys? When price has a big fair value gap or a big PDRA on higher time frame, okay, in our first example the PDRA was smaller. So when the PDRA is smaller, we put our stop loss above the higher time frame PDRA. But when we have a big PDRA on higher time frame like this, How do we trade it? We wait for price to come at 0.5 and 0.75%, okay? And we put our stop loss at 1. And how will you know that from which level price will reject? For that, we will have to drop down to 3-minute chart, and we'll have to find out a swing high inside this hourly fair value gap, right? So we have the measurement of our hourly fair value gap. We also have a 15-minute CB here, so let's mark it. So this is our CB from the 50-minute chart. This is the BPR from the hourly chart, and both of these are a bearish PDA. Okay, we are expecting a bearish price action. And now what does our rule say? To find a swing high on lower time frame. Okay, do you guys see that we have a swing high right here? So I'm gonna mark it, and now as I told you guys that when we have a big PDA on higher time frame, we wait for a rejection from 0.5 and 0.75. We don't do anything until price reaches here. Okay, now let's see if price is building strong sell side liquidity for us when it's moving towards these liquidity levels. And as you guys can see, price is constantly generating trendline liquidity, and that's what gives us confidence, that's what gives us confirmation that price will go lower from these levels. Okay, and as you guys can see, price showed a good reaction from the low of this fair value gap, but we are not executing here. Why? Because this PDA is big on higher time frame. Okay, so the rules are like this, folks. Okay, you will have to follow these rules. Sometimes you will see that price is rejecting from the low of the PDA, so you will have to also align other confirmation with chart, but the high probability is price rejecting from the 0.5 and 0.75%. And as you guys can see, price hit the 0.5%, but we already know where is our buy side liquidity, right? Our buy side liquidity is resting above this swing high, so we'll wait for price to go above this swing high and then execute. And as you guys can see, price hit the 50-minute fair value gap, right? And also price cleared out the swing high from the lower time frame, so this is gonna be our execution right here with a stop loss above or at the at the 1 level right here, about the high of the quadrant level. And what can we target? We can target the higher time frame relative equal lows that I showed you guys on hourly chart right here. Ideal target is 2R, but if you can control your emotions, okay, if you are getting experience, you can target these lows all the way down here. And as you guys can see, it's giving you a very small stop loss, right, and a very huge profits. But the high probability way to manage the stop loss is to put your stop loss above this fair value gap. Okay, when we have fair value gaps like this on lower time frame and price is trading inside it, and you are expecting a rejection or resistance from this fair value gap, I will suggest you guys to put the stop loss above the fair value gap. Okay, this is the high probability stop loss management. Now let's see if price trades in our favor. And as you guys can see, price gave you multiple chance to enter here, and when price went down, okay, went below the 0.75%, it also retested the level again before going down. And as you guys can see, price ultimately hit our TP at this level. So I hope you guys understood what I was presenting here, right? We are following all of our rules, folks. When we have a big PDA on higher time frame, we wait for price to reject from where? 0.5 midway in the upper quadrant. When we have a smaller PDA on higher time frame, we expect a rejection from where? The lower the low and the lower quadrant and the midway of the fair value gap. I'm repeating myself again. When we have a big fair value gap or a big PDA, and it's very easy to know, you see it on your chart on your higher time frame. If it's big, your eye is telling it. If it's big, you wait for price to
show a rejection from the 0.5 and 0.75%, okay, and our lower time frame swing high also confirmed it. As you guys can see, we had a swing high here, and we are doing is following our rules, folks. I'm giving you a footpath, I'm giving you a blueprint, and price is exactly printing these candles like this. When price is going up, okay, for these levels, you want to see price constantly generating these relative equal lows and not clearing it out. We have a higher time frame relative equal low here, but we are trading a lower time frame, so we want to see price not clearing out these relative equal lows, but we want to see price generating it and leaving it, okay. This is where the retails will buy, and once price is done delivering liquidity all the way up here, once price went above the swing high, as per our rule, this is our second rule, and this is the most important rule, is that you have to identify a swing high near or inside, okay, or below the higher time frame PDA. What is the high probability? We have a swing high below the higher time frame PDA. This swing high can also be inside the higher time frame PDA, but the high probability is when price has a swing high below the higher time frame PDA, and that's what I showed you guys in the example 1. And in example 2, I showed you guys that when we have a swing high inside the higher time frame PDA, that's how we trade it. And every single time, folks, it's a bet, it's a guarantee. When we have a big fair value gap on higher time frame, this is how price will react. Every single time you will find a swing high above the midway and below the 0.75 or at the 0.75%, okay. And suppose we have a fair value gap like this at the 0.75%, you are not putting your stop loss at 1, but you are managing your stop loss accordingly with the price delivery on lower time frame, which is above this lower time frame fair value gap right here. So what is the gem here? When we have a small PDA on higher time frame, we can put our stop loss above or below it. Above is when we are taking a bearish trade. Below is when we are taking a bullish trade. When we have a big PDA on higher time frame, we wait for price to show rejection from 0.5. This is the 0.5 level, 0.75, 0.75 level, and 0.25%. So 0.75 is when we are bearish, 0.25 is when we are bullish, okay. So suppose this was a bullish PDA, then we will expect to see price trading all the way down here 0.5% and not going below 0.25%. What do you guys see? Price came all the way up, retested the 0.75%, and then showed a good rejection, and this is your turtle soup model. And how do you get the confirmation, okay? How do you get the confidence that price will reject from here? Price will reject because you are looking at these levels, okay. Price is constantly generating targets for us. This trend line, liquidity, relative equal high and low are targets for us. In this scenario, we'll put our stop loss above the high, bearish, okay. When we are bearish, this is the high, but we also put our stop loss aligned with the lower time frame candles. And as you can see on lower time frame, we have this bearish fair value gap, so we put our stop loss above this bearish fair value gap, because what sometimes price does is, we are trading on lower time frame, price becomes volatile, price fills the fair value gap and then goes down. So it's high probability to put your stop loss above the fair value gap on lower time frame, above or below, okay. So I hope you guys understood how to take an entry with turtle. So now I'm gonna look at the chat. These type of entries are inside macros always. Look, when price gave you this entry 12:20 to 12:40, I'm not talking about the time here, because I already talked about the time in day 1 and day 2 lecture. You already know we are taking our trades inside macro. Without macro, we are not taking any types of trades, and your high probability entries will form inside macros, folks, okay. If if hourly close above 0.5, 50% high fair value gap, is this cancel short trade? No, it doesn't cancel short trade. Go back and listen again. I told you that when we have a big fair value gap, a big PDA, okay, we wait for a rejection from the 0.5% and the 0.575%. But when we have a short PDA and price is trading back inside 0.5%, it's okay, because we are putting our stop loss above the 1 level, right? And that's what I showed you guys here. at this example, let me take you back here again. See, price rejected from the low of this fair value gap, but we are putting our stop loss where? Above the one level. So even if price is retesting this 0.5, we are not getting scared. Price will still reject, but this, the high probability is when price has a small PDA on higher time frame, we put our stop loss above the high, and the best reaction will happen from the low. I hope you guys understood. Now let's go to our next chapter. Our next chapter is rejection block plus turtle soup. I'll show you guys profile 1. We have 2 profiles using this theory. The next profile that we will have, I'll show you guys the next profile inside our mentorship. So this is what you will get here in the 3-day bootcamp, the profile 1. So now let's start. So what is a rejection block? When price has long wick or wicks at the top or bottom of price action, we refer to it as a rejection block. Okay, so these are rejection block because these are long wicks and price is getting support from these levels. Okay, so now the question will be, how do I trade it, Hydra? Because you are teaching us that these are targets, right? We are targeting it, but if we are taking entries using it, aren't we retail? No, I'm gonna teach you a different theory, and this will be different from any other theory that you guys saw in the whole ICT industry. So let's see. But here we will use it a little differently because rejection block is also strong liquidity and it comes in a form of relative equal high or relative equal low. Okay, I teach you guys that these are targets. We are taking trades targeting these levels, but we can also take trades by using these relative equal lows. So how to trust it? This is the main question, how to trust it, because price can also go below and then go higher, right? Because these are retail stops, so price can hunt for it. How do you know it? Now let's see it. So first, the first rule is price will have to do a stop hunt already. Okay, when price does a stop hunt and then uses these rejection blocks to get support, this is the high probability condition. So stop hunt, high probability, not always required. Okay, this stop hunt is not always required, which I'll show you guys in the example 2. But in example 1, I'm showing you guys that when price has price already did a stop hunt and then getting support from these long wicks, this is a high probability condition. Thus our second rule is we will wait for price to generate 2 long wicks which are relatively equal. As you guys can see, 2 long wicks price generated. Why am I not considering this one, right? Because this is not a long wick. It's a basic thing. When you see this long wick, when you see 2 long wicks, that's when you trust it. When price comes back to the same level and rejects 3rd time, that's our turtle soup entry. Do you guys see it? So we have first wick right here after the stop hunt, right? And then we have our second wick right here. Now at this 3rd level we will take our entry, but how to trust it? We need more confirmation. The third rule is when price does come back to these wicks for the 3rd time, we want to see price closing a candle's body below the 2nd candle wick. So this is the rule. We identified our first big wick, right? This is a bullish wick, and then price came all the way down again, retested this support, and at the 3rd time when price does comes all the way down, we want to see price closing a candle's body below or inside this 2nd wick. Okay, price can also go a little bit down and get support from the 1st wick, but you want to see price coming down and retesting the 2nd wick. I'm telling you guys, this is advanced theory. It will take a long time for you to see in chart, and that's what I'll show you guys in mentorship. Okay, in mentorship I'll take you guys in the live price section. I'll show you guys that how it works. But now as per theory, I'll show you guys a couple of examples how it works. Now let's revise our rules again. First, price will have to do a stop hunt, right? This is our first rule, but this is not always required. When price does a stop hunt, this is high probability. Our second rule is we will wait for price to generate 2 long wicks. We identified 2 long wicks. Our first wick is here, our second wick is here, which is getting support from this first wick. And when price comes back to the same level and rejects 3rd time, which level? This is the level at the second week. We are looking at the second week. If price is coming back down and closing a candles body, isn't it getting easier? Yes, we identify 2 long wicks after price does a stop hunt, and we wait for price to close the candles body third time inside this candle wick. So our third rule is when price does come back to these wicks for third time, we want to see price closing a candles body below the second wick, and this is where price gives you a turtle soup entry. You wait for price to close a candles body below the second wick, and as soon as you see it, you enter the second you enter at this candle with your buy. Look for SMT right here, okay, because most of the time what I saw, the price is generating SMT below these lows and then going up. So this is what also works as a confirmation. So suppose I'm trading on US 30 and I'm looking at this formation. I'll also look at ES because these are correlative pairs, also NQ, and I'll watch that if price is generating SMT here. So I'm trading on US 30. I'm seeing this formation happening. I'll watch and see if on other pairs price is making a lower low here. So now let's see how can we take an entry here, our stop loss management and all that good stuff. So this is our chart that I showed you guys in the first in the previous slide. So price did a stop hunt, price generated a long wick right here. This is a swing, okay. Why am I not considering this one? So this is a good question, why I am not considering this one, because this is not a swing high, sorry, swing low, because when price generates a swing low, it will have to have 2 candles next to it, above it, okay. This is a high probability swing low. Price generated it, we identify 2 long wicks, and we have our first week. Our second week is retesting this first week, and at the third time when price comes back down and closes the candles body inside the second week, this is where we get a turtle soup entry. When price closes candles body below the second long wick, this is our turtle soup entry. Our stop loss will be below the first wick, okay. Our stop loss will be below here. If price is going below this wick, we are probably wrong. Price is doing a stop hunt. Our target, it will be the swing high all the way up here. Ideal target is 2R. Look for all swing high or low. This is a all swing high or low, or relative equal high. This is also a relative equal high, right? This swing high is also relatively equal with this wick. Then we will also identify if we have a trend line liquidity. We don't here, but usually price does. We will also target, if we don't have any of these 3 things, we will also target the third one, which is an unfilled fair value gap. So it's very easy to understand. When price does a stop hunt, you wait for price to generate a high probability swing. Once price does that, you wait for price to come back inside this week second time, and if price is repeating and coming back down inside this second week again, you want to see price closing a candles body inside the second week, and that's where you have a turtle soup entry. So now let's look at our example number 2. Rules. We will wait for price to generate 2 long wicks which are relatively equal, and when price comes back to the same levels and rejects third time, that's our turtle soup entry. Read it again, you will understand it clearly. So this is our first week, right? This is our first week. This is a swing low. Why? We have 2 candles right next to this candle which are higher than this one, right? The candle's body is not going below this candle here. So this week got generated when price retested the first week. Okay, now is it getting clear? When we have a week, right, when we have our first week, we want to see the second long week retesting the first week. We are not doing anything here, so we identified our levels. Our second rule is when price comes down, when price does come back to the wicks for the third time, we want to see price closing a candle's body below the second candle wick. So we want to see price coming down here and closing a candle's body here, okay? And as you guys can see, price came down, closed the candle's body here, and that's where you enter. If you want to get a little bit more confirmation, you can apply the anatomy of HYDRA that I taught you guys, right? So the best reaction will happen from the 0.5 and 0.25%. but it's not necessary. As soon as price comes down and closes the candle's body, which price did here, at the next candle you enter, and that's where is your turtle soup entry. So how does it happen? Stop loss, your entry is here, right? You are putting your stop loss. So look here, we have a big wick. So when we have a big wick and price is not going all the way down, in our last example, right, do you guys remember? Let me take you guys back. In our last example, as you guys can see, price came all the way down, filled the second wick, and then showed a good reaction. Okay, but in our next example, price didn't do that. Price rejected from the halfway, didn't even get to the halfway, but the upper quadrant, and then showed a very good reaction, support towards buy side liquidity. So how will you know the price will not go lower? That's why you wait for this candle to close. Okay, wait for this candle to close inside the second big wick. And here, as you guys can see, we don't have a stop hunt. When we have a stop hunt, that's the high probability condition, but when we don't have a stop hunt, it's okay. This also works when we don't have a stop hunt. Look for SMT with other correlative pairs right here below the swing lows. If we have a SMT right here, this will also work as an extra confirmation for you. So this is our entry right here. As soon as price comes all the way down, touches this, closes the candle's body below, we executed the second candle right here, and our stop loss will be, you can manage your stop loss accordingly here. Okay, what I will do in this situation is put my stop loss below the lower quadrant right here, but you can also put your stop loss below here, and target is our ideal target is 2R. That's what we will do. So do you guys understand this concept? This is basically a pretty hard concept to see on chart, because this repeats basically on lower time frame. This is what I saw when I was trading in 30-second, and mostly it repeats on 30-second, 1 minute. So yeah, if I see it in my streaming, I'll let you guys know, and you will see this pattern, me taking entries by using this pattern. The concept is very easy to understand. Okay folks, I can teach you here, and I told you guys when I started my stream, I will show you guys. I made it as simple as possible, but it's very hard to spot as a beginner in charts. So I already gave you guys 2 other models, right? Breaker, inversion, and those models are very easy to spot even when you are a beginner, right? So stick with that. Once you have pretty much confidence with other 2 setups, and you are confident to take trades, you are consistently taking trades with other 2 setups, look at these advanced setups. Okay, these are not for beginners. Turtle soup, trust me, is not for beginner. So this is another model that I'm gonna share. So before I do, let's see if you guys have any questions. Robert is saying, so if it does not close but wicks, do you take it or on the third time? Okay, so the rules are very clear, folks. We wait for price to close the candles body below here. If we are not spotting it, okay, if it's not clear on chart, don't take it, because these are high risk trades. These requires long experience. I started seeing this pattern repeating from the last year, and slowly I built in my confirmation that okay, this pattern repeats and it actually works this year. Okay, so after like 3-4 years, I saw this pattern repeating on chart, and I was able to take trades by using these patterns after a couple of years. So it requires experience. As a beginner, you won't see it, but in hindsight you will be able to spot it on chart. Okay, so the rules are very easy. You spot the first week, the second week is retesting the first week, right? You don't do anything, you are looking at chart. Then as soon as price comes back down inside the second week and closes the candle's body below here, you are not doing anything. You are entering at this bullish candle once you see that price is moving from the second candle towards buy side liquidity. Now is it clear? What time frame macro you normally trading though, as you have many? I already answered it in day 1 and day 2. Go through these lectures and you will hear me mentioning it. Okay, relative equal high and low plus turtle soup. So in our day 2 lecture, I showed you guys a consolidation model. Okay, when price is consolidating or ranging, right? We wait for price to clear out one side and then target the opposite direction. The same theory is here, but this time price is not consolidating, rather price is trending, but price generated relative equal highs up here. And this goes with our first model that I showed you guys, right? Which was by using anatomy of PDRA. So the same thing is repeating here, but this time we don't have a higher time frame PDRA. We are specifically looking on lower time frame and seeing this pattern repeating. So let's see what I wrote here. When price generates buy side liquidity in a form of relative equal high low, it works as a magnet for price as it's a retail stop. By now you guys already know it because I have been repeating, I've literally been preaching this since the day one, and even before, if you guys were watching me, this is where I personalize. When price hunts these strong buy side buy or sell stop, it provides us a turtle soup entry opportunity. What is the opportunity? As soon as price goes above these relative equal highs, you can take an entry here, and that's what I'll show you guys in the examples. And it's very easy to spot. Okay, this is like one of the easiest spotty a pattern on chart. Okay, I'll come back. I have a delivery here, so I'll come back in 1 minute. Okay, I'm back. Someone was ringing my doorbell. Yeah, it was Amazon delivery, so I'm back again. So these are one of the easy to spot chart patterns. The first pattern that I showed you guys using anatomy of PDRA, and even before in the day 2 I showed you guys another turtle soup pattern, and these are similar patterns, but price presents these patterns differently. Okay, I'm showing you every single high probability pattern that repeats on lower time frame, and that's it. Other than this, price just consolidates, and we already know when price consolidates how to trade it, right? So here, when price generates buy side liquidity in a form of relative equal high or low, it works as a magnet for price or retail stops. The same thing, I basically wrote it mistakenly, so let me clear it out. Yeah, now it's looking good. So this is what's happening. Now let's look at our example. So here's our example with the rules and the complete entry model, right? This is our example number 1. As you guys can see, I gave you guys a complete blueprint of how price will repeat this pattern and how you will trade it, as we don't have a higher time frame PDRA right up here, because sometimes you will see that there's no higher time frame PDRA. Like there will be wicks covering the fair value gap, so there won't be a fair value gap, there won't be a breaker block, there won't be order block. Price is just having random candles on higher time frame, but on lower time frame you are spotting this pattern. Then how will you trade it? And this is how you will trade it. So let's read it. This is one of the highest probability turtle soup scenario. Every single day you will see this pattern repeating on all asset class. Trade management, how do you trade it? So we spotted our relative equal high, right? So before we do that, we want to see price generating relative equal lows or trend line liquidity in sell side. Okay, we are not just taking entries blindly when price goes above here. We want to see price constantly generating relative equal lows and trend line liquidity near sell side liquidity. If you have a clean swing low and you are spotting this setup, I'll highly recommend you not to take it. These setups are only high probability when price has more trend line liquidity in the opposite direction of your trade. Okay, so we are taking a bearish trade, so we want to see price forming relative equal lows, trend line liquidity, unfilled fair value gaps right here like this. So how do we trade it? At the double bottom top, you take the entry right here. Stop loss management, there will be most of the time a higher time frame PDRA above relative equal highs or below relative equal lows. Okay, most of the time you will see that there is a higher time frame PD area. So on what time frame you will look for this PD area? So suppose this pattern is repeating on 1 minute or 30-second chart, that's why it will mostly repeat in an intraday session. So you will use 3-minute, 5-minute chart as a higher time frame, or 15-minute, and you will put your stop loss above that higher time frame PD area. You will apply the anatomy of PD area I showed you guys in the first slide. Okay, that's what you will do if you have a higher time frame PD area right here. If you don't have a higher time frame PD area, this is what you will follow. Best to manage stop loss accordingly with higher time frame PD area. But if you don't have it, your stop loss will be 20 to 25 points. That's the best when you are trading in features or indices. I believe like 20 points is a little bit like small, so 25 points is good if you are like generous enough. If you are patient enough, then 30 points is the best, and don't go above it, because most of the time on lower time frame price provides 2R. Basically price reverses after providing liquidity till like 4R. So as you guys can see here, I wrote it here, ideal target is 2R. So price went up, cleared out the buy side liquidity from here, from these relative equal highs, and then rejected, and this is where you take your entries. If you spot a higher time frame PD area, you apply the anatomy of PD area. But if you don't have a higher time frame PD area, you put your stop loss above 25 points and you target the swing low right here. And as you guys can see, when price was going up, right, hitting the relative equal high, it also generated these relative equal lows right here. Do you guys see it? And it also, price also had a lot of relative equal lows right here, and that's what you wanna see price generating when price is moving towards these liquidity levels. But if you have clean levels like this, you can hold your trade from these levels. And these kind of trades mostly, okay, most of the time I saw that it provides more than 2R. So the ideal target, I already talked about it in our previous slide, and even in our previous days, that ideal target is 2R. But if there's no strong target, suppose you cannot see a relative equal high or relative equal low, which is like very rare, you will always find relative equal high or low with these models, okay, then you will target like unfilled fair value gap. There will be unfilled fair value gap, and if you cannot see any of these relative equal high, relative equal low, trend line liquidity, or unfilled fair value gap, I will highly recommend to you guys not to take the trade, because there will be many opportunities intraday again and again inside our macros. Okay, so now let's go and see what our second example looks like. And in our first example, we took our profit all the way down here, right? So now in our second example, I'll show you guys how to take profits in the discount price lag. So what do you guys see here? I'll give you guys a couple of minutes to see, 1 minute to see this chart, and then I'll start talking. Isn't it easy to spot the relative equal low, relative equal high? Yes, so this is a very high probability pattern then that I see in chart repeating again and again. So now let's put our lipsticks. We have our relative equal low down here, right? We expect to see price coming down and clearing the relative equal low, but before price does that, we want to see price generating relative equal highs, right? Because that's what gives us confidence in our trade. We want to see price generating strong target before giving us an entry. And what do you guys see? Price generated relative equal highs here, right? Price also has a unfilled fair value gap all the way up here. So these are like high probability targets, and we do have both of these in the single trade. Price came all the way up, generated another relative equal high, then rejected, cleared out the relative equal low, and that's where you enter. These turtle soup entries, folks, always is gonna be aggressive. That's why I'm telling you guys, if you guys don't have experience like couple of years behind you, skip this part, okay? You will not miss anything. There are many setups with breaker, and stick with it. Come back to it when you are feeling confident and watch these slides again. It will make more and more sense to you. So how do you take it? This is where you take your entry. Price will give you enough chance to take an entry here. Look at this candle. This candle opened here, right? It traded back down, and that's where it's giving you basically again and again opportunity to take a trade. So if you can spot a higher time frame discount PDRA right here, you will put your stop loss below the higher time frame PDRA. But if you cannot spot the higher time frame PDRA, then your ideal stop loss will be 25 points. Okay, 20 to 25 points. It depends on what you are watching near here. Okay, you will see that if you have a fair value gap, the price is filling. So suppose we have a fair value gap right here on lower time frame, and price filled this, so you'll put your stop loss below that PDRA, below that fair value gap. But if you suppose if you are very new and you don't have many experience behind you, but you are seeing this pattern repeating, then only then you will use 20 to 25 points. And if you are not confident enough, then the max you can go is 30 points. Above that, it don't work because the risk to reward ratio will be like very low. So I'll recommend you guys not to take it if your trade is suggesting you to put stop loss more than 30 points. So as you guys can see, price had relative equal high here, price left it, didn't clear it, came all the way down, hunted the retail stop. That's where we take our entry. This is our target. So if I was taking this trade, okay, I will take a partial here, and my initial target will be this premium PDRA. So do you guys see another profile repeating here? Yes, in day 2, okay, at the end I showed you guys 2 inversion models, and one inversion profile is repeating here. We have a fair value gap, right? So this fair value gap failed when this candle closed here, and when this candle opened, that's what I taught you guys inside our day 2 lecture, that this is an immediate rebalance from this inversion. So price is giving you a chance to pyramid. That's why I'm telling you guys to stick with day 1 and day 2 model if you are a beginner. For you, if as a beginner, to take entries like this will be very hard, but at the same time, look here, price is giving you another opportunity to take entry right from this inversion, and it's very easy to spot. When you are taking trades with turtle soup, your heart will shake as a beginner, but when you are looking at these models like breaker, it's very easy to spot. Inversion is very easy to spot. Inversion is what? A failed fair value gap. How do we trade it? When price goes above that inversion, closes the candle's body, we wait for the next candle to come inside the inversion, do the immediate rebalance, and then go higher. The same thing repeated here. Price closed the candle's body at the inversion, right? And then this candle, when it opened, it traded lower, and that's what you want to see. You buy in a bearish candle, and when it traded lower, you buy here. The next candle, it also gave you guys another chance of entry. Okay, how do you manage your stop loss here? That's what I taught you guys in the day 2. You will put your stop loss below the inversion, and you will target 2R from here. So this is the whole model with relative equal high and low, which is similar to our first model, right? And even with our day 2 model, day 2 turtle soup model is basically a consolidation. Here what I'm showing you guys, that price is trending, but it also giving us opportunity to take turtle soup entries. So do you guys understand the concept here? Let me know in the chat, and then we will move towards our next lecture, which is a 3-dive pattern. Okay, the 3-dive pattern, folks, it works like a charm. Mostly on crypto you will find it repeating, but even on indices is the best. Okay, 3-dive pattern is the best confirmation to predict a reversal. So is it clear, folks? Okay, so now let's go to our 3-dive pattern, and this is basically like a retail concept. Okay, when I was trading with retail concept, I learned this, and even after I found ICT, I saw him using this 3-dive pattern, and I'm gonna share with you guys how I traded this pattern. Works best in crypto. It also do work on indices and features chart, on stocks charts. Okay, if you, after I'm finishing the lecture here, go on your chart and you'll see it repeating again and again. I'll show you guys a couple of examples to make it clear. Even when I showed you guys the first example, okay, with the first model in this slide, there was 3 dive pattern repeating. So once I'm done with the lecture, I'll take you guys back into those reviews, and I'll show you guys how that pattern repeated. So what is a 3 dive pattern? A 3 drive is a common price pattern formed by 3 consecutive symmetrical moves. These are the symmetrical moves. Price is constantly generating what? Relative equal lows, trend line liquidity. In its bullish form, the market is making 3 final drives to a bottom before an uptrend forms. In a bearish 3 drive, it is peaking before the bears take over. Okay, so what is happening is that price is constantly generating relative equal high and lows. And how will you know the price will reverse? So what I taught you guys already, that we'll wait for price to hit the higher time frame period, right? So we already know how to apply ICT concept, but we'll also learn how to see market with retail concept that works. So we have our first swing here. I'll show you guys the logic in a simple way. We have our first swing here, we have our second swing here, we have our third swing here, and once price clears out this third swing at the fourth, we expect a reversal, and that's where price gives us a turtle soup entry, and we will target the third swing and the second swing. This is the high probability, because at the first swing, okay, here we will have suppose a fair value gap with the order blocks. So this is a deep discount level from where price will reverse. Our ideal target will be third swing low, second swing low. Okay, it's very easy to understand. I'm gonna repeat myself again. Price generated a swing high here. The first time, you are waiting to see what price is doing. Second time, third time, and at the fourth time, when price cleared out the third swing high, price rejected, and this is what gives you a strong confluence that price will reverse from this level. Now let's go and see a little bit more, and how will we take our entry and manage our stop loss with this model. So our entry, market entry for the 3 dive patterns occur after the third drive. Okay, this is our third drive, this is our first swing high, this is our second swing high, this is our third swing high, and this is the fourth one that hit the higher time frame period. Okay, we will apply this concept with ICT concept to give us extra confirmation. So in the retail industry, when I was a retail, okay, when price was going above the third drive, they don't know like how far this swing will go. So what ICT did, he made it easy for me to know how far it will go. It will go until there it fills a higher time frame period, or it hits a premium PDR. Okay, this is a bearish, we are looking for a bearish trade here, so this is a premium PDR. Until price hits this premium PDR, you will know the price is gonna reject, and this formation will happen inside our macro. So that also works as another confirmation. In this scenario, again, the same with our previous models. Every single time we have a higher time frame PDR, we apply the anatomy of PDR here, and we manage our stop loss accordingly, the way I taught you guys in the first slide. But if you cannot spot a higher time frame PDR, then your stop loss will be 20 to 25 points. Max you are going is 30 points. So this is where you will enter when price tapping inside the higher time frame PDR, and your target will be what? The first swing low, and here as you can see, the second swing low is basically got taken out by the third one. So ideal target is 2R anyway, so that's what you will target, and you can see price went even lower. So this folks works like a charm. It's very easy to understand, it's very easy to spot in chart, and it works like a charm. Okay, I'll show you guys a couple of examples and it will make you clear. Here's an example. We have swing high, first swing high, second swing high, third swing high. So once the third swing high clears out, we enter as soon as price hits the premium PDR, or if you cannot spot a higher time frame PDR, you just take your entry here and you manage your trade accordingly. Price will eventually reverse. The target is same. If we can spot a relative equal low, relative equal high, or trend line liquidity, or unfilled fair value gap, that's gonna be your best high probability target. If you don't have it, then I'll highly suggest you not to take it, or target only 2R. Now let's go and look at our second example, which is from the slide. Okay, from this slide, let me take you guys back. from this example. Now let's go and see what price did here. Price generated our first swing high, right? Price was in a bearish trend. Now after that it changed its trend. It generated first swing high, second swing high, the third swing. Why am I not considering this as a swing high? Because this is not a swing high. It don't have a candle right next to it lower. Okay, this candle went above, so this is not a swing high, but rather look here, this candle is higher than this one and this one, so both of these candles are staying lower. So this is our third drive, and as soon as price went above the third drive, what happened? Price hit our higher time frame PDA, right? And when I showed you guys this example, I also applied the anatomy of PDA, right? That is also working as a confirmation here. The anatomy of PDA, we are putting our anatomy of PDA. Our fair value gap was big. We are expecting a rejection from 0.5 and 0.75, right? The midway and the upper quadrant was here, and as you guys can see, this 3 dive pattern is working as a confirmation to make you a little bit more confident to take this turtle soup entry. Isn't it clear? So when you spot this pattern repeats every single time on indices, folks. Okay, even on crypto, I'll show you guys the Bitcoin chart. The weekly Bitcoin chart is repeating there. Every chart that you go, if I go there and see, when price is trending, it's stopping at the third stop hunt, and that's where your turtle soup pattern forms. That's where price gives you a turtle soup entry. So this example was from our second slide. So now let's look at our 3 dive pattern and turtle soup on Bitcoin chart. As you guys can see, we have a chart here. Okay, look here, we have first swing high, right? We have candle lower to this candle, so this candle is lower, this candle is lower. This is our first drive, this is our second drive, this is our third drive, and at the fourth one we expect a rejection. Our target will be what? The third drive low, third swing low, or the second swing low. And as you guys can see, price showed a very beautiful rejection. I already showed you guys how to take entry from this, right? You can basically take entry from here and you put your stop loss like 25 points or 30 points, but the best is you are taking this trade accordingly with your higher time frame PDA. Okay, other time frame, you align other time frames with it, you take it, and it works like a charm. Now look here, the same thing. Okay, the same price action is repeating again. We have our swing high here, the first one, the second one, the third one, and the fourth price rejected. So this is an example from the weekly chart of Bitcoin. I told you guys that this works like a charm on crypto. Most of the time you will see price like exactly to the tick respecting this pattern, this 3 dive pattern. But on indices what happens is that we see a little bit more volatile price action intraday. So yeah, sometimes you will see that the third dive swing low is getting taken out by the second one. Okay, so this happened, but it also works, and as you guys can see, it's a beautiful formation. Now I'll take you guys back again into the first slide, the first example that I showed you guys, and here also the 3 dive pattern was repeating. When you know the concept, you will see it every single time. Okay, so it was here. Okay, so this is our first drive, right? First swing high right here, then our second swing high, our third swing high, and exactly at the fourth one price hit the higher time frame PDA. So we are basically not taking trades by using the 3 dive pattern alone. We are aligning other confirmation, we are mixing it together, and this 3 dive pattern basically gives me confidence in my trade. So I thought of why not share it with you all, right? It works as an extra confirmation, it gives you guys a confidence, and it's very easy to spot, and it aligns like it aligns beautifully with higher time frame, right? So first drive, second drive, third drive, and at the fourth drive we expect a reversal. It also aligning with our other logic, right? We expect to see price rejecting from the low of this fair value gap, and after that you guys know what happened. Price rejected beautifully from here after generating the third drive, and after clearing out the liquidity from the third drive, and that's it. So do you guys understand the concept of 3 dive pattern? Let me know in the chat. Is it clear, folks? So there's another. I already shared like 4 entry models with turtle soup, right? I shared 1 entry model in day 2, and here I showed you guys a couple others, and the highest probability is relative equal high and relative equal low in our first slide, okay? And other models are like a little bit advanced, so I'll show you guys how to take entries by using these models inside our mentorship when I'm trading in live with you. Until that starts, you can watch my tape reading session on my YouTube channel, and you will see me taking entries by using these models. So 3 dive pattern, folks, it's very beautiful. You will see price, like before price hits a higher time frame period or before price rejects from a fair value gap, it moves towards it, right? When it's moving towards it, it also generating swing high. So when you apply this 3 dive pattern, it works like an extra confirmation. When you see that, okay, price generated three swing highs, now I will wait for price to go above the third one, and this is what will give you a turtle soup entry. You will feel a lot more confident when you are seeing chart with this 3 dive pattern. And there's another model that is left, is breaker and turtle soup. So the model is basically like when price is doing the stop hunt in the breaker model, right? Our breaker doesn't get generated without a stop hunt. So that's what I'll teach you guys inside my mentorship. And there are 3 other models with turtle soup that I'll not show you here. It will be specifically for my students inside my mentorship. So this is it, folks, for the turtle soup models. Did you guys found it insightful? Let me know in the chat. And no one, I didn't saw like the other person in ICT community would teach us turtle soup is Romeo, right? So did anyone here did Romeo's course? So he didn't talk about any of this stuff, right? He basically like randomly showed you guys chart. I gave you guys a complete model, okay? I gave you guys, okay, if price presents this relative equal high, relative equal low, then you will take an entry. If price is doing this, then you are doing this, like a complete blueprint, a complete structure, a complete model. Okay, so let's now see what will be inside my mentorship. And so this is what I will present to you guys inside my mentorship. So everything about time, price, and all other concepts, right? Basically I shared with you guys 3 concepts. There are two other concepts. There are 2 other entry models that I use, which I will share inside my mentorship. And everything else I'll also share handwritten ICT notes. I shared like 3 or 4 handwritten notes in Twitter, and as you guys saw, like these are very easy for you guys to understand what basically goes on inside the marketplace. And I'll share like multiple, there will be like more than hundreds of handwritten notes, daily chart analysis and weekly forecast price analysis, weekly price action breakdown, seasonal tendencies. That's another concept that I'll teach you guys, okay, inside my mentorship. Plus there will be real-time mentoring with live tape reading session. I'll take you guys in the real time in the chart. In other mentorship, no one takes you in the real chart and trades with you, but I'll do that with you. Once we saw the turtle soup setup, I'll take it with you in real time. I'll show you guys, okay, this is what is repeating, and that's where you learn the best. I'll do 2-3 times a back testing session in a month, and we will do a whole month, okay? each time we will do a whole month of back testing and many more. So the booking will start soon. It's not available yet, but very soon I'll launch it, so you guys will know. So the pricing will be for you guys. I'm giving you guys a discount. For you guys, it's only $200 for 6 months. There won't be any monthly charge. You'll basically make the $200 when you see me taking trades in front of you, right? Because look here, real-time mentoring with live tape reading session. So what I'm gonna do, I'm gonna show you that this is a model and this is a high probability model. So what you are doing, you are taking it with me, you are making money. So basically $200 investment is nothing. There won't be a monthly fee for 6 months. Even there's a discount, like other people who are not inside my mentorship, right, this 3-day workshop, they will be paying $250, but for you guys it's only $200 for 6 months. And trust me, you will make way more money, plus you'll gain way more experience when you are trading live with me, when you are learning from me, when I'm showing you live in this chart that this is what happening, and that's what you should do. And that's where the best growth happens. Okay, when you saw my tape reading session on YouTube for free, go back. If you didn't, go back and watch the last session. See how much you improved just by watching one live session. And I'm gonna do it with you every week, 2 times for 6 months. Man, that's the best offer. So the mentorship is not available yet. It will open soon. I will yet to build the website, which will be HYDRAmentorship.com. So when I do it, the booking will start from I think from December or at the midway of November. So I'll let you guys know. For you guys, this is a discount, $200 USD for 6 months. And for the other people who are outside, they will pay like $250. So there's a $50 discount, and trust me, we'll make it back in like 2-3 days. So don't worry about that. So this is it, folks. This is the complete of our 3-day bootcamp. I will do a backtesting session to show you guys how I will do it inside my mentorship, so that you guys know what you are paying for, right? So the backtesting session will be on 10th of November. I'll share the timing with you all, okay? And this will be free. You guys don't have to pay for the backtesting session. I'll take you guys in the FX replay. I'll use FX replay, and we will use a whole month. We'll backtest a whole month inside our macros, and that session will be like 5 or 6 hour longs, right? So already what I shared with you guys here is more than, like, I believe our first lecture was 5 hours, right? Second lecture was 3 hours, and this lecture was 1 hour 30 minutes. So 11 hours of content, no trash talk, all knowledge. Even this is on discount, $80, and you are getting this. I saw like another day Twitter influencer, he is like 10 hours of content and he's asking for $200. That's it. There's no other thing. It's just a theory and people are buying it. So you saw what I can present to you with the quality of content. You saw me live trading. We saw me tape reading. So I hope to see you guys there in the HYDRA mentorship. And this is gonna be it, guys. This session is recorded, so you'll be able to access it again. And that's it, folks. I hope to see you guys in my mentorship and also in the 10th of November. Don't miss it, okay? That session is not going to be recorded. I'm not going to record it. I'm sorry to let you guys know that the backtesting session is not going to be recorded, so you will have to be there. So the time that I'll decide it with you all, okay? It will be based on like most of the people that prefer. We will not record backtesting session because that's where the real mentoring happens. I don't care like if someone leaks my content, because you cannot become profitable just by using theory. You need someone to show you how it works in the live price action, okay? When you're figuring out it by yourself, it takes a long time. But when you are learning from someone who can do it in live market, your experience, your learning curve, folks, trust me, it gets slower, okay? You learn first, you learn very first, and you make money first, right? You make money And that's it, folks. That's gonna be it for today. And if you guys have any question, our Telegram group will still be open, so you guys can ask me question there, and I'll try to get back to you as soon as possible. So that's it, folks. Peace.
Hey folks, are you struggling to find A plus turtle soup entry? Do you know how to match time and price for a sniper entry? If not, in today's lecture I'll teach you guys how to take a plus turtle soup entry by matching time and price, and it's gonna be very easy, so hang on with me. We're gonna be taking a deeper dive into how to take a plus turtle soup entry and how to find out the structure as well. So let's dive into our today's lecture and let's go. Hey folks, so let's dive into our today's lecture and we'll go through what is required to take a plus turtle soup entry. So the first thing that you need is the checklist for A plus turtle soup model. You'll have to know about the time and the macro when most likely these A plus turtle soup setup will form. And second is general idea of liquidity pools. We'll also go through that very soon. The third one is if higher time frame supporting trade idea on lower time frame. So we'll also have to look at higher time frame and see when we are taking our turtle soup entry, if that entry is backed up by a higher time frame PD area, like suppose BC, CB, or like order block or breaker from higher time frame as well. That will make our setup more high probability. So let's go inside the details. Inside specific time zone, price will repeat some same market structure. One of it is A plus turtle soup model, and this kind of setup, folks, will repeat every single day. You will just have to find out when it's gonna repeat, and it price leaves signature before it repeats this kind of model. So once you identify this kind of signature, you will know that okay, this model is gonna repeat now, and that's how you will be able to identify a plus setup coming before price actually gives you the entry. To take an entry with this model, you must have a good understanding of power of tree, accumulation, manipulation, distribution. We'll also go through that. This model requires no bias, so you don't have to rely on bias specifically for this model. This model is based on liquidity itself. Price will generate strong liquidity in both sides of the marketplace, and we will wait for price to clear out one direction of that liquidity, and then we'll target the opposite direction of the liquidity, just like that. So now let's move into our second page. Here I draw the whole model here. So this is one of the highest probability market structure that forms at macro. By macro, what do I mean? By macro, I mean that there are specific time windows when price will repeat this kind of structure. In this condition, price generates liquidity in a form of relative equal high or relative equal low in both sides of the marketplace. As you guys can see, price came down, chopped a little bit, and generated equal high and equal low. Don't worry, I'll give you guys a good visual on the chart itself, and when I show you guys that, you will have a better understanding of what I'm talking here. High probability is to wait for price to show its hand. If price takes equal high first, we will target equal low. If price takes equal low first, we will target equal high. So what do I mean by this? So suppose you saw this kind of scenario, price is accumulating orders. This is the accumulation phase, and you saw equal high and equal low in both sides of the marketplace. So the high probability is to wait for price to show its hand. You don't have to know which side price will deliver first. You will have to wait and see which side price wanna deliver first, and once price delivers liquidity in one side, like suppose price cleared out equal low, that's when you will expect to see the manipulation happening, and that's where you will take your turtle soup entry, and the distribution will be after the manipulation. Rules: price have to support bullish or resistance bearish from higher time frame PDRA. Price have to get support from a bullish PDRA if you are looking for a long. If you are looking for a short, then price will have to get resistance from a higher time frame bearish PDRA. So we'll rely on higher time frame to get this kind of scenario on lower time frame. Once higher time frame PDRA is identified, we can manage our stop loss accordingly. Manipulation and distribution must happen inside macro. So accumulation can happen outside of the macro, but the manipulation will have to be happened inside the macro. So I'll just give you guys an idea. Suppose you are looking for a trade at 850 to 910 macro. So the accumulation phase can happen outside of the macro. That means what? It can happen at 840, at 830, but the manipulation and the distribution must happen inside this 10-minute window, 850 to 910, and you will just get give price extra 10 minutes to do the distribution if it's not hitting your TP already. So together it's 850 to 910 macro. This scenario often provides two opportunity, turtle soup and a breaker. So our turtle soup entry is right here when price is doing the manipulation part, and once price goes above these swing highs, here we'll have a bullish breaker, and we will be able to take another entry from the breaker as well. So here's another slide with a chart here. So the rules are: identify strong liquidity, equal high and equal low. So as you guys can see, we have equal high up here. We also have equal low right here. Equal high means clean swing highs. Equal low means clean swing lows, those that are relatively equal to each other. You guys can see this swing low is relatively equal to this swing low. This swing high is relatively equal to this and this swing high. So that means what? We identified our first rule, that means strong liquidity, equal high and equal low. The second rule is identify higher time frame PDRA for manipulation. So you will wait for price to clear out one side of the liquidity. So if price is clearing out equal low first and you are expecting that, then you will have to identify a bullish PDRA right here from higher time frame. So suppose there will be a BC, there will be an order block or something like that on higher time frame, and once you identify that, as soon as price clears out the equal low, you can take an entry right down here. As you guys can see, I took an entry here, and your TP will be right up here where price left the strong liquidity levels. So suppose price was clearing equal high first, then you guys will target equal low. If price is clearing out equal low first, then you will clear out equal high first. At what time price is forming this structure? Okay, that's the most important part, is that once you identify the setup, your entry must have to be inside the macro. Why am I saying that? Because inside macro, price will do the distribution. Outside macro, price will do more accumulation. As you guys can see here, so suppose this is our 850 to 910 macro. So accumulation is happening before 850, manipulation is happening inside 850, and the distribution as well. So our entry will have to be inside the macro. And again, this model requires no bias at all. Now I'm gonna take you guys into the chart, and I'm gonna show you guys a real example. So folks, let's dive into our first example. And as you guys can see, we are in a bearish trend, and we have been delivering sell side liquidity down here. I'm showing you guys this example on 1 minute chart, and this is from today's price action, 16th Jan 2024. And as I told you guys, this kind of setup repeats every single day. All you have to do is find out the signature that price is leaving for you to identify the setup. So what do we see here? We had a bullish delivery, price cleared out equal highs from here, price delivered buy side liquidity, then we had a market structure shift. Below here, price generated a breaker, and it continued the trend towards sell side liquidity. So I'm going to use the standard deviation from this high, swing high, to this swing low, and we know that from -2 standard deviation we can expect to see a reversal happening, right? So we hit our desired target, it's -2 standard deviation. And now let's look at this price action, what's happening here. price here is generating, so this is our high probability reversal level by following standard deviation. -2 standard deviation always works out like a charm. It gives a good reversal for price. So what do we have here? As you guys as I told you guys the rules, that you will first have to find out what price is doing and how price is generating liquidity. You will first have to find out the strong liquidity levels that price is generating. What is this? This is our equal low. And what is this? Price is generating equal high as well. And we have another equal high up here. So how we are going to be trading this kind of setup? We already got one confirmation from price that it has a possibility to reverse from -2 standard deviation from this manipulation lag right here. And then we also identified equal low and equal high where we have strong liquidity levels. Now all we have to do is wait for price to clear out one side of the liquidity, and price will have to do the manipulation. That means this is the accumulation phase, right folks? So we are going to be identifying this liquidity, this consolidation phase, as a accumulation phase. And we also we are going to be expecting to see price clear out either one side of the liquidity levels, but we don't know which side price is going to be clearing out. But we have a good idea, as this is a reversal level, -2 standard deviation. We want to see price doing a manipulation towards sell side liquidity, right? So we are going to be expecting our manipulation happening at this level inside this -2 and -2 standard, -2.5 standard deviation. So this is going to be the part where we will expect to see a manipulation. So we identified the accumulation phase where price is generating strong liquidity levels, equal high and equal low. There's another equal high towards buy side liquidity. So it's reasonable for price to deliver sell side liquidity, clear out these equal lows, and then move towards buy side liquidity as well. So we are going to be expecting the distribution phase right here, and that will have to be inside our macro. So as I told you guys before, that accumulation can happen outside the macro, manipulation and distribution must happen out inside the macro. So our macro here, as you guys can see, price is trading here at 9 a.m. So our first macro that starts here is 9:20 to 9:40 macro. So I'm just gonna mark it out, 9:20 to 9:40, and this is the highest probability macro to expect a plus setup forming. So we identified our macro. We want to see price doing the manipulation part inside the macro. As I told you guys before, accumulation can happen outside the macro, but your entry, the manipulation and the distribution phase must happen inside the macro, and that's how you will know that price will have a good setup. You will have a good A plus setup. So now let's wait for price to clear out one direction, and we want to see the direction that is right here, the liquidity that is right here, equal low getting cleared out. And we want to see price clearing this liquidity level or this liquidity level inside the macro. Okay, our high probability scenario is price clearing out equal low, as we identified a possible reversal level. And if I show you guys another logic here, we have our OTE down here as well. So you guys can see we are trading inside 0.62 and 0.79 level. That is our ICT approved OTE level, 0.62 and 0.79. so this is our OTE. So we got two possible level for price to show a rejection. We are also trading inside -2 standard deviation, and we know these two levels are good for support for price, OTE and -2 standard deviation. Now let's see if price does our manipulation part inside this macro. And as you guys can see, price cleared out the liquidity The first liquidity that price offered is sell side. It cleared out all these relative equal low that it generated, and it also did a deeper dive inside our -2 standard deviation. But look at the time, it's 9:19. We are not still inside the macro. As soon as price gets inside 9:20, I will take an entry. So as you guys can see, price came inside the 9:20 period. So let's take an entry here. How am I gonna manage my stop loss in a scenario like this? You can put your stop loss below the swing low right here, below the where we have our sell side liquidity, and you can target up here or all the way up to the buy side liquidity as price tells you to do. Okay, it depends on the narrative, it depends on the volatility, it depends on your expectation. If you believe the price won't go higher than this level, then you should be taking your profit here or a partial down here. So our stop loss is staying here, our TP is staying at the buy side liquidity up here. So now let's see, we'll expect to see crazy volatility at 9:30. As we know, this is the New York opening price. So as you guys can see, we are now inside the 9:20 period. Just a little bit, just 1 minute more. And as you guys can see, exactly at 9:30 price hit our take profit up here. So I hope you guys understood like what I'm telling you guys here. All you have to do is find out a scenario like this where price is generating equal highs and equal lows, and after that you will have to wait for price to get inside this small time window. It can be 8:50 to 9:10, it can be 9:20 to 9:40, it can be 9:50 to 10:10 macro. So all you have to do, find out this kind of scenario, find out other logic for price to get support. Like what we did here, we identified that this is the -2 standard deviation, this is also a level of OTE. So two possible ways for price to get support, and price also left all this strong buy side liquidity, equal high up here. So we know that equal high and equal lows attracts price like a magnet. These are retail buy stops. So price, as soon as price cleared out retail sell stop, offered sell side liquidity here, it reversed and cleared out retail buy stop, offered buy side liquidity up here, and all the way up here. So I hope you guys understood this example. Now I'm gonna show you guys another example. So folks, let's dive into our second example. And what do you guys see here? We are generating liquidity, strong liquidity levels towards buy side and sell side as well. So all we have to do is identify the signature that price is leaving for us, the consolidation phase, and we have it here. We have our equal high up here, we have our equal low down here, right? So now all we have to do is wait for price to show its hand. What do I mean by showing its hand? We'll wait for price to clear out one direction, and then we will target the opposite direction. And we have more targets up here, equal high here as well, and all the way up here we have more equal highs here as well. So a lot of buy side liquidity. That's why we want to see price clearing out the sell side liquidity, as we have more and more buy side liquidity in a form of equal high here. And on sell side liquidity, you guys can see that we are basically done providing sell side liquidity, and we don't have anything on the left section of the chart. So now this is our accumulation phase, right? We identified our accumulation phase, and all we have to do is wait for price to get inside our macro. Look at the time here, it's 9 a.m. So when we are trading inside the 9 a.m, we have a macro that runs from 9:20 to 9:40, and as I told you guys, this is one of the highest probability macro that forms this kind of structure. So 9:20 to 9:40 coming down here, and we'll wait for price to do the manipulation, right? As we have so much buy side liquidity here and all the way up here, so we'll expect to see price clearing out sell side liquidity first and then delivering buy side liquidity. Why? Because price have been offering sell side liquidity all along, and inside this high probability macro, we expect to see price clearing out the equal high or the levels, the clean levels that price left before this macro. Why this macro is so powerful? Because at 9:30 price brings in the volatility, and that volatility straight goes for this kind of strong liquidity level. So we have our accumulation phase here. We'll wait for a manipulation happening down here, and after that we'll also expect to see the distribution happening towards buy side liquidity. So the ideal target is, in a scenario like this, targeting 2R with a risk like suppose 0.5% or 1% according to what you can do, right? According to your balance, according to your like funded account balance or like live account balance. So we are going to be waiting for price to clear out one direction's liquidity, and we are expecting to see price clearing out the equal low. And as you guys can see, price is generating more and more buy side liquidity in a form of equal high, and it left these equal lows down here untouched. So as you guys can see, price generated more equal high up here. Why is it equal high? We have a swing high here, then all of these highs are relatively equal to this swing high. So price is doing what? Price is generating liquidity for upcoming delivery at 9:30. Price will clear out these liquidity levels at 9:30. So now let's wait for price to clear out one direction. Price did that, and the manipulation part happened inside our macro 920 to 940. So we can take an entry right here. So we already identified price cleared out the equal lows right here exactly at 926, and we know that at 9:30 price will bring in the volatility. So this, if I was taking this trade and I took it, once I'm done with the explanation, I'll show you guys what I did live by sharing with you a recorded live trade management. So we are going to be targeting like 2R. As I told you guys, in a scenario like this, 2R is ideal. So our stop loss is staying right here. Ideal stop loss is 10 points. So now let's see what price does here. And as you guys can see, the 9:30 candle opened and is showing bullish signature. And as soon as price cleared out these equal highs, our breaker right here got activated. And as I told you guys, when you are seeing a scenario like this, you will also see a breaker getting generated. Now, do you guys see how price is getting support from the breaker right here? So you can take another entry from the breaker, and you can put the stop loss of the first entry at the break even, and your target can be like 2R. So after that, as you guys can see, price went up and offered more buy side liquidity up here. So this was our original TP, and this is where we will close our position. So I hope you guys understood what I was trying to say here. All you have to do is find out where price is consolidating like this, and the best scenario is price consolidating before our macro is getting started. And as I told you guys, that accumulation can happen outside of our macro, and the macro was here 920 to 940. So price did the accumulation before 920 period, and inside our macro, as you guys can see, price did the manipulation and the distribution as well. This is a very simple model, folks. All you have to do, align time with the model, wait for price to show its hand by clearing out one side of the liquidity, and then target the opposite direction. I hope you guys understood. Now I'm gonna share with you guys the live example, live trade management of this trade that I took on 4th January. So this right here, folks, is the same scenario that I showed you guys in the last example, and now I'm gonna play the execution, the live trade management, and watch it very carefully, how I'm doing it, how I'm predicting price going higher, how I'm taking the turtle soup entry. So as you guys can see, it was a beautiful trade, and the example that I showed you guys, price delivered more than 100 ticks. And as you guys can see, my entry was inside the macro when price did the manipulation. This is our accumulation phase happening outside the macro, manipulation happening inside the macro, and price doing the distribution as well inside the macro. And I told you guys the ideal target is 2R, and this is where I close my trade at 100 ticks profit. So I hope you guys understood the lecture. I hope you guys understood what I'm trying to show you guys here. When you identify a scenario like this, taking a plus turtle soup entry is very easy, and trust me, this is one of the easiest way to take a turtle soup entry. I hope you guys enjoyed the lecture. If you did, hit a like the lecture, and comment down below if you have any question. I'll catch you guys in the next lecture again. Till then, take care and peace.